process was expedited. That is the fear of some people who perhaps are unwilling to take the vaccine. What do you say to them?
Well, we can have 100% confidence that it's not more dangerous for the first 2 months because we have the data. I mean, although the review was expedited, the trial was done like any other, or the trials really were done like any other clinical trials. They were randomized, placebo-controlled. The participants were very carefully followed up. Everything that happened was recorded. It's there in the public view. It's been analyzed independently by the FDA, which, remember, is a really important role for the FDA. It's not just the company analyzing the data or even the researchers. You have this third check of the FDA itself doing an independent analysis. So people should really be comfortable that, we've got a lot of data showing that this is a safe and effective vaccine.
Dr. Califf, in the meantime, we can see the number of cases rising dramatically, leading to shutdowns around the world. How quickly will this vaccine make a difference and actually change the trajectory of the pandemic?
Well, you've heard a lot of talk from people, which I think is quite appropriate, that it's likely to be late spring, really before we have a major effect. But it's not right to think of this as just sort of a binary yes or no sort of a thing. We'll see a gradual reduction in the transmission of the virus as the number of people who are vaccinated increases, combined with the number of people that have already been infected. And we can't forget, probably most important of all, during the vaccination period, as we're rolling all these people through, which has to be done carefully, social distancing and wearing a mask will make an enormous difference in the number of people who die between now and the time when the pandemic is quelled.
Robert Califf, at the margin, how do we convince or force anti-vaxxers to get back into society with vaccinations? Is it the job of government? Is it the job of business? Is it the easy job of transportation that says you're not getting on the whatever if you don't have a vaccine? What do you see as the mechanism to drag anti-vaxxers into a vaccination process?
Well, first of all, I think we got to separate anti-vaxxers from people who are hesitant. Those are two groups. People who are deeply imbued in the ideology of anti-vax, I don't think we're going to change their minds. And I don't even think it's necessary for the most part that we force them to get vaccinated. We really need to focus on the people who are concerned and just, want to be sure that what they're doing is in the best interests of themselves, their families, and everybody else. And I think, there's a massive campaign already underway to get knowledgeable people to speak out. Very important in all of this are the clinicians, the doctors, the nurses, respiratory therapists, people who know about healthcare and are going to be are first in line to get vaccinated. As we were talking earlier, my son, who's an emergency medicine doc, is getting vaccinated on Thursday. Most people I've talked with, even sophisticated professors back at Duke University, what they tell me is, I'm going to ask my doctor. For other people, it may be the nurse that they see frequently. We've got to really provide the human face to this information and about how important it is.
Measured conversations like this one are important as well, so we appreciate your time, sir. Thank you. Robert Califf there, former FDA commissioner. Tom, to your point, will this be mandated by government? Will it be enforced by corporations? I think we already got a flavour of this a month or so ago when Qantas Airlines, the chief exec of that company, said, if you want to get an international flight at some point, we will require you to have a COVID-19 vaccine. I have no idea whether everyone follows or if they'll indeed follow through with that, Tom, but that's just a flavour, a sense of where things could be heading. Yeah, I agree totally. And the Qantas, of course, making a lot of headlines there, and you wonder what the next mechanisms are. We've been so busy this morning, John. This Moderna headline this morning, it's important. It is important. Hopefully, we get another nod for another vaccine before the weekend in the United States of America. For our audience worldwide this morning, good morning. New York looking glorious. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves, the significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating. And it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Not only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
From New York and London for our audience worldwide, good morning to you all. This is Bloomberg Surveillance live on Bloomberg TV and radio, and here's the price action. Futures up 0.7% after 4 days of losses on the S&P, the longest losing streak on a daily basis since September. We bounced back a little bit. I mentioned this yesterday. I think it's worth repeating. The consensus target coming into 2020 was 32.80 on the S&P 500, 36.65. The consensus target was 32.80 before anyone even knew about COVID-19 in this market. I still can't get my head around that, but that's the story right now. Switch up the board. Just quickly, the S&P up on the year by about 12.9%. Big advance off the back of a huge policy response, and that's been the story. And that's the story for the long end of this curve as well. 10-year yields about 90 basis points, basically unchanged on the day. 30-year yields about 164, up about a basis point on the session. It's about the next 24 hours. Tomorrow morning, we'll get a retail sales print for the United States of America. 24 hours from now, a lot of people think that retail sales print will be negative. The month-on-month read could be negative. So it's about the economic data for the long end, and it's about the Federal Reserve as well. And, Tom, we've talked about it repeatedly through the last couple of months. We want that clarity on the asset purchase program from the Federal Reserve. One, will we get it? And two, will they extend the average maturity of the bond buying, which basically means if you're looking for that, yields up, curve steeper, you might be a little bit disappointed.
Well, I go to the data. You talk about 24 hours. John Farrell, I would look at 24 days. That gets us through December, and a late jobs report in January. January 8, I believe, is the date calendar. Michael Gapin joins us now with Barclays, their chief U.S. economist. Michael, you look at December, and then you've got this wonderful phrase, looking at the hope that's out there. What's the character of our hope right now, and will our hopes be dashed?
No, I don't think our hopes will be dashed, but I do think the next several months will be difficult. The data is slowing, momentum is ebbing. Restrictions on activity are decreasing mobility. It is showing up in some of the higher frequency data points, but obviously I think that the hope and the optimism around the medium term is anchored around vaccines, which are now being distributed. So we still have this blend of kind of near-term pessimism with medium-term optimism. Given what we know, I don't think those hopes are going to be dashed on on the rocks of the shore. I do think we'll get there, but it's going to be bumpy to get there.
Yeah, and certainly when you talk about bumpy, another sign of it is that there seems to be a little bit more weakness in the manufacturing sector. According to data that just came out, the Empire Manufacturing Survey came in at 4.9 versus 6.3. It came in lower, and this is the first read to really get a sense of the December data. Michael, how much are you counting on manufacturing to remain robust as services are unable to employ people and really take off as people try to social distance?
Hi, Lisa. Thanks for that. Yes, we are actually depending on it. It's our view that manufacturing and factory output still has room to run to catch up with where demand is. Industrial production is roughly 5% below where we were in February, despite the strong demand from households for goods. So we are expecting the manufacturing data to hold up, even as some of that personal spending data fades. We think factory output still has room to pick up as well, and not just to meet demand, but replenish inventories, which have been down for 4 quarters. So we are counting on it to some degree to kind of hold things in place until services sector activity is freed up, which is likely going to come more at the end of the first quarter.
Still work to do for fiscal authorities. And, Michael, some people think maybe for the Federal Reserve as well. What do you expect on the forward guidance front in 24 hours' time?
I think just something that qualitatively ties how long the Fed will be buying assets to achieving the dual mandate. I mean, as you know, they've anchored rate hikes around thresholds, achieving maximum employment, getting inflation to 2, expecting an overshoot of inflation. So I think really all they want to say is we're going to keep buying until we're confident that we're on the path to that outcome. So right now they're just saying we're buying assets over the coming months. That's not long enough of a time horizon. So I think just something qualitative in nature about confidence that the economy is on a recovery path and we expect to be meeting our dual mandate. To me, this is not a big change. I mean, I think this is more about aligning the language in the statement with where markets are already priced and with what Fed members are already saying. So I don't envision that this is any big change forthcoming from the Fed in terms of guidance.
So just to tie this all together, Michael, it seems like the consensus, as John and Tom have been talking about, is looking past the now and the pain and looking toward a post-pandemic world. What would you have to see in the higher frequency data to change that view and account for a greater degree of scarring?
I just think that for the Fed, at the end of the day, I think that it'd have to show up in the labor market. And so if as Tom mentioned, there's that late report in January that's going to come out around January 8th. If that shows a market deterioration, so we're losing jobs rather than adding them at a slower pace, then that I do think changes the calculus for the Fed. So if we're losing jobs and then they may feel more inclined to do something as we move into March, whether that's change the composition or increase the pace of purchases. My guess is that would also light a fire under fiscal policy if we don't have a package in place by that point. So I think in the end it would come back to the labor market.
Michael, always appreciate your time, sir, and it's great to catch up as always. Michael Gapin there, Barclays chief US economist. About 20 minutes ago I said we had some breaking news. I'm sure we can build on that story right now with Gershon Distenfeld, who part-time works for AllianceBernstein, the co-head of fixed income, and now I understand full-time is a poker player. The final 9 of 2020 World Series of Poker, and Gershon Distenfeld gets a seat at the table. Gershon, can you walk me through your news, please, sir? And it's great to break this news on Bloomberg Surveillance, I've got to say.
Good morning, John. How are you?
Very well. Probably not as good as you.
Well, I've had an interesting past 48 hours. So I had the opportunity this year, since it was a little bit of a condensed version this year, the World Series of Poker main event. Most of it was played online until they got down to the final 9 players. I had the opportunity to play online since it was only 2 days of very intense poker. Usually it's held over a period of 10 days live. I don't usually have 10 days due to my very intense job. I was able to play, and I made the final table. Poker is a lot like investing. It's making decisions based on probability with incomplete information. There are a lot of parallels. So I've dabbled in poker over the years. Haven't had the time to play as much as I'd like due to the fact that my full-time job is in investing. But I was very gratified to be able to make a final table. I'm very excited about it.
Gershon, congratulations. And, maybe it's like the Queen's Gambit where she sees the chess pieces on the ceiling and you see cards and aces on the ceiling floating around as well. What's the number one mistake the 700 people made who didn't make it? What's the number one thing not to do in losing money at poker?
Well, I think it's the same thing as in investing. It's thinking that you know too much. Being overconfident, thinking that you know exactly what the other person has, thinking that you know the exact right move. I think realizing that the future is uncertain, realizing you don't know exactly what the next card's going to come, and estimating probabilities. And look, like in life and like in poker, there is a certain amount of uncertainty. And you do need there's a little bit of luck involved, or maybe sometimes a lot of luck, but in the end, skill does win out.
All right. Well, Gershon, I'm going to be, I don't know, Debbie Downer, but I want to make the analogy. You said that you have to know what you don't know and know when you're overconfident. Do you feel like there is too much confidence right now in markets?
Well, I don't know about now. I think there's too much confidence in general. People believe that they know everything. There's just too many pieces of information. I think humans are hardwired. I think you guys know from our previous discussions. I've studied a lot of behavioral finance. People are hardwired to deal in stories. We like to create a mosaic. We pick out a couple of pieces. The Fed's going to do this.
Right.
Right. Our politicians are going to do that. Therefore, Z is going to happen. X and Y and Z. And the world's a lot more complex. One of the most influential things that I've read in my life, books I've read, is a book by a former poker player, although it's not really a poker book, called Thinking in Bets by Annie Duke. It's something that I would recommend to everyone. It talks about how in life you have to look at everything as a series of decisions. And realizing that there's a lot you know, but for everything you know, there's so much more that you don't know.
Right.
And if you take that approach to life, to investing, to poker, whatever it is, not only will you make better decisions, you'll also be a lot happier when things don't go your way.
Gershon, one of my divorce lawyers said, read that book. Gershon, I want to look, Gershon, at the great Ed Thorpe. I had the honor, 88 years old now, I had the honor of interviewing Ed Thorpe years ago. He was definitive in quantitative finance with Paul Wilmot, Nassim Taleb, and others. What'd you learn from Ed Thorpe?
Well, I've learned a lot from. I haven't read Ed Thorpe tremendously. I've learned a lot from many authors. I tend to learn from those that are less certain about things. I think when people are in general are put out a thesis and they're so sure of themselves, you tend to doubt things. I've always found in my career I've learned the most from people that are humble and from those that realize that there's a lot more they don't know than they do know.
Gershon, always great to catch up with you, sir. I was going to finish with a year-end target on the S&P 500 for 21 and see if you responded with confidence and conviction, but I doubt it. Gershon, it's always great to catch up, and good luck, sir.
Good luck.
I'll be in touch, no doubt. We'll talk about it. Good luck. That was spirited, wasn't it? Good luck. Good luck.
I think it's fabulous.
What was that?
No. Good luck.
What was that, Tom? What was that?
I'm picking up snowshoes.
What's wrong? Snowshoes?
We're going to snow. Lisa's got the Alpine tubular snowshoes, the ones with a hinge on the heel and all that from when she's portaging with a canoe. I'm looking at the wood ones, Wilcox and somebody. Ash, hand-done snowshoes.
Boots? Yeah. Wood shoes?
Yeah, they wanted me to get in a Motel 6 right near to where we are. For the
I think I'm staying there too.
Coming. Yeah, so I'm just going to walk to work. I'm going to snowshoe to work.
John's just...
You done?
Checking out.
No, we're just, we're getting ready for the week. It's a big week.
I'm checking out?
He's like, I'm done, peace.
Been checked out since 6:59:30.
Nice, that's not true.
Before the show started. Just firmly checked out. I get to check out now in about 2 minutes. I'm stepping away. I'm done.
Please, to one of your other properties.
I'm done. Play the music. What's that music? Play the music.
We can talk about markets.
I'm looking at 2-year yield.
Play the music. There's the music.
Look at that.
2-year yield
That's
matters.
just glorious.
Look at that.
Turn that music up just a little bit.
Stocks are up.
That is glorious. That music has never sounded better. Alongside Tom Keane and Lisa Abramovich, I'm Jonathan Ferro. This
I don't think it's the same
Bloomberg.
Liverpool. I just don't think it's the same Liverpool.
With the First Word News, I'm Emma Chandra. Joe Biden is calling on the American people to accept the outcome of the presidential election. Hours after the Electoral College sealed his victory, Biden called on the country to, quote, turn the page on what he called an unprecedented assault on democracy. President Trump had no public reaction to the vote. It turns out more U.S. agencies were targeted by Russian hackers. The Department of Homeland Security was hit, and the New York Times says so were parts of the Defense Department. Meanwhile, the Washington Post says that the State Department and the National Institutes of Health were also hacked. Federal agencies have been told to disconnect their solar wind software that the Russians manipulated to break into their networks. In China, the economic recovery is picking up steam. Industrial output was up 7% and retail sales grew 5%. China's economy is likely to be the only major one to expand this year. It's being boosted by strong demand both at home and abroad. The City of London could face the toughest coronavirus restrictions as early as tomorrow. Infections have spread out of control and hospitalizations are rising. Under the so-called Tier 3 limits, pubs, bars, restaurants and indoor entertainment venues would be forced to close. And it's the latest sign that the U.S. economy is hitting a snag. A growing percentage of American homeowners are looking to delay mortgage payments. In the first week of December, the proportion of mortgage borrowers that began seeking relief rose to its highest level since August. That's according to the Mortgage Bankers Association and could eventually lead to more closures. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
With the new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
The Chinese market will never be like the international market in its entirety. The international market will never be able to suit into a Chinese market, but there will be enough, middle ground where they do intersect. It is in that intersection that Hong Kong have to find the most relevant role to play.
That was Charles Lee, the CEO of the Hong Kong Exchange. For our audience worldwide this morning, good morning to you all. Alongside a vocal Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up a little bit later on a programme all by myself, Kate Moore of BlackRock will be joining us on Bloomberg TV, and I'm very much looking forward to that conversation, Tom.
I'm sorry,
please.
Charles Lee's life has changed. Charles Lee's life has changed. It was interesting to hear that. I mean, Hong Kong 2021, what's it look like? I don't know.
It has changed a lot already this year.
How many more days, John? 3?
3. He's counting them. He's counting the hours.
This one.
He's got a clock. He's got a clock in London counting down. Lisa, John, go away. The open rates here.
The real calendar.
Some market reaction. Futures up 25.
3 more days left with Tom.
Okay, come on. I'm talking. You're interrupting again. S&P up 25. Dow futures up 162. On Bloomberg Radio and Bloomberg Television now, we're going to do what we love to do with one Barry Ritholtz. And that is rip up the script. You can do that with him. He's a wonderful read on the street. Of course, his podcasts have been really, really interesting. Barry, there was a young child at St. Paul's in Concord years ago whose parents, like a lot of other parents, played cards. But what she did was turn the card playing into a life work. Anna Duke. And, of course, the book we were just talking to Gershon Distenfeld about. You interviewed her years ago about poker and about our behavior. This is a year, Barry, where we need Ms. Duke to tell us how to behave into the next year. What would she say?
Well, probably the single biggest takeaway I got from the book was what she described as, quote, resulting. Resulting is the tendency that poker players and investors have when they look at the outcome of a variable. They look at the result and they draw the conclusion that what they should have done was what would have led to that result, completely ignoring all the unknowns, all the variables, all the randomness that may have led to that result. And it just discounts the idea of thinking in terms of probabilities, and that's what investors are supposed to do.
She's done all sorts of work out of Pennsylvania in psychology, folks. This is really heavyweight academics, but there's a book that's really, really accessible. John was talking that up with Mr. Distenfeld on his way to Las Vegas and Pokerdom here in a minute. I mean, thinking in bets, and Barry, the big bet is a single digit or lousy, go to cash 2020. A huge body of people got that wrong. What's your bet for 2021?
You know, the fact that the calendar year is flipping over in December is absolutely meaningless to these longer-term underlying trends that drive the economy, that drive corporate profits, that drive the stock market.
Stop.
So
Guys,
really
this is critical. We're going to pick it up with Barry. What he just said there, folks, is absolutely the most important thing in investing. Forget about the calendar. Barry, go.
So what's the underlying driver of the current market and the current economy? We've previously discussed the K-shaped recovery where the 30% or so of people who can work from home, the white-collar professional workers are doing fine. Everybody else who's forced into a furlough or layoff situation because of the pandemic are not. We now have the vaccine in the United States. We're now seeing it begin to be distributed by sometime next year. Let's call it the second quarter. I'm just guessing. We're going to begin the process of getting back to normal. How much of that is already built into the stock market is really anybody's guess. We've been anticipating this for a while, but we could start to look at things from a more traditional perspective and stop just spitballing as to what happens next.
Yeah.
At least the economy will start to resemble something approaching normal with a whole bunch of caveats.
Well, just to sort of complete the theme here of thinking in bets and making smarter decisions, with the moment that we're in where there is such a heavy consensus about that more optimistic moment that you say is increasingly priced into markets, does it make sense to try to go against the consensus just by virtue of positioning and probability? Or is this really a much trickier equation when you look at the scene at hand?
You know, I've made a couple of those bets over the course of my career, and they're always nerve-wracking. And one of the things you learn when you are on the opposite side of the trade from the crowd is that for the most part, the crowd gets it right. You know, it's not a coincidence that momentum and persistency and trends are such important parts of trading. It's not usually a minute-by-minute or day-by-day energy that's driving a particular sector or market or economy. It's big, broad secular trends that are pushing things in a given direction. And so guessing when that trend ends, and I use the term guessing very precisely, making that bet against the crowd, you know, there's a very brief moment when you could do that and be right. Most of the time, it's a challenging and money-losing exercise.
Thanks so much, Barry Ritholtz. Really love that. And, of course, the value of his podcast to have the quality of Annie Duke-on and many, many others. I can't say enough about Mr. Ritholtz as a habit for a 40, 50, 60-minute conversation with some of these experts. So futures up 26, they advanced. Dow futures up 165, as John mentioned, 4 days down in all. And, Lisa, again, I've got to admit, I'm not really focused on the market data so much with the news flow that we're seeing right now, and particularly on the pandemic. You know, I kid you about grim, but I'm sorry, Lisa, it's grim, isn't it?
Well, it's grim and hopeful. I mean, this is sort of the binary of 2020 that we're in December 2020, this idea that, yes, the pandemic numbers are getting worse, but the Moderna vaccine, which the FDA came out this morning and said seems to be effective and safe, is a big deal. Because the key aspect, and Tom, you've picked up on this, is that it doesn't have to be refrigerated at the incredibly cold temperatures as the Pfizer vaccine, which means that perhaps it can have a distribution process that's a little bit easier. These are key aspects in trying to get everybody vaccinated and get us all out and vacationing, and you back in your snowshoes, your wooden snowshoes that you're going to be trekking from Motel 6.
Yeah. You know, I'm looking at them. They got the short ones, and then they got the long ones with the big fancy tail. And
I can't wait.
You know,
keep them on.
They go down Park Avenue. I mean, you know, they don't work on Lexington, but they really work, frankly, on a snowy day. It's actually really beautiful, folks. The snow in Manhattan, when it really comes down for a number of hours until it's a mess, is really, really beautiful. We may see that here in a couple days. I want to run through the data. We've been remiss on that today. Futures up 28, Dow futures up 174, Dow out to 29,955. NASDAQ 100 shows some joy as well. German yields aren't really playing. U.S. yields, they play with a 2-year yield, 2 basis points, 0.91%. I'm going to call bonds a churn over the last couple days. Dollar, a churn over the last couple days. Commodities, a churn over the last couple days. You get the picture.
Any more churning?
Churning. Yeah, well, we'll see. Coming up on the pandemic, a serious conversation. Stephen Corwin, New York Presbyterian. Stay with us worldwide on Bloomberg Radio and Bloomberg Television.
industry, buildings, electricity, all of those things.
Everything you need to know about our
We just got to allow them to be given to the people who need them the most, but that's going to take more than 6 months.
Give you a sense of the real-time action.
With the big issue, vaccinations underway, the threat of lockdowns still lingering. Governor Cuomo with a warning.
We go back to where we were.
Similar warnings echoing throughout the nation, with infections surging, the pressure rising. Americans awaiting support, looking to Congress for action. A chorus of lawmakers calling on leadership to get it done.
This is our consensus bill. We all agree on it. It's ready to go.
Everyone says, why didn't you do this or why didn't you do that? We strictly looked at everything that was going to expire at the end of this month.
There's no excuse for either the speaker or the leader. You've got it. Give us a vote.
Now
Americans are hurting.
Stands by Kevin Cirilli and Kelly Lyons. Kevin, let's talk about it. Progress over the last couple of weeks. You've got to say we've had progress. Can we make this happen?
Lawmakers, but a quote-unquote Christmas miracle in order to get fiscal stimulus support across the finish line between now and the end of the year. But it comes at a time in which rank-and-file members behind the scenes have been growing increasingly frustrated at leadership of both parties, from Speaker Pelosi as well as Leader McConnell, for there not being some type of fiscal stimulus deal that has been stalled for months. But their lack of ability to deploy political capital from a centrist perspective has left them frustrated and left their options limited, even as the outgoing administration, with Treasury Secretary Steven Mnuchin trying to push for some type of an agreement, also looks to be stalled, really, by leadership of both parties. The final point that I would make here, Jonathan, is that the calculation that both Speaker Pelosi and Leader McConnell are making involves January 5th in Georgia. They feel that that will help to inform their negotiating abilities heading into a new administration, and they're very reticent in order to get some type of an agreement across the finish line before Georgia casts their ballots.
Leadership looking lonely. Can they wait until January 5th? Kevin Cirilli, thank you, sir. Kayleigh Lyons joins us now for the latest on the vaccinations. This is the story, Kayleigh. We need to get out to a period where enough people are vaccinated to remove the restrictions, and then we can talk about not having fiscal aid. Pfizer, yes. Where's the rest?
Well, Moderna could be coming, John. At least that's every indication we've gotten this morning after an FDA staff report found that the vaccine is safe and effective. Now, a panel of advisors to the FDA will be voting on whether or not to recommend it come Thursday, which means that it could be the second COVID-19 vaccine approved by the U.S. by the end of this week. Moderna's candidate, of course, is similar to Pfizer's in that it uses messenger RNA. It had similar efficacy rate. And as we know, Pfizer's vaccine rollout has already begun. But, John, to your point, it could be another 6 months before most of the population is vaccinated, or at least enough of the population to reach herd immunity. And in the meantime, the virus continues to rage really out of control in many parts of the U.S. Just yesterday, we hit the grim milestone of 300,000 deaths from COVID-19. And of the world's major economies, the U.S. has by far the highest number of cases per 1 million people, that number topping 50,000. In California, hospitalizations have jumped by 50% just since the start of December. 3 of the state's 5 designated regions are under mandatory lockdown. And as we just heard, Governor Andrew Cuomo saying New York could be headed back toward a second full as economies were beginning to recover, John.
The restrictions piling up. Kelly, thank you. Thank you very much. In this market right now, 25 minutes away. Throughout November, from COVID defensives into COVID cyclicals, we still see
of increased cases, the increased deaths, especially news of potential lockdowns. We're going to see some choppy. And the vaccine story and of the pandemic is what's going to drive markets. Still a lot of room left to run. So when we look at the differential in these
world, Europe was lagging. The world that we're trying to live in the second half of 2021 compared to where we were, Kristen, because
several months has repriced every single asset out there. to around 70%, there's still more for that to normalize to even get us back to the position that we were at the beginning of 2019. There's still big, or the beginning of 2020, I should say. There's still a big disparity there, and that's the gap that we actually think will close.
So that's the catch-up trade, Kristen. Then there's the next leg. Whether you stick with that rotation beyond just the catch-up trade, and we've discussed that so many times. I'm trying to understand in what environment
A story about the curve steepening and not necessarily depending upon the outcome of in this particular improved economic data or the continuation So this is another area that typically, these are the strong companies, the quality companies that have high quality balance
always sharp and always great to catch up with you. We appreciate your time. Kristen Biddley there of Citi. Let's get back to these markets up 24.
Vaccine for COVID-19 is both safe and effective. They will be making it unusual. The Nikkei usually has a bearish slant toward Apple. Not today. Apple popping higher, John.
Increasingly optimistic about the recovery. Weighing in on that conversation.
I think the market's kind of figured. And that's why, again, even today, you're starting to see some of the small caps, value stocks continue to
in the way for a second shot to gain emergency authorization, potentially. % in the third quarter. On this report is Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, if I could sum up the survey in one way, it would be bold. But that risk appetite extends beyond equities. Optimism on risk-on assets was the highest going back to February of 2011. And as well. Now, as for the most crowded trades, even despite all that conversation about value over growth, technology is still the biggest sector overweight. And when you look at the most crowded trades, long tech tops the list at 52%. It's followed up by very same crowded trades, John.
Bitcoin. We'll find some time for that a little bit later in 2021, maybe. PIMCO's Erin Brown publishing her 21 asset allocation outlook, expecting the early cycle recovery to provide a tailwind for risk assets. She writes the following: we remain joins us right now. Erin, that's the outlook. We'll get to that in just a moment. I just want to ask you a question on how you would respond to the following. Governor Cuomo was pretty outspoken
last month or so over the Thanksgiving holiday. So first, I don't think this should come as a surprise. Second, I think investors largely understand that it's going to be $2021.
When do you think we need to see evidence of that pickup, Erin? If we're willing to look through the weakness in claims, in retail sales tomorrow, in the payrolls report that comes in early January, when do you need to see the pickup?
I think that you'll likely start to see the pickup in the second half of the first quarter. So as we move into March and then into April, where you start to see real adoption of the vaccine, that's when you're going to start to see the bottoming of the economic data and start to see the pickup into really the second half of 2021. At PIMCO, we're expecting that we're going to return to pre-COVID levels of productivity and output in the second half of 2021, so in the third or the fourth quarter, which is well ahead of what we're expecting to see in Europe and broader developed markets.
And going into that, we're familiar with this story, the exposure to industrials, materials, semis, housing. Erin, what I didn't see in your report was energy, financials. Are they a factor in the mix as you add some cyclicality back into the portfolio going into 21?
So first, we do like to separate cyclical growth versus value. And oftentimes companies are value because, there's some type of impediment to growth. And so we're really looking for good quality cyclicals rather than just, putting all of our eggs into the value basket. When you look at financials, when you look at energy, I think that both of those sectors have problems for 2021 that are going to continue to impede growth and really keep them continuing to underperform. With the case of energy, we do believe that this is a sector where it's likely to be fairly range bound in terms of the total price of oil next year. And that's certainly going to weigh on the amount of profit growth that we expect in 2021. Certainly, you're going to see a catch-up trade in terms of sort of profitability growth, just given how much it's been hurt this year. But we're not expecting that to be widely sustained. In the case of financials, I think financials also have a problem because they've been disintermediated by the central banks, and certainly here in the U.S. by the Federal Reserve. And I think that is going to be able to cap the total profit growth that we see from financials this year. Certainly, we do expect that you'll see some curve steepening, and that should help modestly, but it's not where we think that there's really going to be significant growth potential next year.
Erin, there's two risks on your radar around this portfolio that you've been building. One is lower growth, obviously. The other is higher inflation. How do you protect yourself against that?
Yeah, it's a great question, and it's one of the questions that we get most from investors right now. I think that there are ways to insulate your portfolio. One is through buying break-even inflation. That's one of the sort of simplest or most direct ways to buy inflation protection in portfolios. And despite the fact that you have seen a rebound in inflation over the last 3 significant next year. We still think we're in a low inflation environment, but it is a risk for portfolios that you need to protect against.
Can I just say Kate Moore. This is Bloomberg.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonizes it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
Let's get you some morning calls. First up, Goldman adding Bristol Myers to its conviction list. The analyst expecting commercial execution and FDA approvals to drive upward revisions and multiple expansion. His second call from the team at Wells Fargo upgrading Exxon to overweight, $53 price target. The analyst seeing a more favourable macro environment next year with fundamentals improving. And finally, Citigroup upgrading Hilton Hotels to a buy. The analyst saying the industry is on the cusp of a multi-year recovery with the biggest challenges in the rearview mirror. They're three of the calls. The opening bell is up next with Kate Moore of BlackRock. This is Bloomberg.
There's a need and a clear need for me to spend money. I need to spend money to boost the economy, the necessary push. And therefore today, as of now, and for this fiscal, I shall not worry about the deficit number.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Uncomfortable bullishness has been a feature of this market throughout the whole of 2020. It is uncomfortable. Equities are up another 27 points on the S&P 500, up 0.75%. Uncomfortable because the restrictions are moving in the wrong direction. Tier 3 in London, lockdown potentially, I stress potentially, in New York. But we have a vaccine, and that gives us the ability to live in the back half of 2021 if you're in this market. For society, you've got to live in the here and now, and I hate to get philosophical, but that's just the challenge for investors at the moment, to live in the back half of 21 with everything that is just not good happening all around you. Futures up 0.8% going into the open. Switch up the board into the bond market. Key 24 hours coming up. Tomorrow morning, retail sales in America looking for a downside surprise, maybe. Given the restrictions, we're already looking for a negative print on retail sales. Jobless claims come Thursday morning. They've been moving in the wrong direction. And the Fed, will the Federal Reserve give the green light for yields to go higher at the long end? Your 10-year 91 basis points. And the FX market, euro-dollar 121.53. Crowded trade. Short the dollar, they say. We are just off the highs of the year on euro-dollar at around 121.78 intraday for 2020. That's the market action cross-asset worldwide at the market desk with your movers. Here's Abigail.
John, let's start out with this morning's big news, and that, of course, is Moderna shares are popping higher on the news that the FDA has found their COVID-19 vaccine both safe and effective. They will be voting on Thursday for the emergency authorization that everybody expects to go through. If all goes well, most likely their vaccine will start shipment and distribution later this week or into next week. So that stock up about 0.5% off the highs. Nonetheless, the bulls are there. Where we really have the bulls, Apple up 2.2%. We have Nikkei saying that they are likely to boost their phone production by 30%. GE up 1.3% as Deutsche Bank has raised their price target by 44% to $13. And then Wells Fargo also getting a bullish nod from another bank, KBW, raising their rating to outperform. This stock, Wells Fargo, really up in a big way over the last couple of months on the reflation trade, John, up about 35%. And interestingly, Moderna, flipping ever so slightly lower there. So we'll be watching that all day to see whether or not it's a sell the news event similar to Pfizer yesterday. And then talking about sell the news, John, if we take a look at some of those big IPO movers that had been up so much last week, Snowflake, which IPO'd in September, down 7%. Airbnb, which had doubled last week, giving back 3%. So not a huge move lower. DoorDash also climbed huge off of their IPO last week, up 85% on the IPO, giving back just a little bit, down 1.4%. Investors considering that froth that everybody's talking about, John.
Plenty of froth, according to plenty of people, though the consensus trade is still to buy. The S&P 500 up 0.6%. Information technology on top. We advance about 1% there on materials, up 0.9%. Call it 1 percentage point. Pretty much every single sector on the S&P 500 in positive territory, with the exception of real estate this Tuesday morning. Looking ahead, Wall Street preparing for the year ahead, already establishing a massive consensus trade for 2021.
We remain overweight equities at the expense of fixed income.
The focus for investors is really away from treasuries.
It's cash that is providing you that risk control far more than government bonds.
I would play it via equities, and I would hedge out my currency risk.
We're still bearish the dollar.
Sentiment has been built up very, very bearish on the dollar.
This is the same old story that we've been talking about.
You are going to see larger and larger allocations towards equities.
Central bank support has provided if you like, an umbrella.
Investors have gotten a bit aggressive.
It seems to be a consensus view looking outside of core government bond markets.
You have no other choices.
People do feel they have no alternative but to buy equities.
For more, let's bring in Bloomberg's Katie Lyons. Hey, Katie.
Hey, John. Well, the harmony among these strategists is really quite remarkable. Wouldn't really make for a very interesting dinner table conversation, considering everyone seems to agree with each other. When it comes to equities, everyone is basically bullish. Yesterday on this program, I was talking about how there isn't a ton of consensus as to how far equities will run in 2021. Forecasts range from anywhere between 4% and 20%. But the fact of the matter is, John, everyone does think the S&P 500 would end the year higher. On average, they see the index at 40.35. That would be upside of around 10% by year end. That's even more bullish than the strategists were at the tail end of 2017, even with anticipation of tax cuts. Now, within equities, we all know what the trade is. It is cyclicals over defensive, small caps over large. We do all know that story. Now, when it comes to the FX, consensus there as well. It is a weaker dollar that everyone is calling for. And our colleague Cameron Christ put out an interesting piece yesterday pointing out that when you look at the euro-dollar cross, this is the 5th consecutive year that the strategists have expected the dollar to weaken against the euro over the next 12 months. It's actually only happened in 2 of the last 4 years, as you can see here, so we'll have to see if it actually plays out. And it's worth pointing out that the magnitude of the expected drop in the dollar is relatively small. Then in fixed income, John, bearish treasuries is the consensus call. The 10-year treasury yield, which has remained below that 1% threshold for so long now, is expected to rise by about 30 basis points over the course of the year. John, here's the thing, though. The street basically always expects yields to rise. Over the last decade, they have forecasted the 10-year treasury yield would rise every single year. It hasn't happened every year, though, so we'll see if 2021 does indeed bring that, John.
That has been the pain trade in the bond market, that's for sure. Katie Lyons, thank you. Lou Wang of Bloomberg News put this together as well on the equity market. 2 decades. For 2 decades, not once has the consensus been for lower equities. For 2 decades, the consensus has always been equity markets will be higher. Kate Moore of BlackRock weighing in. She writes the following: investors have had an insatiable demand for compelling secular growth stocks and will be hesitant to rotate away from the 2020 winners and into deep cyclical or reopening trades against the backdrop of an even recovery in the first half of 2021 and a long path to activity normalisation. The retail darlings within growth and tech will likely remain crowded. Kate joins us now for more. Kate, bit of pushback there. That's refreshing. Let's talk about it. Let's sit on that just for a moment. You think the crowding into tech can persist. Why, Kate?
Yeah, so hello, John. Nice to talk to you today. A couple things I want to point out. So I am in the consensus in believing that equities are going to be the best performing asset class in 2021. I don't think that is, just because we're all in that space, that should be terribly controversial. But there are a couple places where I think, the market might be wrong, or the consensus in the market might be wrong. First of all, it's kind of around the timing of the recovery. And the second is around the shape of the recovery, the second being really critically important. Now, the timing, I just feel like, everyone is expecting as soon as we start getting a bunch of jabs in the arm, we're going to return back to normal activity. And I think we're going to be in very uneven paces across different industries. And everyone needs to be quite measured, I think, about their enthusiasm for some of the travel, entertainment, leisure, deep cyclicals that have been depressed over the course of 2020, and think realistically about their fundamentals. And then the second point is on the shape of the recovery. And this is something I think you and I have talked about before. Everyone wants to go back to the playbook they've had from previous recessions. What did it look like when we came into sort of a better demand and a better second derivative for growth environment? But this is different, right? This is a health crisis. And we've seen some industries get permanently impaired as a result of it. And we've seen an acceleration and an improvement in the prospects for other industries. So I think there's room to own more of the tech stories, the platforms, the software, the digital enablers that have really sort of shown in throughout 2020, and I think are going to be in high demand throughout the course of next year.
Kate, let's talk about the time horizon. You mentioned through the course of next year, but is this a cycle call for you or just the 12-month call?
Yeah, so the 12-month calls are really hard, John. You know this. We all sort of put into the box of making a full year call as we get into, Yeah, no, I mean, it's difficult. We have to do it all the time. But the truth of the matter is that, this is going to be a little bit more uneven. One of the things I pay very close attention to is the CFO surveys. And a number of, big institutions do these, gather them across CFOs across a variety of different industries and ask some good questions. There have been some great COVID-oriented CFO surveys. And quite a lot of these are now showing that CFOs across all industries and geographies are not expecting any kind of real recovery or near normal activity into the fourth quarter of next year and the beginning of 2022. So, against that backdrop, that's why sort of the timing is so important, is that, you're going to see some industries pick up off the bottom, but returning to normal levels where you can actually sort of project a sustained revenue growth, it's going to take some time.
On the sustained improvement, I think what you're looking for in terms of gradual improvement around two particular sectors, in fact, one, let's talk about it, travel and leisure and entertainment as well, Kate. This idea of this temporary pickup, this gradual improvement and the sustainable, more durable trend as well, where do those sectors fit into that thinking?
Yeah, so I think the preferred reopening trade for lots of investors, I'd say for a number of my colleagues at BlackRock as well, is really around travel and leisure, and travel in particular. But I think we need to really think about which travel companies are well positioned. And I'm thinking about those that have strong digital platforms, those that enable the consumer to do price comparison shopping, that provide them with flexibility in case there's another uptick in cases or something changes in terms of their own health. And, there are a bunch of digital companies in the travel space that I think are actually quite encouraging. Some of the more traditional travel names, I'm less constructive on, frankly. And, it'd be tempting to say because they're depressed, because they've had a rough go in 2020, let's just buy them back. But they may not be well positioned for the future of demand, especially in a post-pandemic world. So I would tell investors to be much more thoughtful about what you're owning and don't just buy the industry because it's beaten down.
Kate, always great to catch up with you. I love talking to you. Kate Moore of BlackRock. Kate, thank you. Thank you very much. And send our best to the team at BlackRock, please. Let's head back to the market desk and get you some movers. Here's Abigail.
John, well, we have two big laggards and leaders when we lift the surface. We go beneath the surface of the relatively bullish markets here on this Tuesday. Taking a look at Freddie Mac and Fannie Mae, we do have big losses. This as Treasury Secretary Steve Mnuchin has all but ruled out letting these companies be released from the U.S. government, deferring that to when President-elect Biden's administration comes on. That's a bit of a disappointment as investors are clearly selling these shares deeply. Bed Bath & Beyond, on the other hand, up 2%. This after they have sold their Cost Plus stores to a private equity firm, part of their plan to raise $500 million through divestitures. And then Inovio Pharmaceuticals is popping higher as they are developing antibodies for a COVID-19 treatment. But the big winner on the day, John, that of course is Apple. Shares popping higher on that unusually bullish report from Nikkei. Now, wow, look at that, up 3.8%, 3.9%. Nikkei saying that they are going to be boosting their phone production by 30%. Nikkei tends to be bearish toward them, so this is a bit unusual. And you see Qualcomm, one of their big chip suppliers, higher, along with many other of the suppliers. So that is a big tailwind for the stock market today, John.
Abigail, thank you. Coming up, markets anticipating fresh guidance from the Federal Reserve tomorrow, the final meeting of 2020. That conversation up next with Nuveen's Tony Rodriguez. For our audience worldwide, this is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
You're very welcome.
All they want to say is we're going to keep buying until we're confident that we're on the path to that outcome. So right now they're just saying we're buying assets over the coming months. To me, this is not a big change. I mean, I think this is more about aligning the language in the statement with where markets are already priced and with what Fed members are already saying. So I don't envision that this is any big change forthcoming from the Fed in terms of guidance.
Barclays economist Michael Gapin saying little to anticipate ahead of the Fed's meeting, with markets awaiting fresh guidance on the central bank's QE program. For more, let's bring in Michael McKee. Hey, Mike.
Good morning, John. Well, if it's up to the economy, the Fed doesn't have to do a whole lot. We did get some good news today. Industrial production rises 0.4 on the month for November. After having fallen 16.5% back in April, it's now only 5.5% below where it was before the pandemic. Manufacturing up double what was forecast, 0.8%, seventh consecutive monthly gain, most of that cars. I just want to mention the output of utilities declined 4.3%. Warmer than usual temperatures in the month of November. That's going to change tomorrow. John, sitting over in London, is not going to have to shovel like the rest of us. To get back to the Fed, the decision tomorrow is the event of the week. The question is, will no news be some news? We've seen the 10-year note yield bounce under 1%, trying to get through since it fell off in April. That hasn't happened. Investors questioning what it'll take to break through. On the one hand, you have a steeper yield curve, so does the Fed, if they're intent on holding down the rates, change its QE mix and buy more at the longer end? Or does a failure to break through 1% mean they don't have to? 77% of the economists we surveyed say the latter. The Fed will eventually increase the weighted average maturity of its portfolio, but not until sometime in 2021, which sets up for a possible move through 1% on Thursday, according to many in the markets. But does it stay there? No seems to be the feeling on the street. Weak economic data, worsening pandemic news, weighing on yields, plus the feeling the Fed, of course, could step in sometime in the near future, the next meeting January 27th. So here's the question, John, for your guys going forward. Does what happens tomorrow matter? Didn't sound like Michael Gapin cared a lot. If the Fed does adjust its balance sheet buying, they're going to have to adjust what they do on the trading desk. But if not, you take a look at corporate spreads, they're still very, very low. Borrowing costs haven't really changed. So the Fed doesn't really have to do anything.
They don't. But maybe they will, because they're worried about what happens if they don't.
Isn't it nice to have a we don't know? Some reason to tune in.
I guess. Tune in tomorrow with Michael McKee. No doubt he'll be left at the end to ask the tough questions for Chairman Powell to say Michael McKee and then run away at the end, which we've seen repeatedly over the last several months. Nuvin's Tony Rodriguez expecting new guidance but little action from the Fed. Tony joins us now on the phone. Tony, great to catch up with you, sir. What does that mean? Little guidance, little action from the Fed, new guidance. What do you mean by that, Tony?
Well, good morning, Jonathan. Good to be with you. What we mean by that is that we don't think the Fed is going to actually make a substantive change to their policies, meaning increase the amount of purchases, for example, or announce a lengthening of maturities. But we do think that they're going to continue to try to provide dovish commentary. So that could be in the context of increasing some of the, as they refer to it, qualitative outcome-based guidance. So they start to put a few metrics around what it will take to either increase the amount of purchases, lengthen maturities, or reduce those. Because at the end of the day, they're focused on two things, trying to average 2% inflation. They're missing on that target. And they're obviously focused on maximum employment. And they are clearly suffering currently a pretty big shortfall from that level. So we think they'll continue to try to promote the dovishness that they've been doing over the past few meetings, but that we won't see any concrete action.
Do you think we need some clarity on the asset purchase program, Tony?
You know, I think that there's enough uncertainty in the market as to whether they're going to remain committed to those purchases, for example, throughout 2021 into 2022. We saw this with the ECB meeting last weekend where they kind of extended the time frame for their purchases. So I think if they really want to ensure that the market has 100% confidence that they are not going to kind of withdraw their quantitative easing too early, I think that being the bigger risk from their perspective than that the market feels it may go too long, I think that's why they may try to provide a little bit more guidance to the market to ensure that there's no uncertainty that they may pull back prematurely.
Let's rattle through your calls. Steeper curve, weaker dollar, higher crude, higher equities, tighter spreads. Tony, that's a lot that's got to go right through 2021.
No, that's absolutely right. And our view is, and if you look at our Nuveen investment outlook for 21, we call it dark tunnel, bright light. And the reason being that we do think the next few months, call it through the first quarter of next year, maybe into the second quarter, is going to be the most difficult period. That's where we're going to have kind of the potentially weakest economic outcomes relative to the second half of the year. So when we're looking at it more of a medium-term horizon through 2021, we certainly have much greater confidence in all of those forecasts you mentioned. Now, we don't think it's going to be a dramatic drop in the dollar, for example, just continued modest weakening in the dollar. We don't think that higher equities means double-digit equity returns in 21, but we do think upper single digits. And we talk about credit, we think you will be able to earn the carry or the risk premium or spread that's embedded in the credit markets, but we certainly don't think we're going to see significant further spread tightening from here. So we think it's a market where you want to be exposed to risk assets, but at the same time, you need to calibrate your return expectations, that we're not talking about, record years out of the equity market or, upper single-digit returns out of fixed income assets. It's more modest returns, but certainly better than sitting in cash or sitting in very high-quality sovereign debt like U.S. Treasuries.
Tony, great to catch up. Send our best to the team and enjoy Christmas, won't you, sir?
Are out. However, there is some of that defensiveness up top. Tech leading the way up 1.2%. Materials, so there you have some of the reopening trade right behind it. Discretionary, utilities, financials. So there's a little bit more defense there. We have real estate on bottom. That, of course, is a cyclical trade. And over the last 5 days, John, most sectors are lower, led by some of those cyclical sectors, including real estate and the financials.
Abigail, thank you. Coming up on this program, your trading diary. 23 minutes into the session, equities up on the S&P by 0.7%. This is Bloomberg.
I'm David Weston, Bloomberg Television. Is reinventing one of the most iconic
25 minutes into the session, equities advancing. Let's get to your trading diary. What you need to be watching through this week. President-elect Joe Biden campaigning for Democrats in Atlanta this afternoon ahead of January's runoff election in Georgia. Then it's a busy Wednesday with U.S. retail sales, an FOMC rate decision and a news conference with Chairman Powell. On to Thursday, another round of jobless claims and a Bank of England rate decision. Then it is the BOJ rounding out the week with a rate decision of their own. A lot of central banks speak through the week. For our audience worldwide, this was the countdown to the open. Thank you for choosing Bloomberg TV. For our audience worldwide, you continue the conversation with me at Faro TV on Twitter with your equity market up about 0.7%. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Three p.m. in London, 10 a.m. in New York, 30 minutes into the trading day this Tuesday in the United States. From London, I'm Guy Johnson. My co-host in New York, Alex Steele. Welcome, everybody, to Bloomberg Markets. Alex, it's fascinating to watch what happens. Wall Street, Main Street continue just to live on different planets.
As that stimulus size gets shorter and shorter, whether or not Mitch McConnell said the right thing or not at the press conference yesterday, that number gets smaller. But let's check in here on the markets. I wanted to highlight what the Bank of America Fund Manager Survey said, because everyone loves watching that for an indicator of sentiment. And the takeaway was sell the vaccine in the first quarter. There's a lot, cash levels only at 4%. They say that's a sell signal, and there's a lot of optimism when it comes to, shocker, tech. Biotech index, interestingly enough, down by 0.5%, despite the fact the FDA staff gives a thumbs up to the Moderna vaccine. 10-year yield pretty much goes nowhere. Brent at a 9-month high. IEA has a pretty dismal outlook out. Nonetheless, you're seeing a stronger Brent market. Part of that is definitely going to be the better data we saw out of China, particularly that fixed asset investment. Let's get right to the story, though, and that's the vaccine here in the U.S. The U.S. Food and Drug Administration staff reports that says Moderna's vaccine is safe and effective for preventing COVID-19 in people ages 18 and older. This clears the way for a second shot to quickly gain emergency authorization in the U.S. Joining us now is Drew Armstrong, Bloomberg senior editor for healthcare. Drew, what did the staff say? How quickly can it be distributed? When do we get approval?
So the good news is that we have a report saying that we have another vaccine with, in this case, 94.1% effective at preventing symptomatic COVID-19 infection, which is just about the same as the Pfizer-BioNTech vaccine. And we're going to see the FDA's outside experts meet later this week and give their recommendation. And keep in mind that, FDA acted essentially a day later to give the emergency use authorization to Pfizer's shot. I think we can expect a relatively similar timeline for this one, barring any surprises, which from the FDA analysis that we've seen from the staff, it doesn't seem like there are going to be. After that, roll out the trucks, load up the planes. The government has said that they, in total, expect to about have 20 million people in the U.S. get their first shots by the end of this year.
Okay, and on that note, perfect timing, we're going to bring in our next guest, Drew Armstrong. Let's talk about backing up the trucks and rolling the planes. Dr. Stephen Corwin joins us now to give us his take. He is the president and CEO of the New York Presbyterian Hospital, one of the largest in the world, ranked number 4 nationwide. Dr. Corwin, this is a huge undertaking, rolling out the vaccine. You've got to start the process today. Can you give me a sense of the size and scale of what is about to happen?
Well, I think it's enormously complicated logistically. We're storing the Pfizer vaccine in -80-degree refrigerators, freezers, and making sure that we can prioritize all the healthcare workers as we start to ramp up in terms of the amount of doses that we're giving. So, as you might expect, emergency department workers and ICU workers are the first people getting the vaccine. We prioritized it. We need to make sure that we've got the right chain of custody, that we can make sure that we can get the people back for the second dose of the vaccine. But it's all good. I mean, the fact that we were able to get this vaccine developed in record time is nothing short of an extraordinary scientific accomplishment, as I'm sure you all know. Thanks, Guy.
100%. And we definitely look forward to that day. We do have to get, though, to herd immunity. In the meantime, cases are rising here in New York. How is hospitalization doing? What's the spare capacity? Cuomo's mentioning, and de Blasio, potential other lockdown. Walk me through what you're seeing on the ground.
Well, we're at about 25% of where our peak was last April, which was really horrific. The good news on that is that the mortality in hospital is substantially less. At the peak of the pandemic in April, we had about a 20% in-hospital mortality, which is just extraordinary and horrific. Now the mortality is closer to 5%, which is still terrible, but nowhere near as devastating as what we saw in April. That being said, we anticipate with this surge that we could get up to about 50% of where we were at the height of the pandemic, which puts a severe strain on hospital resources, which is why both the governor and the mayor have been making sure in an assiduous fashion that we don't overwhelm the hospital resources.
Do you think that will mean a lockdown? Do you think we'll ultimately get to that point? What do you think we should do over Christmas as well?
Well, I don't know about you, Guy, but over Christmas, I'm hoping to watch Chelsea win a few more football games. But in all seriousness, I think that we're still seeing the spike from Thanksgiving, and we're hopeful the people will be mindful of that over the Christmas holiday. I do think you'll see some more severe restrictions depending on how high the surge starts to get. But right now, when we model it out, the trend is not encouraging.
Do we need a lockdown right now?
I wouldn't lock the whole thing down, but I think that you're going to see further restrictions without question. And I think that that's going to impact people. Look, small businesses, restaurants, the travel industry have just been devastated by this. All the more important, I think, that these businesses get relief with whatever stimulus package can come out of Washington, and it can't come soon enough. We're going to have some dark days ahead of us over the next 6 to 8 weeks. We just can't avoid that. And it's going to take a while to get to herd immunity with the vaccine, as good as the news is on the vaccine, however. So I think that we're in for a rough 6 to 8 weeks, to be honest with you.
I'm really curious about how your staff are approaching the vaccine and whether or not they are, as a group, completely committed to taking it. Is there any hesitancy? This is still a relatively new drug. This is messenger RNA. This has never been used before, never been tried before. It's still not licensed. It's under emergency use. Are any of the doctors or any of the healthcare professionals that you employ saying, you know what, we can wait?
Yeah, I think that probably when we poll our employees, you're at about 70-30, 70% saying, yeah, I want to get the vaccine now. That's one, and 30% saying, gee, I'm really not sure. The communities of color have long been experimented upon, so they need to be convinced. We have to have a vigorous educational effort to make sure people understand the safety of the vaccine and the risk-benefit of the vaccine versus getting the disease itself. We're embarking upon that. I think it's important for the rest of the country to see that healthcare workers get the vaccine. And I'm talking about everybody from environmental service workers to registrars to doctors, nurses, et cetera. So we've got a lot of educating to do. People have to understand what the messenger RNA platform is, the reactogenicity of it, the lack of side effects, what the potential long-term side effects may or may not be. And we think that they're going to be negligible. Safety if you're pregnant, safety if you're breastfeeding a child. So these are things that we have to work through. But I really think that it's imperative for us to get the vast majority of Americans vaccinated so that we can come through this crisis.
Would you require your workers to get vaccinated before they come back to work, or as a condition of employment?
You know, we talked about that option. I would leave that option open, but right now I think it's persuasion and discussion and conversation, and we're doing that across the board. All of our senior leaders having discussions with that. I've told employees directly, look, if you want me to get it, to show that I'm not afraid of getting it, I'll do that. So we're in the beginning of that ramp up of the education. I'd much prefer to do that as opposed to mandating it as an employer, because I think we'll get a lot of pushback from it.
When are you going to get it?
Well, right now, I'm going to get it when I'm in line to get it, which probably would be sometime towards the end of January. But if the staff and the rest of the hospital staff feel they want to see me get it to encourage them to get it, I'd be more than happy to get it earlier than that. I'm not of the view that the vaccine is dangerous. I think it's safe. I think it's effective. I think it's necessary. And I'll get it to show leadership as soon as people think that they need to see that. Right now, we have more demand for the vaccine than we have supply, so it wouldn't be necessary for me to get it. But if people want to have that reassurance that the CEO of the hospital got it, I'm game to do it as soon as people think that it's necessary.
Talk to me about the dual dynamics right now for you of distributing vaccination to the workers, still dealing with rising case counts, and there's still, surgeries are still going on, et cetera. And then there's sort of the after effects of the shot. Can we tackle the virus today in addition to distributing the vaccine? What are some of the issues or struggle points that you've noticed?
Well, there are a couple of things. First, I have to tell you that in terms of people reliving what we went through in March and April, it's very encouraging for them to see that there's a light at the end of the tunnel in terms of the vaccine. Because people, I think that you've seen it on various news outlets, your own, how horrific this has been and the toll that it takes on the staff. Having a dying patient only be able to FaceTime with their relative, things of that nature. So it's encouraging when I speak to our staff that they see the light is at the end of the tunnel with the vaccine. That being said, people can have mild effects from the vaccine. They may have some mild fever. They may have body aches that may keep them out of work for a day. So we're very careful about, for example, if you're vaccinating an entire emergency department, we want to be careful that we don't do the entire emergency department in one day for the very issue that you mentioned in terms of staffing. So logistically, we've got to be very careful about how we do it.
Dr. Corwin, Alex kicked the show off talking about the stimulus money that potentially could be coming out of Washington. Clearly, this has been a year that you as a hospital have faced severe financial stress. Can you just give me an idea of whether or not you're getting the kind of support you feel you need on the financial front as well?
Well, I think we could use more. We're a hospital that traditionally, on $9 billion of revenue, operated at about a 3 to 4% margin. On that $9 billion worth of revenue, even with the CARES Act, we will lose $800 million this year. Wow. And that's a consequence of the pandemic. There are a lot of businesses that are hurting out there, and they need help. Hospitals need more help. And quite frankly, state and local governments need help, because if our state doesn't get help, then the first thing that's going to be cut is the Medicaid budget, and that will further hamper our ability to recover from COVID. So I'd like Congress to, in a bipartisan way, to get their act together and to pass more relief. And when I see the struggling businesses in New York, the small businesses, they really need help now.
Yeah, no, 100%. Doctor, it was so great to talk to you. We'd love to catch up with you soon again. Best of luck, Dr. Stephen Corwin, New York Presbyterian President and CEO. All right, coming up, how all of this is affecting the stock market and pricing in a vaccine. Kim Coffey-Forrest, Boca Capital Partners founder and CIO, will be joining us next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I feel really lucky, having stared into what felt like an abyss for travel, and then to kind of rally together with thousands of people and rebuild the company from the ground up. Something that I think is stronger than it ever was before the pandemic.
Awesome. Some breaking news for you. You have Mitch McConnell on the Senate floor saying that the U.S. officially has a president-elect. This comes after yesterday when the Electoral College finally voted and declared, in essence, Joe Biden the winner. He says he wants to congratulate President-elect Biden, says there officially has a president-elect. He also goes on to say that Trump deserves our thanks through all of that. So it feels like it's sort of official now, Guy, when you have the House, the Senate leader acknowledging and saying those words, it's going to be really hard to backtrack that if you're a Republican in the party.
Yep, it's real now. We can move forward. We can figure out what comes next. Certainly, that is something that I think is really important for America right now. The other thing that is important as well, we've already talked about it in this program, is what is happening with the vaccines, I should say. Moderna shares giving up some of their gains that they delivered a little bit earlier on, despite what now looks like certain FDA backing for their vaccine. Overall, there's been a huge surge in biotech names looking to combat the pandemic. Does this continue to have legs? Joining us now with the details, Abigail Doolittle.
Guy, well, setting the stage for those biotech stocks, let's take a look at the virus itself, because the numbers are not moving in the right direction, especially here in the U.S., leading the pack. These are the most developed economies, the number of cases per million, and we see the U.S., again, leading more than 50,000 people per million people having the virus here in the U.S., so the numbers are surging. Not surprisingly, because the biotech companies are the companies developing the therapies for the virus, those stocks are outperforming the broader stock market. Take a look at the biotech ETF shares along with the actual NASDAQ biotech index. Biotech ETF up about 50% this year relative to the S&P 500, up far more modestly. So investors clearly going into these stocks. As for the vaccine itself, lots of ordering here by the U.S. This is actually the vaccine velocity here. We have Moderna here. Extraordinary on the year, up more than 600%. And of course, today, the positive news that the FDA has found that their vaccine to be both safe and effective. And then finally, vaccine makers on the year. Here we have the orders for the U.S. Lots of orders here. Many of these vaccines, Alex, of course, still have to be authorized by the FDA, but a move in the right direction, Alex.
No doubt. All right, Bloomberg's Abigail Doolittle, thank you very much. Let's get the market reaction from Pittsburgh. Kim Coffey Forrest, Boca Capital Partners and founder and CIO, joins us now. Kim, that's just a way of talking about the rally that we've seen in these biotech stocks. Bank of America fund manager survey, they do it every month. They show the positioning. They say, overall, you want to sell the vaccine, basically sell the vaccine rally. In biotech specifically, do you agree?
I really do. And that's because, the discovery is what drives investment in biotechs, because as we know, they partner with a third party to distribute it and they get some money from that. But really, this is kind of I hate to say this, lottery ticket approach to investing. The science is very exciting and new, but a lot of times you don't know if they're going to get to the finish line with the product, if it's going to meet, the scientific standards. And when it does, that's when you want to sell that biotech and not wait for it to get out on the market.
What about Big Pharma, Kim?
Big Pharma is kind of scary to me for a lot of reasons. They've been using biotechs as their farm team, we'll say, if we use a sports analogy, where they, seed a lot of money, see what the science is doing out in biotech land, and then, reap the rewards. But here's the problem with pharma in general. Most of the money it gets is from Medicare, and Medicare reimburses or has certain rates that it will reimburse with. With this big slug of baby boomers moving through our healthcare system, and most of that is paid for by the government, I would say that probably reimbursement rates aren't going to be going up. I would say they're flat to down. And that's kind of my cautionary tale for people who are looking at pharma going, ooh, look at that big flush of people that are going to use these products. That's great. But it is the reimbursement rate that affects profitability.
Yeah,
and profitability is what Wall Street wants.
Yeah, and also just in terms of, the vaccine, for example, some of them aren't even going to make a profit. Okay,
Right.
So let's take that lens and look at large cap technology stocks. In this fund manager survey, it was sort of a huge long-term long into long tech. There we go. I found it. Their number one call was 52% were long tech. What do you do?
Sure. I'm all in on tech, and it's something I've talked about for years, and it comes out of what I did first as a professional, which is software engineer. So technology is the only way that people can be more productive, and businesses have been spending more and more over the decades on technology. I think it's a no-brainer for big tech. It's just what they do and what the value is. And I think that is what investors really have to concentrate on, is what value does a technology bring to the end user? It's key in whether or not it's a successful technology investment.
Kim, the European Union and the UK today have both announced big regulatory changes in the way that they're going to approach big tech. If we see a similar thing in the United States, and maybe that's going to hang on what happens in Georgia, what is the story and how different is it from an investment point of view around these companies?
Well, for the very largest companies, and we'll talk about the top five, right? FANG and Microsoft. I think more social media might be affected in the long run, but in the short run, probably not so much. Remember that although they, count on users don't pay them anything. Advertisers do, and advertisers go to where the eyeballs are. So that is why social media has been able to rake in dollars, because it's marrying advertisers and people that are going to buy their products. So for the short term, I don't think it's going to affect the companies. For the longer term, it may. If they have to break up, if they can't use their
Indeed, Kim Corky-Forrest of Boca. We can't predict the outcome and timing of these various probes. We'll continue to monitor this story, but as I say, the share's getting pretty dinged earlier on in the session after the Dargan's Industry report. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from London, I'm Guy Johnson. Alex Steele, of course, over in New York. This is Bloomberg Markets. So, Alex, the EU unveiling 2 new pieces of tech regulation, basically overhauling the digital markets. America's tech giants firmly in the firing line here, and they could face heavy fines. The regulations could become some of the strictest in the world. Basically, you've got 2 pieces of legislation here potentially going through: a Digital Markets Act, which is aimed at kind of unfair competition, and a Digital Services Act, which is basically about illegal behavior on these platforms. And the fines could be absolutely enormous, 10% of revenue. And if you get hit with 3 fines in 5 years, there is the risk of breakup, Alex.
Well, and it's not just the EU. The EU is taking a stricter line in some respects, but the FTC is going after a few companies here, and they're giving them like 45 days to hand over information of how they collect data. Twitter just got fined about $547,000 by the EU. You also have that antitrust investigation lawsuit, I should say, against Facebook that could result in a breakup and kind of rollback breakup. So it's on all fronts. But the markets just don't seem to care. That's amazing to me, as Twitter is up by about 1%, for example.
Well, the belief seems to be that these companies are so big that they don't need to care, that they can continue to do basically what they want. And that seems to be where regulators are starting to get frustrated, that fines are not delivering the outcomes that they're looking for. And as a result of which, they're changing the way that they're approaching this rather than getting bogged down in long-term cases. They're completely changing their approach. We're going to hear from Vestager, Commissioner Vestager, hopefully in the next hour. This is Bloomberg.
For retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
Not only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Live from New York, I'm Alex Steele with Guy Johnson in London. This is Bloomberg Markets. Senior Senate Democrat Dick Durbin said that Congress should vote on a bipartisan COVID-19 relief bill that's just the consensus provisions. This excludes the two most controversial elements, liability protection and aid for state and local governments. As we inch closer to a smaller deal, well, joining us now, Anna Egerton, who helps lead Bloomberg's coverage of U.S. Congress. What's the reality of what can get passed and be put to a vote? What's the timeline, Anna?
It really depends on congressional leaders at this point. We're really waiting to see what Mitch McConnell and Nancy Pelosi can do. You know, it was really interesting to see the strategy from this bipartisan group of splitting off those two more controversial provisions, because it was kind of a recognition that those aren't going to get resolved by the end of the week. And that's really when this needs to be done. In fact, we actually need the legislative text, you know, maybe by the end of today, if it's going to get through both chambers of Congress and signed into law by Friday.
Anna, thanks very much indeed. Anna Egerton updating us on the latest. Let's get some perspective on all of this. Joining us now, Rick Davis of Stone Court Capital, and of course a Bloomberg contributor, as we well know. Are we going to get a vote? Are we, as leadership, actually going to allow this to get done? Because the calls for a vote are growing louder and louder, and that's all I heard last night. The question is McConnell going to go for it?
Yeah, obviously the pandemic, coronavirus is dominating every headline today. And I think there is this momentum demand in Congress for action. But also, McConnell looks like he's going to get what he wants, which is a slimmed down version of Nancy Pelosi's original $2 trillion plus bill. So if he declares victory, this thing will usher its way through the Congress pretty quickly over the next couple of days. And I'm sure it gets signed by the president, first thing before Christmas. So there's a lot of demand in the country for this. There seems to be momentum in Congress. They've pared down this piece of legislation in a bipartisan fashion. So I think everybody's on the hot seat to get this done.
To get what done? Like, what are we going to be talking about? Is it going to be $500 billion? Is it $700 billion? It's just staggering to me because it was on the table, was $1.8 trillion before the election.
That's right, and Pelosi's original bill was over $2 trillion. So I think that this is definitely, quote, skinny legislation, as Majority Leader McConnell likes to call it, and it's just a Band-Aid. There's no question that the very first thing this Congress will pick up, the next Congress will pick up when they come to town in January, is a stimulus bill that actually helps the economy. This is just paying bills. Covering costs of the pandemic for many of the industries that are supporting the cures. And so this is not a stimulus bill. It is not going to go toward trying to put the country's economics on the right track. And so that business looks like it's going to be held over for the next Congress. And we'll see, based on the outcome of the Georgia elections coming up in the first week of January, who's in charge of that Congress.
What's your read on that? Because it's going to be really critical for the financial markets.
It is, and it's quite a toss-up. I mean, in both elections, we have two Senate seats up all at the same time in a runoff situation. And in both elections, it's within the margin of error. I would say the demographics favor the Republicans, and the politics right now today with Joe Biden coming on board as the new president seem to favor the Democrats. I would say voting started yesterday, and the in-person voting set a record. Even more in-person voting yesterday than the first day of voting for the general election, which for a runoff is unheard of. And so the one thing we know, that the Trump era has seen record turnouts, and if there's a record turnout here, that may actually inure to the benefit of the Democrats.
The other thing that sort of changed over the last few minutes is that Senate Majority Leader Mitch McConnell spoke about the next presidency. Here's what he had to say on the Senate floor, Rick.
As of this morning, our country has officially a president-elect and a vice president-elect. So today I want to congratulate President-elect Joe Biden. The president-elect is no stranger to the Senate. He's devoted himself to public service for many years.
So, Rick, that's obviously monumental moving forward as a country. Does that hurt or help the Republicans in Georgia?
It actually may help them. Right now, there's been a lot of confusion. Donald Trump took a visit down there about a week ago and said he was going to dispute the elections and even ran against the entire statewide elected Republican leadership. Virtually every statewide elected office is held by Republicans who Donald Trump spent an hour and a half deriding. So this puts it back on an even keel. It declares the obvious. I can imagine that there'll be a lot of communication between McConnell and President-elect Biden. They've got a very positive history, and we will see how that's going to shape this election. But calming the political waters on a national level, let's Georgia be Georgia. And I think McConnell believes that if Georgia is, if it's a local election and not nationalized, it'll be better for Republicans.
Just to circle back, if, as you say, the Republicans are at this stage probably likely to hold Georgia, and that looks like the most likely outcome from a demographic point of view, have the last few days in terms of leadership in Congress being just simply unable to get on the same page, is that what we're in for the next 4 years? Or is there going to be somewhat of a reset here? It was interesting to hear McConnell talk about the fact that President-elect Joe Biden is no stranger to the Senate. Obviously, he's dedicated huge amounts of time there. Can we see any olive branches here?
Well, I think you see one now in this debate around the stimulus package. I mean, this comes from a gang of 6, 3 Republicans, 3 Democrats, who got together and said we have to bust this impasse in the Senate. So I think you'll see that regardless of the outcome of the Georgia election, it's going to be close in the Senate. And what will happen is you'll see these coalitions. In the past, we refer to them as gangs, but it's like-minded Republicans and Democrats getting together to actually, in a minority situation, right, a small group of people can control the outcome of the entire Senate. I think that will become the norm in the future. And so it actually gives a lot of power informally to individual senators who actually want to get things done.
So help me understand then what could realistically be on the table. Does Nancy Pelosi get reelected House Speaker? How does that then affect things like an actual stimulus, not just like the bridge gap until we all have herd immunity? And other things like tech regulation. We're getting new rules on EU tech, for example. What are the realistic things? What are the pipe dreams?
Yeah, I think obviously with a 10-vote margin, maybe a little bit more when all these other House elections are finally decided, she'll get a narrow victory as Speaker. And so she won't be managing the House of Representatives with a big mandate, but she'll have the majority of the House on her side. So she will aim big. We know what her appetite is for stimulus. It's go big or go home. And so we can see that materializing. She will have a friend in the Treasury Department rather than a rival in the new Biden administration. And so you can imagine that will be a lot of momentum going into the United States Senate. Mitch McConnell will have his hands full on dealing with spending issues. He'll want to go small. And yet he's got 1 or 2 vote margin where, as we see happening right now, a group of Republicans get together with a group of Democrats and, anything can happen and he loses control of that process. So I think that it will be much more of a jump ball in regards to the control in the United States Senate by Mitch McConnell. He'll have to use every ounce of his skill to manage the situation there. But the reality is that there is going to be momentum on the side of the Biden administration, and they'll likely get what they want, at least for the first 100 days.
How big is the spread between stimulus if Georgia goes to the Republicans, and how big is the other side if it were to go to the Democrats? What's the difference between those two numbers, do you think?
Well, look at the trading range now. It's $1.5 trillion difference between the bid and the ask in the House and the Senate. So there's a lot of cushion there to play with. But I think you'll see many more programs that go to the states. That's clearly on the board for future stimulus to try and shore up their balance sheets. I think you'll see more support going directly to unemployed. The unemployed supplemental insurance will be doubled at this stage compared to what it has been, or at least is in this current discussion. And so I think you'll see a lot of difference in the approach when you see a bill come out of the House with the support of the White House. That then puts the onus on Mitch McConnell and Republicans if they're in the majority. If they lose these 2 seats, you can expect a $2 trillion stimulus package making its way through both House and the Senate and being on the desk of the president to sign very shortly after swearing in.
It really does feel like that risk not yet priced necessarily into the market. Rick, it's really good to catch up with you. Happy holidays. Bloomberg contributor joining us there, Rick Davis. Guy?
We've been talking about it throughout the morning, Alex. Let's get confirmation now. The EU laying out its new pieces of tech regulation, 2 pieces of tech regulation. Basically, platforms are going to need to remove illegal content under EU rules. They're going to have to be banned as well from unfair practices, heavy fines, breakups. All of these things are on the cards. There is a news conference, a virtual news conference underway in Brussels. At the end of that, we are hoping to speak to Commissioner Vestager. Really looking forward to that conversation to see what she has to say in terms of the approach that the EU is now going to be taking on this. A complete shift, a complete update in the way that it is approaching big tech. We're also going to be talking about Boeing as well, the company widening inspections for its 787 Dreamliner planes. It's about the way that the barrels fit together. Remember, this is a composite aircraft. We'll talk about that in a moment as well. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
With a new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
Let's check in on the Bloomberg First Word News. I'm Emma Chandra. The Food and Drug Administration says Moderna's coronavirus vaccine is safe and effective. The agency released briefing documents today on the shot. Next up for the Moderna vaccine, an FDA advisory panel will look at the data later this week. A recommendation could lead to the vaccine being approved for use in the US. The City of London could face the toughest coronavirus restrictions as early as tomorrow. Infections have spread out of control and hospitalizations are rising. Under the so-called Tier 3 limits, pubs, bars, restaurants and indoor entertainment venues would be forced to close. Vladimir Putin has become among the last world leaders to congratulate Joe Biden. The Russian president sent Biden a telegram after the Electoral College formalized his victory. Putin wrote that he was, quote, ready for cooperation and contacts with you. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg.
Emma, thank you very much indeed. So Boeing is widening its inspections of newly built 787 Dreamliners. The company is looking to find any additional manufacturing defects that could prematurely age its carbon fibre frames, the barrels. For more on this, let's bring in Brooke Sutherland of Bloomberg Opinion. Brooke, these are composite aircraft. They are manufactured in a completely different way. The composite barrels have always been a kind of source for concern for the industry, just to see how they age. Can you just give me a sense of what is happening here in terms of what is going on with the manufacturing process and how serious this could be?
So it's parts in the carbon composite fuselage that aren't quite as smooth as they're supposed to be under FAA guidelines. There's little wrinkles happening there, and this could potentially be an issue for the plane in flight. Now, neither Boeing nor the FAA views this as an immediate safety issue, but they are, as you said, widening inspections of 787 Dreamliners before they go out to customers. Now, this process is delaying Boeing's typical delivery schedule. This is one reason why it delivered no Dreamliners in the month of November. CFO Greg Smith was speaking at an industry conference a few weeks ago and indicated that deliveries will remain slow in December as well. And, you know, just to take a step back, it just sort of adds to overall questions about Boeing's reputation for quality and if that's really what it once was. I mean, given everything that's happened with the 737 MAX, this is, of course, not the first headache to come with the 787 Dreamliner. I just think you have to wonder if these planes are, you know, as great as they've been billed to be from Boeing's perspective.
Well, Brooke, help me understand, like, the normal stuff that happens with airplanes. Like, there's going to be stuff that needs to be fixed or tweaked or equipment that's not perfect. What's that versus what's, like, a real issue for Boeing and sort of a consistent flaw?
Right. And I mean, we should say this is not, you know, of the caliber of the issues with the 737 MAX that caused that 20-month grounding. So this is in a different category. These issues do crop up with airplanes. Also, I would point out with engines. You know, United Technologies' GTF engine had a number of growing pains, shall we call it, once it was actually put onto aircraft. And so this does happen. It is normal. But I will say, you know, there's more of a spotlight on Boeing right now because of everything that this company has been through. And for me, it's more the cumulative nature of these issues that keep cropping up on its airplanes. And I think, you know, until Boeing can sort of reassert its reputation for quality, there's going to be a harsher look at these issues when they do come up.
Is it also the case that this being new technology, relatively new technology, that the regulators take a closer look at what happens? This isn't building an airframe out of aluminium. This is an airframe that is a carbon fiber composite. And I do wonder whether or not the extra scrutiny is probably a part and parcel of this as a result of it being new tech.
I mean, I think it is, but they also have been producing the 787 Dreamliner for a while now. So it's new, but it's not that new. But I do think, you know, to your point, the FAA's reputation is also on the line here, and they're expected to take a much tougher look at any airplanes. You know, with the 737 MAX, they're actually doing the final inspection themselves before that plane is handed over to the actual buyers. And so, look, I think the FAA wants to be seen as, you know, taking a very close look at any type of issues that come up with any airplanes, and that's obviously what they're doing here. But as we said, it's not an immediate safety issue, and it is hopefully something that Boeing can figure out over the next couple of months.
Boeing's starting to lay out what's happening in terms of the rollout of the 737 and how many it can start to deliver next year. How fast can it clear the lot?
I think that's the big question, and I think the answer really depends on when you think international travel is going to come back. Certainly, most experts in the industry say they expect narrow-body planes to come back first. Those are planes used on shorter haul travel, more regional travel. The 787 Dreamliner is predominantly used for international long-haul flights, and I do think that's going to be the market that comes back last. I mean, I just don't know if you're going to see, a huge rush to international travel, not least of all because of the coronavirus cases and restrictions, but just from an economical point of view. I mean, even with all of the discounts that I imagine will be offered by the airlines, those are still some of the more expensive flights, and a lot of those flights are taken by business customers. So, I do think that that's going to be an issue for Boeing going forward. They did actually reduce their 787 production rate recently yet again, and that's to reflect some of the weaker passenger traffic numbers and some of the question marks around demand.
Brooke, it's always a pleasure to catch up. I feel like if you and Guy were at a bar together, there would be so much conversation about planes. It would be intense. Brooke Sutherland of Bloomberg Opinion, thank you very much. All right, coming up, from his nerd to my nerd, talking about oil up by over 1.5% in the U.S., despite the fact the IEA sees a lasting glut. We'll break it down. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I think we have a lot to be optimistic about in this country, but in the near term, even with these vaccines, Moderna and Pfizer, we just got to allow them to be given to the people who need them the most, but that's going to take more than 6 months.
If we get a combination, for example, of further significant downgrades in demand because of the COVID-19 crisis is prolonged, and at the same time a breakdown of producer discipline on the side of the OPEC plus producers. But so far, that actually hasn't happened. Compliance with their agreement has actually been pretty good. There is not much headroom for them to supply more oil than they currently anticipate into the market.
That was Neil Atkinson of the International Energy Agency, head of oil industry and markets, speaking to Bloomberg earlier today. So for today's Futures in Focus, we're going to look at oil. Joining us now, Julian Lee, Bloomberg oil strategist. Julian, that was the supply conversation that Neil was talking about, but the demand was pretty grim. I mean, they cut demand yet again. They said the market is going to be fragile, yet oil rallied. Why?
Well, I think there is, there's a lot of pent-up optimism over vaccines. I think, we've had traders who, perhaps for 9 months have been looking for any sign of good news that they can see. We're certainly seeing much more strength in Asia and some of the other developing countries than we are in either the United States or Europe, where the vaccine is starting to be rolled out, but the virus is far from beaten. You know, we're looking at tougher lockdowns in London, tough lockdowns in parts of the US. But I think that, you know, the market is looking forwards. But I have to agree with Neil Atkinson. The outlook for demand looks fragile.
The market is a discounting mechanism, though, isn't it, Julian? And that's the kind of the mismatch we have between now and 6 months down the road. You see it in stocks, you see it with so many assets at the moment. Any selling is met by buying because people have a different time frame to the here and now.
Yeah, absolutely. And I mean, the oil market is certainly looking ahead. It's looking to that point in time, somewhere perhaps towards the end of the first half of next year, when the vaccines have been rolled out sufficiently that in a large enough proportion of populations have been inoculated against the COVID-19, and demand starts to get back to normal. We're already seeing that the demand for truck fuels is high. People have stopped going out to shops, but they haven't stopped shopping. So we're seeing demand there is strong. We're seeing demand for petrochemicals is probably fairly strong. The areas that are still being hit are certainly aviation fuel and to some extent gasoline, which is very much the fuel of private automobiles. But I think we can't lose sight of the fact that the extent to which this market is still very fragile.
Julian, always appreciate your input. Thank you very much indeed. Bloomberg's Julian Lee. Up next, we're going to talk tech regulation. Commissioner Vestager is going to be joining us. This is Bloomberg.
we explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Live from London, I'm Guy Johnson. Alex Steele is over in New York. We're now counting you down to the European close here on Bloomberg Markets. So what do you need to know from Europe this hour, Alex? Well, the EU warning that it may break up big tech. The threat comes as Brussels publishes drafts of 2 pieces of tech regulation. Commissioner Vestager, we hope, will be joining us very, very shortly. SEB, Swedbank and Danske see their shares dive on reports that they're being investigated by the FBI and 2 other US federal agencies. Within the last hour, though, the banks have started to push back. SEB saying the report is, quote, old news. And the European Commission president says it's likely that the first Europeans will be vaccinated by year end. This is Ursula von der Leyen faces criticism for the region's slow approval process. Let's talk about the markets. Let's show you where we are. Over the last 10 days, to be honest, European equities have just gone sideways. Today is another example of that. 392, we're up by 0.2%. The pound continues to be bid. The mood music continues to be more upbeat when it comes to Brexit, 133.94. The FTSE 100, the kind of flip side of that, the mirror of what is happening here, trading down by 0.3%, continues to be, according to the Bank of America Fund Managers Survey, the biggest underweight out there. The FTSE 100 UK stocks continue to be under pressure. And we are continuing to watch what happens with what the bond markets on both sides of the Atlantic are doing. It is the Fed tomorrow. It is really going to be critical, both in terms of the Treasury market and the bond market, what happens here. We're negative 61 on a German 10-year at the moment. We've dealt with the ECB. The Fed is next, and it's going to be a massive moment, I think, tomorrow when we hear what it has to say, Alex.
Yeah, and what happens if we do get stimulus? Do we see 10-year yields at 1%? Does the Fed have to say more things? That'll be interesting as well. Well, let's stay focused on the virus. The U.S. Food and Drug Administration's staff report says Moderna's vaccine is safe and effective for preventing COVID-19 in people ages 18 and older. The report was posted online ahead of Thursday's meeting of the agency's advisors who will vote on the emergency authorization. Joining us now, Sam Fazeli, Bloomberg Intelligence Senior Pharmaceutical Analyst and Director of Research for EMEA. Sam, that was no surprise. Where's Europe right now? What's their process that they have to get to?
Hi. So that is not a surprise. You're absolutely right. But we were all very keen to see the details in the FDA's analysis, and there are some interesting angles that are worth looking at. But the Europeans seem to be taking their time. I'm not quite sure what is going on, because obviously now the UK, Canada, US, Bahrain, and I'm pretty sure some other places have already approved the vaccine. So, but the talk is 21st of December, but if not, it will be 29th of December. So they might be wanting to vaccinate somebody to meet the pledge that I just heard about on the just before the literally New Year's Eve.
The thing about the Europeans, or the EU to be more accurate, Sam, is that the process is different. Emergency use I'm telling you already know this. And I'm wondering why we are finding ourselves with this problem. Basically, emergency use authorization over in the United States, it's not a licensed product, but you can use it. In Europe, the way that it's done is that it effectively becomes a licensed product, and there is liability for the manufacturers. Has Europe basically spent too much time kind of dotting I's and crossing T's? Is this process too slow and too onerous in a fast-moving situation like a pandemic?
Yeah, well, I mean, let's not beat them up too much, the European Union, as you rightly say, because at the end of the day, we're talking, if this is the 17th when the Moderna vaccine gets reviewed, the 21st is only 4 days later. I mean, these are in the grand scheme of things, these are not massive timeframes. But of course, if you're somebody suffering from the disease or somebody who has suffered from the disease in your family, you want these things yesterday. But in the grand scheme of things, getting the vaccine sorted out, I mean, at this late stage in the year, I think really the difference is quite minimal. But it is a longer-winded process. We've always known that, and it's something that the European Union needs to think about. Is there
is there a way they can shave some of the bureaucracy out of the system?
So before we let you go, what did we learn from the FDA staff report on Moderna, and then how that's going to highlight what's happening over in Europe? But what were some interesting tidbits you pulled out?
Tidbits, safety, tolerability, let's put it that way. Safety, I think, is the wrong phrase to use here. Tolerability is a little worse than the Pfizer vaccine, but frankly, you won't have a choice. So I don't care. I'll take either of them. And then you've got this Bell's palsy thing that's just kind of rearing its ugly head again a little bit. These are all mostly side effects which only 3 patients had in the vaccine group versus 1 in the placebo. They do resolve, but it's something that I think the FDA is now saying we need to survey. And then the efficacy-wise, it's pretty much as good as the Pfizer vaccine. I mean, you could say maybe it doesn't work as well in the elderly, but these are small numbers of cases, so I'm not going to go there. These are very effective vaccines.
Sam, always a pleasure. Thank you for updating us and educating us on what is happening here. Sam Fazeli of Bloomberg Intelligence. Joining us now to get a market perspective on all of this, Karen Wars, JP Morgan Asset Management, EMEA Chief Market Strategist. Karen, there is a lot of good news in the markets. Every survey I read of market sentiment, everybody's incredibly bulled up. You've got what's happening in the States. We've got a government coming in. Joe Biden's going to be the president. We had that confirmed today. We've got vaccines that are coming through. There's still stimulus coming from the ECB, possibly still from the Fed as well. There's a lot of good news in there. My question is, what keeps asset prices moving higher or even staying where they are right now? How confident are you that that's going to happen?
Well, I think you have to remember there's a lot going on under the bonnet, guys. So if you look, for example, at the COVID losers, the sectors who were really badly hit by the pandemic, so the energy stocks, airlines, hotels, and they've certainly bounced since we heard about the vaccine news, but they're still well down on where they were at the start of the year. So I think when you start to pick through the detail and step away from particularly the S&P and the NASDAQ, which are really looking so resilient based on the fact that they've got a very heavy tech weighting, then actually I think that sort of colours the picture slightly differently, that there is perhaps investors are a little bit more circumspect about the ongoing difficulties of the pandemic. So I think that's one point I would make. But I think you're absolutely right to highlight that one of the reasons that people are optimistic is not just the vaccine, but it is an assumption that in the interim, to the point where we get to the widespread use of the vaccine and us truly getting back to normal, we're going to see the type of policy stimulus that we've already seen back in the spring to create this bridge from one side of COVID to the other. So I think that's the thing we've really got to keep our eye on. We've got to be sure that we're getting in Europe furlough schemes extended right to probably mid next year. I think that's where they're going to be required to. We need that fiscal stimulus package to come through in quick time in the US, because let's be honest, the trajectory there on the virus is really not looking good at all, and they're going to need some restrictions. So I think that's the key thing I've got my eye on to think about whether there's a little bit too much optimism priced.
So based on that, Karen, if you take into account central banks, which we'll get to later, as well as stimulus from whatever government you're talking about, what country is going to be able to close their output gap first?
Well, I mean, we're most excited about North Asia. I think, not just China, but some of the surrounding countries really did manage to put the pandemic behind in the spring, and, have been sort of fascinated by how they did this. I think it's partly their internal controls, an extraordinarily effective test and trace system. But of course, they've had massive external border controls. So basically, they drove it out and then they've kept it out. And I think it's the external border that's really, been so effective. But you look at where they are then in terms of level of activity, and China's back to its pre-crisis level. It's actually above. It's almost back to pre-crisis trend. So I think that part of the world is clearly looking furthest ahead in terms of overcoming this. Then I would think that we're probably going to be looking at Europe and the US. I mean, it kind of depends on as you were just discussing, the speed with which authorities are going to be able to approve, roll out, and vaccinate populations. I would imagine it's going to be a fairly similar timescale, really, for Europe and the US. And then I think for the broader emerging market community, again, it's really that question of how quickly those vaccines can get rolled out, whether the cheaper options on the market, such as the AstraZeneca one, comes to fruition, because that's really when you'd be looking at a much broader EM rollout. So that's our kind of preference in terms of at least the macro.
The current market premise is based on low inflation that's not going to cause central banks to have some sort of policy reaction. I read your notes coming into this, and you talked about one of the risks for next year being inflation. And I'm wondering what kind of inflation we're talking about here. How high could inflation get, and would it be high enough to, for instance, trigger some kind of Fed reaction? The Fed's basically said it's going to look through inflation for a while, but could we get inflation that actually forces it to change its approach?
Yeah, I mean, it's the thing that keeps me up, Guy. But as I've said, I think the foundations on which the market's optimism is built is on the back of the central bank backstopping this whole system. That comes into question if inflation does show up. But as you say, the Fed have effectively said, we would welcome a little bit extra, a modest amount, I think was Jerome Powell's exact words, but certainly inflation moving back above 2 is something they've set themselves up for. So I think, Guy, it's more about it moving in an unexpected fashion. So if it drifts up slowly, gradually, and it will in the Q1 as the base effects turn, it will move above 2. But as long as it's predictable and it's moving in line with everyone, the Fed and consensus expectations, I don't think that's going to rattle the market. I think the Fed will look through it. I think the problems will come if it's unexpected, if instead of 0.2 on the month, it's suddenly 0.3 month after month, and we're looking at it moving north of 2.5, perhaps towards 3. I think at that point, the whole narrative of tolerance starts to come into question. So unexpected is the key word there.
That feeds into the earnings conversation. It feels like consensus is obviously earnings are going to be pretty good in 2021. Are they going to be good enough to justify the optimism in the market and the price to earnings ratio in the market based on an inflation creep?
Well, I mean, I think it really comes back down to having to go under the bonnet, because again, the dispersion between what is expected for earnings for the relative losers versus the relative winners, which of course the sort of tech, e-commerce, anything that's allowed, facilitated this new life at home that we're all existing in. There is this massive dispersion between the earnings outlook, and that in turn is driving prices. So I do think that's one of the key points that we need to get across here is looking at the aggregate, whether that's the S&P, whether that's the PE ratio or the total earnings. I do think you miss a lot of the nuance about what's really expected. And actually that in certain sectors, there's still quite a lot of pessimism. I mean, energy is a very good example. If you look at expectations for earnings for the energy sector, they're really not factoring in that buoyant global recovery. So I'm not too concerned that there's too much optimism built into earnings when I do that sort of bottom-up analysis.
All right, Karen, you're going to be sticking with us. Karen Ward of JP Morgan Asset Management staying with us. We're also watching what's happening with big tech over in Europe as well. The latest during the press conference here is Margaret Vestager is saying that digital rules could be final in mid-2022. This is all on top of things like tech platforms need to remove illegal content. They're banned from unfair practices if you're a gatekeeper platform. We'll keep you updated on all those headlines as they cross. In the meantime, the NASDAQ is rolling over here in the U.S. We will be speaking with European Commission Executive Vice President Margaret Vestager later on in this hour, so stay tuned with us for that. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Live from New York, I'm Alex Steele with Guy Johnson in London. This is the European Close on Bloomberg Markets. We were just talking about China, the recovery gathering pace in November, industrial output and retail sales strengthening, reinforcing those expectations of healthy growth in 2021. Michael McKee, Bloomberg International Economics and Policy Correspondent, has been digging into some of those numbers. Hey, Mike.
Hey, Alex. Well, Europe is locking down. The U.S. is tightening up and China growing strongly, moving ahead of other industrialized economies on the back of the strong data we have seen recently for retail sales, industrial production, and investment. Industrial production up 7% in November. And then we saw retail sales rise by 0.5%. And you can see with the fixed income investment rising 2.6% that the basic thrust of all of this is to move up, and that sets the stage for a strong 2021. China benefiting not just from having COVID under control, but being the exporter to the world where COVID is not under control. Exports have soared in recent months, and that's largely because the world is buying a lot of PPE, medical equipment, and work-from-home electronics from the Chinese. They still have to work to do on imports because at this point it's an export-driven recovery, but it's still good news for them overall. A lot of companies asking China to rush shipments because they're afraid they're going to lock down here in the United States. The data make it likely that China is going to be the only major economy to grow this year. The forecast is for a 2% growth rate for the year. And then you look at 2021, they haven't had this kind of growth since 2011. So a very strong year ahead for China based on the fact that they're able to be open and they're able to make the things the rest of the world, which is not open, want.
Mike, thank you very much indeed. Perfect. Mike McKee setting up the conversation we need to have on Asia and where you want to put your money to work. Still with us, Karen Ward of JP Morgan Asset Management. Karen, how much money in a typical portfolio should I be thinking about putting to work in this part of the world? A lot of money managers, and we saw that in the Bank of America survey today, are still very long tech. They are less, at the moment, overweight what is happening in Asia, but it's moving pretty quickly. How much do you want to put to work here?
Well, we've designated this as going to be Asia's decade. You know, as we look back, the US was clearly the outperformer across currencies, across fixed income, and across the stock market. As we look forward, we think Asia really takes that pole position and deserves a higher allocation. And, you know, it is partly cyclical, but it's partly structural. So, you know, I think the cyclical story was well covered. They have generally been the manufacturer of the world. And as we know, manufacturing has done well through this recession because of the extraordinary nature of it, and internally they've managed to keep domestic demand going. And then you look at their 5-year plan, and I think they build on that cyclical story with good structural roots, a focus on how they build that internal engine, keep those middle income group of the population growing. They've still got ambitions to double income per capita over the next 15 years. And also then just some of their strategic focus, particularly on climate technology. So I think that cyclical, that structural story, and then, you know, coming to things like the fixed income markets, you know, this is one part of the world, perhaps one of the only parts of the world where you can get 3% on a government bond, which has a very low correlation to global stocks. So I think it's an opportunity set across both fixed income and equities that investors should be thinking a lot harder about.
If you look at a chart of copper, for example, over the last, say, 20 years, this looks a lot like the super cycle that we saw back in the early 2000s. Are we in a commodity super cycle, although this time it's not driven by things like coal and oil, but it's driven by things like decarbonization?
Yes, exactly. A very different nature. I mean, I think we've seen global momentum towards tackling climate change is increasing everywhere, particularly now we've got Joe Biden at the helm of the US. So it's not going to be it's not going to be a fossil fuel super cycle. But as you say, it's feeding into a broader commodity, particularly agricultural products, for example. So perhaps a very different cycle to what we've seen in the past.
A lot of investors don't like the UK at the moment. Do I like the UK because it's got a lot of miners?
Yeah, I mean, I think the regional breakdown for this year, I suppose we're still in it, and as we look forward, really is dictated again by that sectoral story. So anything that's heavy in tech has done particularly well. Anything that's heavy in financials, energy and materials has done particularly badly. And of course, the UK is very heavy in financials, energy and materials. So what are the prospects for those sectors, I think, is the question you need to ask yourself about to what degree the UK will recover. Struggling a bit with energy, as I've said, I do think as the momentum behind reaching zero emissions, that's going in one direction. And therefore, I think although we're coming off a low base and there could still be some relative upside, I think the structural headwinds for energy are quite clear. Similarly, financials. I mean, I think we're going to be in a world of zero interest rates and flat curves for quite some time, and that's a challenge for the financials. Materials could be a bit more cyclical, so we could see a little bit more upside there. So there's going to be some cyclical factors which help the UK, but I think we've just got to recognise it's really those structural sectoral headwinds which are going to continue to, I think, weigh on relative performance.
Karen, it was such a pleasure. Thank you so much. Karen Ward of JP Morgan Asset Management. Thank you for joining us. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Emma Chandra. Boeing has stepped up its inspections of newly built 787 Dreamliners. It's looking for manufacturing defects that could prematurely age the plane's carbon fiber frames. Regulators say the faults don't pose an immediate safety risk, but the discovery of another flaw is slowing deliveries and raising doubts about quality control. One of London's biggest landlords is taking an almost $1 billion hit. Shaftesbury is writing down the value of its restaurants, bars and stores by about $932 million. The companies say vacancies almost tripled from a year ago, and it's bracing for more coronavirus restrictions to hit London's West End. And that's your Bloomberg Business Flash. Guy.
Emma, thank you very much indeed. Just for those that know, that wasn't the West End. That's obviously kind of where we are now, which is the City of London. Shaftesbury over in Soho, Chinatown, Covent Garden, that's where it's big. And that obviously has been, Alex, where we've seen the biggest hit. London's about to go back into Tier 3. It's those part of towns where you see theatres and a lot of the creative sector in Soho. A lot of these people have just dispersed. Theatres have been shut down, restaurants have been shut down, bars are shut down. The creative industry is basically working at home from now, as far as I can tell. And as a result of which, Shaftesbury's feeling it really, really badly at the moment. It was interesting to see, there's a quote down at the bottom of the story I read, which I think kind of sums it up. It won't be over by Christmas. It may not even be over by next Christmas, said the CEO of Shaftesbury, putting out the statements, which kind of sums it up.
I think it's an important point because there is an expectation in general, particularly in the market, that like the second you get a vaccine, you're going to throw open the doors and like run out and spend all this money. You're going to go to bars, restaurants, you're going to buy a lot of stuff. If that doesn't happen, what kind of pressure will everybody, but in particular these commercial real estate guys and property owners wind up seeing? And is the recovery really not in the back half? Is it really 2022? I mean, I don't think we know. The market thinks it does.
Yeah, the market definitely thinks it's the back half of next year, doesn't it? But it may end up being deferred. And as you say, behaviour may have changed on a more permanent basis. We simply don't know yet. Anyway, we'll talk about that and all the other stories that are moving European markets next. The European close is coming up. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We're nearly done with Tuesday. 30 seconds to go until the end of regular trading here in Europe. We are finishing on a high as well. Session highs for Europe. We're up by 0.4%, but still in the big picture, relatively range-bound over the last few days, certainly the last 10 days. In terms of the individual markets, let's show you the breakdown, give you an idea of what's going on. The FTSE being affected once again by the pound. FTSE 100 down by 0.2% on the continent. The DAX with Volkswagen really getting into gear today. The DAX up by nearly 1.2%. The CAC 40 only up by 0.2%. So outperformance certainly coming through as the car sector really delivers. In terms of the Brexit news that is moving the FTSE 100 and by extension, well, the pound and then by extension the FTSE 100, we are seeing a little bit of a story developing down in Westminster, apparently. We've got a BBC editor sending a tweet out earlier on suggesting that there's buzz down in Westminster about a possible deal and that we should be watching out for Jacob Rees-Mogg potentially to dedicate some time early on next week to potential ratification processes that we have to go through here. Anyway, all of this, obviously, just a lot of kind of rumour and speculation at the moment, but it kind of just shows you how on tenterhooks the market is. And we did see a reaction in the pound and in the gilt market, to be honest, as well, as you can see. Euro sterling, as you can see, down by 0.7%. Nothing confirmed, but it just, I think, highlights what is happening in terms of the hair trigger that the market's on here. Let's take a look at the sector breakdown, give you an idea of what is going on there, just to show you the breakdown, as I say. Also very much having the whip hand today, as you can see. We're up by nearly 3%. Volkswagen, the big driver here, but basic resources, banks, technology are all moving to the upside as well. The safe haven, the bond proxies, the healthcare sector down there at the bottom. As I say, Volkswagen, one of the key stories that we've been watching out for. It's right in the middle of this board here. The stock up by nearly 6% today. This on the back of backing from the board for Herbert Diess, the CEO, and that's certainly providing some real upside, some clarity in terms of the direction of travel for Volkswagen. The retail sector under pressure today, both Inditex and Hennes & Mauritz. Hennes & Mauritz down by 2%, nearly 3% today. Sales miss, but also the lockdowns that are just sweeping across Europe at the moment. London is going to be going into one very shortly, but other capitals, other big cities around Europe are also facing similar restrictions. And then the story that we were talking about a little bit earlier on, that report that hit the tape a little bit earlier on, that the FBI and two other federal investigations taking place in the United States, knocking some of the Scandinavian banks. Swedbank down by 4.87%, despite the fact that it and some of the other banks as well are pushing back very strongly on this reporting from Dagens Industry. Alex.
All right, let's get to the details of that. So for more on that investigation, Bloomberg managing editor for the Nordic region, Tasneem Brogger, joins us now. Tasneem, the market didn't take this well. What was new in what we learned today about this FBI investigation?
Yeah, exactly. So, I mean, investors started dumping stocks in the three of the biggest banks here, Swedbank, SEB, and Danske, when they saw this report. The headline had FBI prominently flashing across screens, and that seems to have sort of spooked people. But we do know the banks themselves have said that there are investigations. I mean, for Danske and Swedbank, there are U.S. investigations that are well known. The problem is that the banks can't tell us exactly who is investigating them. So while they have confirmed that, you know, it's well known that the U.S. is looking into their allegations of money laundering and that they're in dialogue with the U.S. authorities, they can't confirm to us specifically which authorities those are. The feeling, however, is, and also Elliot Stein, who's a Bloomberg intelligence litigation analyst, he says, look, there shouldn't really be anything particularly surprising here. And we can actually see that the bank stocks are starting to pick up slightly again.
When do we start to get clarity on this whole process?
So for one of the banks, Swedbank, they've actually already received a fine in Sweden. But the international, I mean, the U.S. investigation is ongoing. For Danske Bank, which is the biggest of the money laundering cases, which started 2 years ago, they've yet to receive a fine, and they told us today that they can't actually give us a timeline on that. So we still don't know, and we don't know how big that fine is going to be, which is part of the reason analysts say why the nervousness is so sort of palpable, and why the market overreacts in a way when they see anything that looks like it might be a new piece of information in this case where so much is still uncertain.
This might be a crazy question, but when are we going to be done with the fines and the investigations and all of that? Like, when are the banks going to be able to be cleaned up and say, okay, we did it, we paid for it, we're done?
Yeah, I mean, that is the $60 million question. For Danske, we somehow thought it would be this year. That hasn't come about. We know that the CEO of Danske, Chris Fogelsang, was in the U.S. not that long ago talking to presumably prosecutors there. We expected that would lead to something soon, but that hasn't come about yet. And as I said, for Danske, which is the longest of the current investigations, they said today that they simply can't tell us. They can't give us anything on the timing, and they can't give us anything on the scope of what they're facing.
Tasneem, we'll leave it there. Thanks for the updates. Certainly catching everybody's eye earlier on. Bloomberg's Nordic Managing Editor, Tasneem Broga. Let's stay with the banks. Let's talk more about what is happening. This time we're going to turn our attention to what is happening in Switzerland. Credit Suisse is warning it may miss a key profit target next year because, unexpectedly, of course, of the pandemic. It plans to restart share buybacks in January. Joining us now, Alison Williams, Bloomberg Intelligence Senior Analyst for Global Investment Banks and Asset Managers. It is the pandemic. It has removed clarity. We all know that. But how big a surprise is it, just the kind of the uncertainty that is coming from Thomas Gottstein in terms of the key targets that his bank needs to make next year?
Well, I think I would be more surprised if he was certain.
Yeah.
And in fact, the fact that they are sort of keeping that medium-term target of 10 to 12% return on tangible equity, I think could be optimistic. If we look at someone like J.P. Morgan, which is obviously a very different story, but I think across all the banks, they've sort of put their pre-pandemic targets on hold. J.P. Morgan had sort of said, look, over the next couple of years, given everything that's going on, we'll be happy with the 15% ratio, which is below their long-term target. Again, it's a different bank, and they have more exposure to sort of the macro uncertainty, just given their U.S. card business, which tends to be a higher loss. For Credit Suisse, I would say that the good news is that they're planning to restart their buyback in January. That's sort of the first among the banks that we cover that's given a more specific target on that front. We'll hear from the U.S. banks on Friday. Deutsche Bank, which is a European bank that we cover, has sort of had all capital return on hold just given their plans. So I think that's a positive step. There still is a lot of uncertainty for Credit Suisse. I mean, there's I guess, two near-term challenges, both of which are really not core to the business. So one is currency. The Swiss franc is very strong. So their investment banking, for example, is going to have a quarter that's sort of in line with what they've been experiencing. But because that business is U.S.-based, we think there could be some currency challenges there. We definitely saw the currency challenges last quarter, perhaps the worst in I think it was 9 years. Mm-hmm. And then the second, I guess, set of issues is there are some non-core charges coming in the fourth quarter. One related to their asset management business. It's been sort of struggling for them, but they have an ambitious plan to improve things there. Second is on the litigation front. Our legal analyst, Elliot Stein, has talked about seeing some acceleration of banks trying to get some legacy issues behind them in this sort of lame duck period, and I think that's what we're seeing from Credit Suisse.
Alison, quickly, every earnings season we talk about the juicy stuff, and then I always ask you what else are you watching, and you always say costs. How much more costs can Credit Suisse kind of wring out here, and when are we at the bare minimum?
So what's interesting about their plan and what's interesting about their plan is they said they're going to be cutting costs but investing, and I think that's actually what we want to see for the long term is investing, becoming more efficient. And I think there's more progress definitely on the technology side of things. We saw actually again J.P. Morgan talking about upping their costs next year for investment. Deutsche Bank pulling forward some investment next year. So we think the cost story is going to be one of more efficiency, but also more investment.
Alison, thanks for the update. Greatly appreciated. Alison Williams of Bloomberg Intelligence. Just to wrap things up here in Europe, these are the final numbers. A negative session for the FTSE 100, a little bit of a give back during the auction process as well. So a little bit of a tick down. Nevertheless, as you can see, significant underperformance, certainly versus the DAX, with Volkswagen having a very solid day today. More analysis at the top of the hour in the Cable Show on Bloomberg Radio. John Ferrer and I will be taking you through that hour on DAB Digital Radio. This is Bloomberg.
hiyo mkokoteni ya stima nikaipata naweza sikia vizuri sana kwa sababu inatumia nguvu sana.
The advantage of the electric handcut over the manual conventional handcut is that one, it increases the productivity level of the users. Two, it is eco-friendly in that it does not pollute the environment. Three, it increases the income level for their users in terms of loading capacity and also in terms of productivity.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
There's a need and a clear need for me to spend money. I need to spend money to boost the economy, the necessary push. And therefore today, as of now, and for this fiscal, I shall not worry about the deficit number.
This is Bloomberg.
So the EU's Margaret Vestager is still holding a news conference on the EU's new tech rules that have been announced today. Joining us now is Columbia Law School professor Anu Bradford. She is a legal expert in EU regulation and the author of the book, The Brussels Effect, How European Union Rules the World. How the European Union Rules the World. Professor, let's just talk a little bit about what has been announced today and how effective it is likely to be. Is the EU taking the right approach?
So the EU is certainly taking very decisive steps, and the big tech is wise to brace for impact. So the EU is unveiling significant new regulations, both to try to restore competition on the single market and also to make the platforms take more responsibility over the content that they display on their platforms.
Is it going to work? Is it enough of a deterrent to kind of get big tech in line?
Well, that obviously remains to be seen, but I think there is certainly a potential that this will shake up the industry. What the EU has concluded and what is driving these regulations is this consensus that the existing tools have not been enough to introduce competition, and we need something more. And here, we are not just empowering the Commission to, for instance, impose fines, but to really introduce the kind of regulations that potentially change the business models of these companies. And that is obviously much more damaging for the revenue model that these companies have relied on.
Will it spur innovation? Because that is the criticism, that these companies are too big and too dominant, and that represses innovation within the tech sector, both in Europe and in the United States. Will the result of this be more innovation?
So that is going to be the well-rehearsed argument that we will be hearing over and over again. The tech industry will claim that this will deter innovation. And it is obviously a criticism that we need to take seriously. The regulation needs to be smart and it needs to be geared towards enhancing innovation. I don't think the regulation as such is necessarily going to be an impediment to innovation. But it is not necessary that the regulation alone will be sufficient then to make the European companies and European markets more innovative.
Anu, what U.S. tech company is going to be most exposed here?
So what is really critical about these regulations is that they are making a distinction between the big, powerful platforms and the small companies. So it is targeting so-called gatekeepers of the internet. So we will be seeing the greatest impact on companies like Facebook and Google and Amazon and Apple. And I think here the EU is really responding to the criticism of the GDPR, the General Data Protection Regulation, that was criticized for really being disproportionately more difficult to comply if you were a small company. So now it is really targeting the big ones that will have a much greater responsibility going forward.
The first headline I read on this story this morning, and I've been reading about it for a number of days, but one newspaper's website said the EU threatens to break up big tech. How realistic is that threat?
So that is obviously a big headline, but I wouldn't think that that is the biggest takeaway of these regulations. The EU already has the rights under existing laws to pursue a breakup. Yet it has chosen not to use that tool. And Commissioner Vestager, for instance, has been clear in her remarks that that is the nuclear option. The EU is just now looking to gain a set of new regulatory tools that it will be eager to try first. And only if those prove to be inadequate, we might see in somewhere around the world also some consideration of a breakup. But I don't think that is the one that we're going to see used very easily.
Professor, thank you very much indeed for your time today, and thank you for your patience. We are running late in the press conference that is taking place in Brussels, but our thanks to Columbia Law School Professor Anu Bradford, greatly appreciated. So let's turn back to the markets and talk a little bit about what has been happening. It's been a banner year for investment banking despite the pandemic. Just last week, we saw those blockbuster IPOs, Airbnb, DoorDash. Bloomberg Sonali Basak is now with a top deal maker from Moelis, the co-president Navid Mahmoud Zageda. I think I've completely mispronounced that, Sonali. Help me out.
I got you, Guy. We have Navid Mahmoudzadegan again with us. Thank you, Navid, for joining us. And speaking to those IPOs, I think Alex, Guy, and I are still a little stunned from those rallies we've seen. I wanted to ask you about this because you're not an underwriter, so you don't have a stake in the game that way, but you do have a big capital markets practice that you're trying to grow. What do we think about this exuberance? Are we in bubble territory?
Hello, Sonali. Pleasure to be here. And look, I think you're right to be, slightly astounded by some of the stock price performances of these IPOs. Look, these are great companies that are going public. I think they have real and sustainable business models, and they're here to stay. One can question, some of the valuations we've seen recently and whether there's some froth in those valuations. But I think many of these companies that are going public are, really incredible companies run by real leaders, and they're here to stay. So we'll see how they trade over time. But clearly, we're in one of those periods where the market's valuing growth and putting a huge premium on companies that are growing fast.
But, some of this exuberance, what's surprising me is that it's really floating over into other areas. And when I talk to some of your rivals, what they tell me is that they're hard-pressed to find a reason next year won't be incredible. Help me here. I'm counting on you to pour a little bit of reality on this, because what are the big risks into next year?
Well, look, I share the view that I think the M&A market, which has been very strong here for the last couple of quarters, is likely to continue to be very strong for the next number of quarters. Many of the underlying rationale and reasons for the market to be strong, strategic consolidation, companies looking for more growth and trying to figure out how to improve their growth profile. The major role private equity is playing in the M&A market these days. All of those things, I think, are likely to continue to drive the market higher. Having said that, look, we do have a fractured country, despite the fact that I think there's a fair amount of optimism about President-elect Biden and his ability to potentially bring this country together. I do think there's potentially political risks and stalemate around, government providing stimulus and other things that, we need to keep this economy moving. And so, if there's one risk out there, to me, it's that.
So there's a lot of exuberance around M&A, but also a lot of expectations around more bankruptcies into next year. What do you think will happen for the next 12 months? How aggressive are we going to see this pace of bankruptcies?
Well, I don't think you're going to see an aggressive pace of bankruptcies, especially if, we get stimulus and some of the things we need to make sure the economy keeps moving. But look, I do think there's a fair number of companies that were able to access liquidity in April and May and into the summer, which, bought them more time to get through, the crisis, but still have, fairly levered capital structures. And, especially in some of these, structurally challenged, areas of the economy, if you have a company that, has too much leverage, even if you've been able to deal with the near-term liquidity issues, at some point, you have to deal with that balance sheet. And so I think we're going to likely to see over the next couple of years a steady stream of in-court and out-of-court restructurings, which will keep our restructuring bankers busy. But I don't think you're going to see a big wave unless there's a big turn down in the economy.
So this conundrum here is making it very difficult for investors to figure out how to invest, particularly the large credit investors. How do you expect people to start deploying capital over the next 6 months?
Yeah, it's a really good question. I think over the last 6 months, it's really been about recovery, right? Which placing bets on companies and industries and sectors that were likely to recover, when we got through the crisis. I think as you look out in the next 6 months, I think it's going to be more about making decisions and placing bets where, with companies that are going to be benefiting once we come out of this post-COVID world. Nobody knows exactly how consumer behavior, corporate behavior is going to change on the other end of this crisis. There's lots of hypotheses out there about things that may happen, but nobody really knows. And I think the challenge for investors is trying to make those decisions going forward. I think it's not an easy thing to do.
Let's talk about how you do your job now, too, because, just a week ago, Ken Moelis, the CEO of Moelis & Company, had said that he would be letting more people work outside of New York, work outside of the main hub office. But I know there's a lot of concerns across the industry as well about how this next generation of talent is trained up when everybody is farther away from each other. How are you thinking about that issue?
Sure. Look, I do think it's apparent that there's going to be more companies that choose to relocate to, lower tax jurisdictions, lower regulatory jurisdictions. And I do think we'll have, some of our bankers who choose to move to try to be closer to their clients and closer to some of these companies. And so, one of the things we want to do as a firm, because we're a talent-driven organization, is make sure that we're allowing our bankers to be close to their clients, especially during COVID, where we're all kind of working in a different way. We're trying to be a little bit more flexible. Having said all that, look, New York is the financial capital of the world. It's going to continue to be the financial capital of the world, in my view. It will always, I think, be the headquarters of Moelis & Company. I think we're always going to have more bankers there than anybody else. We're looking forward to getting our bankers back in the office when it's safe to do that. And I do think that, being together is important for culture, and I think it's important for training. There's always been an online and offline component of banker training, and our junior bankers are doing an incredible job of servicing clients and getting up to speed and learning the business, but there's nothing like being together.
And real quick here, I have one more question for you. You implied that CEOs are moving. It's not just the finance industry. How much is this bankers following clients that are moving their hubs outside of New York?
I think that's part of it. Look, there is at times an advantage, being close to your clients. And, I do think, if we do see companies move to other places and we'll see bankers and other service professionals, move to try to be close to their key clients. And again, we want to be flexible to allow our bankers to do that so they can be maximally productive. And I think we've seen, through some of the online tools that you can be productive even if you're not in a major hub.
Navid, thank you so much for joining us today. We hope to have you back soon. Alex, back to you.
All right, Sonali, great interview. Thank you so much. We really appreciate that. Quick check-in here on the markets. We are still waiting for Margaret Vestager to end her press conference so she can then talk to Bloomberg, and we'll bring you that when it crosses. Latest headline, though, from Politico. Nancy Pelosi, House Speaker, inviting McCarthy, Schumer, and McConnell, so White House Chief of Staff and the Senate Majority Leader and Senate Minority Leader to chat. Presumably that would be then about stimulus. The deal seems to be getting smaller, but will we actually get it done by the end of the week? The market's still relatively optimistic. You have the S&P up by 0.5%. The biotech index, though, rolling over. The NASDAQ rolling over a little bit as well as we're waiting those tech regulations coming out of Europe. It seems like they could be hitting by mid-2022. I do want to highlight what's happening with the bond market. 90 basis points is where we sit. The Fed begins its meeting today. I feel like we didn't even talk about it. If we do get a stimulus, are we going to have to see actually more buying from the Fed in terms of long-term bonds to keep a lid under the 10-year there, or can we handle a 1%? All of that to dissect over the next 24 hours. That wraps it up for me and Guy here in New York and also in London. Coming up, John Yarmuth, U.S. House Budget Committee Chairman. He'll be joining Balance of Power with David Weston on Bloomberg Television and Radio. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. This is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
I feel really lucky, having stared into what felt like an abyss for travel, and then to kind of rally together with thousands of people, rebuild the company from the ground up.
Tumbling now 11 in this knee-jerk risk-off field.
From New York to our Bloomberg television and radio audiences worldwide, I'm David Weston. Welcome to Balance of Power, where the world of politics meets the world of business. I want to start with the markets as we do every day. And Abigail Doolittle. So, Abigail, just glancing at it, looks like the S&P kind of is coming back today.
Yes, it is. And in fact, the first up day in 5 days. So the bulls are trying to reestablish positioning here. And of course, lots of it has to do with vaccine optimism. We did have the announcement from the FDA today that Moderna's COVID-19 vaccine is safe and effective. They will be ruling on it later this week on Thursday as to whether or not it will receive that emergency authorization that Pfizer's vaccine received last week. It's largely expected this will happen. So if all goes well, that vaccine should be in distribution, relatively soon as well, David. So this means in the longer term, medium term, that the economy will be able to reopen. So on this, we do have the S&P 500 trading higher, the NASDAQ 100 trading higher. Interestingly, though, the NASDAQ 100 is up less than the S&P, up just 0.3%. And the big drag there, David, is Moderna. So this is very similar to what we saw yesterday with Pfizer. Pfizer, their vaccine was actually starting to go into distribution. That stock closed down more than 4%. Moderna down 4.6%. So a little bit of sell the news action there. In addition, we have some of the big tech names down 2%, Facebook down 2%. So interesting weakness there. However, David, bonds not worried. We have that 10-year yield climbing. So overall, it is a bullish risk-on picture, even as folks, investors, traders are waiting for news on stimulus. But right now, they're pretty happy about the idea that a vaccine and now a second vaccine is potentially close to distribution, David.
So, Abigail, you always look for little counter indicators. Do you see any oil someplace else today?
Today, not so much, David. One that had my eye yesterday, and of course, we had that bearish reversal because initially stocks opened higher yesterday and then closed down. The VIX, that quote-unquote fear index, when it's above 20, that tells you that uncertainty does remain elevated. It is still well above 20. That tells you some investors are hedging to some degree, that they still think that the near term could be difficult around this virus situation, even as we come to believe that the medium and long term will be more positive as the vaccine gets into the population. So that keep an eye on that VIX. If that's above 20, that tells you some of the smart, fast money that they are hedging a little bit, that they're not completely bullish in this picture. That's a beneath the surface tell to look at, David.
Okay, thank you so much, Abigail. We really appreciate it. In the meantime, Congress is in a rush to get its work done before it breaks for the holidays. It has an omnibus spending bill. Look like it will be going forward sometime later this week. And it may be attached to some form of stimulus bill as well, with some compromise being talked about. We welcome now John Yarmuth. He is Democratic Congressman from Kentucky and also the chair of the House Budget Committee. So, Congressman, it's great to have you back with us. Thank you for being with us. We just saw an announcement just a few minutes ago that actually Nancy Pelosi, the Speaker of the House, is going to be meeting with her counterpart, Mr. McCarthy, as well as the Senate leadership. They're going to have a confab later this afternoon at 4 p.m. Are we moving toward a deal, do you think?
It looks that way, David, and it's great to be back. I just realized that you can't see me smiling, but I'm happy to be back. But this is something that should never have gotten this far. We passed the CARES Act in March. We passed the HEROES Act in May, and Senator McConnell, who's my constituent, as I am his, said at the time, we'll have to wait and see once we pass the CARES Act if we needed more help from the federal government. Of course, that was sensible, but it wasn't sensible not to start working on Plan B. And we all thought this was going to be over in midsummer. Many people did. So we provided for that in the CARES Act. And here it is in December, and we still don't have an ongoing solution to the many, many tragedies that the American people are experiencing right now. And we've seen employment numbers take a turn for the worst in the last week. We know that it looks like December is going to be very soft on the employment level, and we've got potentially a lot of evictions coming up in a couple of weeks if Congress doesn't act. So we put not just, we haven't helped with the strain that Americans are feeling, but we also put a lot of additional stress on them. We should have been more responsible than this.
So my understanding, Congressman, is that basically that group, that bipartisan group from the Senate, divided the issues into two camps. One of them would include things like support for small businesses and some of the unemployment insurance that is going to go away at the end of the year. That seems to be something people agree on, but it separates out the assistance for the states and the liability limitation. Is that a sensible compromise, and what will that do to states and local governments if we don't get that done?
Well, I don't think it's sensible, but again, I don't think it's sensible that we are where we are in general. Right now we're asking the states to be the leaders and the implementers of this incredible challenge to distribute vaccine across the country over the next few months. And states and localities are already hurting desperately for revenue. We've already laid off 2 million public service employees across the country since the pandemic started. We need to provide resources for those states and localities to do what we're asking them to do, which is save the lives of millions of Americans. And it's incredible that this has become political, that Republicans seem to think this is a blue state, red state thing. I remember seeing Governor Asa Hutchinson a few weeks ago begging Congress to act. And Arkansas certainly doesn't even have a tinge of blue in it. My state, we have a Democratic governor, but everything else is Republican, and Trump carried the state easily. We are desperately in need of help. I talked to my mayor just this morning, mayor in Louisville, and who's also president of the National Council of Mayors, and he says cities are hurting all over. They're having trouble actually doing the basic stuff, the block and tackling, the policing, security, healthcare, and now we're asking them to help distribute the vaccine. So we need the help, and it should not be tied to liability reform, which is what the Senate Majority Leader McConnell is pushing to do. Yes, I think there's a valid case for liability reform, but we need to do what needs to be done right now. And I think what Mitch McConnell said was, let's do what we agree on now, and let's do what we don't agree on sometime later. State and localities can't wait till later.
You mentioned the mayor of Louisville, Greg Fisher. As it happens, we're going to be talking to him in just a few minutes from right now on this program, Congressman. At the same time, as you talk about Kentucky and what's going on in Kentucky, I am mindful of the fact that one of the residents of Kentucky, last time I checked, was Mitch McConnell, who was the one who's resisting that. In fact, I hear he may even be a constituent of yours. Explain that. Does Kentucky not have the problem that other states are having right now?
Well, of course it does. And this is what's just so kind of disingenuous about what Mitch and other Republicans have said. Again, we are not a blue state in Kentucky, and we are definitely hurting. Revenues are down. We've laid off a lot of public sector employees over the last 8 months, and we need help just as every other state does. Our cities do. And I can't imagine why the Republicans who try to empower states, that's part of their core set of values, is states' rights and responsibilities, we wouldn't help give them the resources they need to carry out the roles we're asking them to play. Again, states have to balance their budgets. The federal government doesn't have to. And what virtually everybody in a position of knowledge knows, whether it's the chair of the Fed, Jay Powell, whether it's people like Douglas Holtz-Eakin, who the former CBO director, who has been a deficit hawk, they all said we have plenty of fiscal room to make the kind of investment that we need to make right now. So we ought to do it. It looks like Mitch McConnell and a few members of the Senate are the only people who don't think we need to react in a very serious and massive way.
So, Congressman, I certainly can understand you're concerned about those people who will be going off of the supplemental unemployment at the end of the year. The small businesses will be hurt. So we need to get support for them. We may need to leave behind some of the other issues you think, as you said, would be sensible to do. As a practical matter, if you don't get the state assistance, you don't deal with the liability limitation at this point, is it gone as you go into the next term?
Well, you're going to lose a lot of very good public servants along the way. No, I don't think it's gone. I think one thing that I'm optimistic about is even this compromise measure is designed to get us through March. So it kind of speaks out or implies that we're going to have to do something else. And we will have a president and his economic team who I think understand the importance of doing it. We'll have the bully pulpit then. We'll lay out a very compelling case and clear case as to why we have to do take a certain path and how much that's going to cost us. And that's one thing we haven't had is presidential leadership in this national economic challenge and humanitarian challenge. So I'm a little bit more optimistic that regardless of what happens in Georgia and what happens with control of the Senate, that with very strong leadership coming out of the next administration, that we have a much better chance of getting something done.
Okay, Congressman, it's always a great pleasure to have you with us. That is Congressman John Yarmuth, Democrat of Kentucky. And as I mentioned to him, we're going to be talking with his hometown mayor, Mayor of Louisville, Greg Fisher, a little later on in this program, right here on Balance of Power on Bloomberg Television and on radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. This is Balance of Power on Bloomberg Television and on radio. Christine Todd Whitman served as the 50th governor of the state of New Jersey before she went on to head the EPA. She's also been very involved with an advisory panel, really taking a look at the elections to make sure that they were done properly and that every vote counted. A bipartisan group, I must say. And we welcome now former Governor Christine Todd Whitman. Thank you so much, Governor, for being with us. Tell us about this group, because frankly, I was not that familiar with it before.
Well, VPP is made up, Voter Protection Program it was called, and it is bipartisan, nonpartisan, apartisan, whatever you want to call it, because it's made up of attorneys generals, members of law enforcement, a few people like me thrown in, but people who really care about the law and the rule of law and wanted to make sure that this election was as clean and fair and free as any that we have had. And once we saw what was going on, I mean, we were monitoring all the way through, monitoring particularly in those swing states, watching to see that things were being done right. It wasn't a question of whether Biden won a state or Trump won a state. It was whether it was done legitimately. And then once all the questions started to arise, these people, and really it wasn't me because the lawyers in the group are the ones who are doing an incredible job of writing the amicus briefs and filing briefs to counteract some of these just ridiculous claims that were being made, and messaging, trying to reach those people in those states to say, look, this has been okay. It's been right. Everybody's been watching. There wasn't fraud here. There's been no proof that's been given to the people. There's no there. And so we've been trying to get that message out to people because it's as important, not just for this election as it will be for the next, and people's confidence in our election process.
It seems to me that that's one of the big questions coming out of this election, which is what is the reputation of democracy, of our democracy in this country? We heard President-elect Biden last night as he gave those remarks. He spent a fair amount of his time, actually, defending the process itself, not just the numbers that came in, but all of the people, Republican and Democrats, who were officials at the state and local level, what they did, as well as the court system, going up to the Supreme Court, but including state and federal courts. As you look at this entire thing, because you've had a hard look at it, how did we do? What is the reputation of democracy after this election?
Well, actually, we did very well. I mean, in a time of a pandemic with a president who had been setting up the idea that there were going to be a stolen election, that there would be fraud, because he's been talking about this for a year now, about the only way he could lose is if it were stolen from him. To have come through it the way we have, and yes, there have been challenges. Yes, they're still going on, and they will go on, because it's not so much about this election now, I think, is about the next one. But I think we should show this is the strength of it. It's been tried. Our democracy was tried in this election cycle as it has never been tried before, or at least not in anybody's living lifetime. And we've come through it. We showed that the rule of law works. We've showed that those men and women, Republican, Democrat, because it's both sides, who stood up, stood for the rule of law, who did their duty, those women, men and women, many of them retirees who stood up counting the votes, and in Georgia for 3 different times overseeing this process. We should be thankful that ordinary citizens have taken this so seriously. And the vote turnout is another example of people finally taking this franchise meaningfully and understanding its importance. I think we should say it's good, but we've also shown the weaknesses. There are things that we need to work on. Obviously, we need to take some steps to ensure that the people have confidence in the system. That's the biggest loss, I think, that we've had from this election. If you can say that it's a loss for our democracy, is that this constant repeating of false claims to undermine the credibility of the vote and the people that are buying into it. That's where we have to be concerned. We have to remind people, we came through this, we did it well, we're going to have a peaceful transfer of power. That's the way we've always done it in this country, and we will continue to do it. That's where the majority of the American people want to be.
Governor Whitman, finally, let me turn to another area of your expertise. As I said, you ran the EPA under George W. Bush, President George W. Bush. We right now have a president-elect coming in with a very aggressive, very assertive program when it comes to climate. Give us your thoughts on what he should be looking for as an EPA administrator. Mindful of the fact the person that had been talked about it, she is a regulator from the state of California, is running into some controversy because of the lack of environmental justice. How important is environmental justice?
Oh, I mean, again, if this election has shown anything, it's shown the divide in this country between people who have access to voting, but also people who have been discriminated against over the history of our country. And environmental justice is an enormous issue. It's a very important issue. It means that what we're recognizing is there are communities, because they lacked the economic power or the political power to fight back, have been sites for some of the worst polluting plants. And it is showing itself in this pandemic, because you have people living in those areas that have higher incidence of asthma. Their health isn't as good because they've been subject to so much of the pollution over time. So that's going to be a big part of it. But really, I think the number one challenge is, as with so many things, is to restore people's confidence. And in this instance, it would be science, both for environmental issues and for health. I mean, look at what's happened with the pandemic by ignoring science so early on and so consistently for such a long period. It's something that is going to prove to be a big challenge for whomever comes in. They have to try to restore the morale at the agency, which has been severely battered. A lot of what's happened is they've lost a lot of the institutional knowledge. Some 900 scientists have left the agency. They've been replaced to the extent of about 350, right. But many of those came from the institutions that are the very companies that are overseen by the agency. So there's a lot of work to do there, but bringing back the credibility and people's confidence in the science and the importance of science is going to be a key factor.
Governor, thank you so very much. Always a pleasure to have you with us. That's former New Jersey Governor Christine Todd Whitman. And now we're going to turn from the United States over to Europe, where the EU is announcing major new regulation, proposing it for the tech industry. We turn to our colleague Maria Tadeo, who is with Margaret Vestager. She is Executive Vice President of the European Commission.
The European Union that could have big repercussions for American tech. And on that note, I'm happy to say we are joined by the European Commissioner, Margrethe Vestager. Today, you've announced a whole bunch of measures. We could see big fines of up to 10%. We could see potential breakup of companies, disinvestment. And you also say that companies need to take a responsibility. The digital market is the same as brick and mortar. So I wonder, do you worry about the reaction from companies like Facebook, Amazon, and so on?
Well, what we worry about is competition and a fair marketplace. And we have been consulting extensively. We've been talking with, everyone. We've had experts, member states, parliaments, businesses, organizations. What they worry about is being able to do fair business. And what they worry about is too much illegal content, both product and services. So this is our worry. And of course, we are balancing things, which is why we think that this is, well, quite a proportionate proposal.
And when you were explaining some of the measures, you said that this is not targeting anyone in particular and that you hope you don't have to fine anyone, but nonetheless you could see 10% fine over your revenue here. Is that something that you're looking to do as a measure if needed, however?
Well, I think that anyone would want to comply with legislation that has been passed by our legislature here, the Parliament, the Council. Why wouldn't you want to do that? But it's also good to have an incentive. And the incentive of a fine of 10% of your turnover, I think that's a good incentive.
And could we read that perhaps as a warning too?
Well, the strange thing is that in my work as competition law enforcer, I've seen a lot. I've seen a lot of practices that has been really damaging for other businesses. Now we say sort of in general, well, these are the things that you must do. These are the things that you should not do. And I think it will bring a better balance into the marketplace. And that is what we need. Because this is actually a bit more than just competition law enforcement and making that general. This is also beyond addressing unfair trading practices. And we have seen that no matter how vigilant we are in competition law enforcement, we need to work hand in hand with regulation in order to have an open and contestable market.
And one of the things you said is that in terms of the gatekeepers or companies that may have too big a position in the market, if that was needed, you could look into potentially breaking up or asking a company to disinvest and split up their business. That is something that investors really worry about and look at that as almost a nuclear option. Is that the nuclear option for you, or are you willing to use that too if needed?
Well, I think that we will have compliance because I think it's proportional, it's reasonable. It's actually what you would expect if you're an investor, that the business that you invest in actually is by the book. If they're not, then it is fines and other fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company. I would not expect that we should go there, but as a last resort, I find that it is justifiable.
Okay, so it's justifiable, but it's not something that you're looking to do anytime soon to that respect?
No, of course not. What we want is an open, contestable marketplace where businesses can find their customers. This is what we want to achieve.
You also say moving away from competition, that internet that really controls some of the information that goes on, and especially the fake news and really some stuff that is clearly not factual and could confuse the public is equally important for the Europeans. I wonder specifically with Facebook, we've seen a lot of fake news when it comes to COVID, the vaccine and so on. What are they telling you in terms of A, how quickly they're going to take it down, and are they going to be held liable at one point for that content?
Well, actually, I think that we have had quite a good cooperation with a number of the platforms to make sure that when people are looking for information about COVID and the pandemic and vaccines, that they get sort of official vetted information. So this will not regulate content. But if a member state, for instance, say, well, this is illegal, well, then if you are flagged, this is illegal, you have to take it down. But the other thing is they also have to tell the people who were behind it, we have taken down your content. Do you want to complain about it? Because just as well as it's important for us that what is illegal offline is also taken down as illegal online, freedom of expression is obviously also key.
And the other company, especially heading into Christmas, that has been very much in focus is Amazon. We've seen a lot of small companies in Europe push back. They say it's unfair. They're not able to compete with a huge company like Amazon, and especially in the time of COVID. I wonder, do you sympathize with them? Do you feel that hurt from the small companies in Europe?
Yes, I do. And you know, we just sent a statement of objection to Amazon because what we conclude, preliminary, yes, but what we conclude so far is that they use the data from all these small traders and use that to sort of assess what they themselves as a retailer should put on the market, which of course makes their risks very, very small compared to the small guy who have to, take a risk and guess what is the next thing that someone wants to buy.
Well, Commissioner, thank you so much. Always good to see you on Bloomberg. And that was the European Commissioner of Market Vestager, David. Two big pieces of legislation announced today in Europe that could make a huge difference. But I would say this is not happening overnight. Usually this could take up to 2 years.
No, and by the way, it's been a long time coming, Maria, as you know so well. There's been, particularly Vestager has been very aggressive in trying to regulate tech over in Europe. I must say we all have something similar to that going on back here in the United States as well, as we've got these FTC action against Google and Facebook, and the Justice Department against Google and FTC against Facebook. So there's a lot going on tech regulation on both sides of the Atlantic. Maria, thank you so very much for that terrific interview, very timely interview. We'll have to be watching that as it develops because it could have real ramifications for some of the big tech companies who happen to be based in the United States, which itself is sometimes an issue because there's a perception that perhaps this is almost anti-American, as the Europeans are particularly tough on regulating tech, including with taxation and things like that. In the meantime, we're going to be coming back to the United States and taking a hard look at the Federal Reserve meetings, which are starting today, and how they're going to have to take into account what's going on with the COVID crisis here. How do they take into account what's happening with the economy when we don't know exactly what's happening with that, and the vaccine appears to be around the corner? And we will talk with the Louisville mayor. He is the president of the U.S. Council of Mayors, and he is Mr. Greg Fisher, about what is happening in his state and his city and how mayors across the country are dealing with COVID. That's on Balance of Power on Bloomberg Television and on radio.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonizes it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
With a new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We're going now to Mark Crumpton for Bloomberg First Word News.
David, thank you. Hundreds of hospitals in the United States are gearing up to vaccinate their workers against COVID-19. Packed in dry ice to stay at ultra-frozen temperatures, shipments of Pfizer's vaccine began arriving at 400 additional hospitals and distribution sites a day after the nation's death toll surpassed 300,000. The first 3 million shots are being earmarked for frontline health workers and elder care patients. Federal regulators today issued a positive review of a second coronavirus vaccine. My colleague David Weston will have more on that coming up. The nation's top infectious disease expert expects to be vaccinated against COVID-19 as early as this week. It's not just because Dr. Anthony Fauci is still seeing patients. He tells the Washington Post he believes getting inoculated on camera could help boost Americans' confidence that the vaccine is safe to take. Dr. Fauci says between 75% to 85% of the U.S. population must be vaccinated to achieve herd immunity. For the first time, Senate Majority Leader Mitch McConnell is acknowledging that Joe Biden won the presidential election. He spoke on the Senate floor this morning.
As of this morning, our country has officially a president-elect and a vice president-elect. So today I want to congratulate President-elect Joe Biden. The president-elect is no stranger to the Senate. He's devoted himself to public service for many years.
Leader McConnell also praised President Trump, saying it's hard to list all the president's, quote, major wins. McConnell refused to acknowledge Biden's win until now, saying President Trump was entitled to pursue his claims in court. The transition to a Biden White House is continuing despite President Trump's refusal to concede. Multiple sources say Secretary of State Mike Pompeo will meet this week with his designated successor, Antony Blinken. It could be the first face-to-face cabinet-level transition contact between the outgoing and incoming administrations. Secretary Pompeo has been one of President Trump's strongest defenders. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. The Federal Reserve is beginning its first of 2 days of meetings today, and one of the big questions it's facing is what to make of an economy that is being racked by the coronavirus. At the same time, vaccines are now being distributed across the country. To give us a sense of how the disease and the vaccines are making through, we now welcome Drew Armstrong, who heads our healthcare coverage right here at Bloomberg. So, Drew, thanks so much. I guess the big news today, besides continued vaccinations, is some news on Moderna, because we have an FDA staff report sort of giving it a clean bill of health, so to speak.
Yeah, that's right. I mean, this staff report that FDA produces typically ahead of any decision on a drug or vaccine looks to be very, very good news, similar to Pfizer in that respect when the emergency use authorization for Pfizer was being considered, and saying that, you know, this appears, it looks like this is 94.1% effective. You don't have a particularly worrisome side effect profile. I think this is certainly an indication that this will get authorized for use under these emergency measures, perhaps as soon as the end of this week after outside advisors to the FDA meet and discuss this.
Fascinating. And thus far, what do we have a sense of how fast that vaccine is going out right now? We have the inoculations being done. There's a lot of predictions about where we'll be in the first quarter and things. What should we realistically expect?
You know, what the government has said is that we'll see approximately, I believe, 20 million people vaccinated by, you know, the end of this year, at least, getting their first shot of these two-dose shots. And, you know, that obviously compared to, 330-some million people in the United States is not that many. We are still waiting to see really kind of the mass availability that is going to come later this year. We are actually keeping track of all this data. We're beginning to see the initial reports from states trickle out about early vaccinations and hope to begin posting some of that information soon. But I think right now, at this point, this is going to be a slow trickle to healthcare workers, other particularly vulnerable frontline folks, or people in nursing homes that will begin to get inoculated in the coming days and weeks.
So, Drew, I'm not a public health person. Sadly, I don't think the Federal Reserve is either. But that says to me that there's help coming, but it's not right around the corner, that in terms of the economy, it's going to be a while before we see a material effect on this disease.
Yeah, I think that that's right. We are still in a period in this pandemic that, despite the wonderful news, and I cannot emphasize how wonderful it is that there is a vaccine, that we're at perhaps the most dangerous part of this outbreak in the entire year. Deaths are hitting records pretty consistently. New cases are hitting records almost every day. I mean, this is as bad and as widespread geographically as the outbreak has been in the United States since this began. And public health officials have been emphasizing that people do need to still continue taking those protective measures like social distancing, mask wearing, not assuming that just because there is a vaccine out there that things are over. A vaccine does not do anybody any good as long as it is sitting on a shelf somewhere and not going into the arms of lots of people.
Okay, Drew, thank you so very much. That's Drew Armstrong, who heads our healthcare coverage here at Bloomberg. So what does the Fed make of all this? We turn to our resident expert. He is Michael McKee, and he is our international economics and policy correspondent. Mike, so what does the Fed do? They have to have some projections, I assume, of what the economy is going to do over the next 6-12 months. How does it make that projection?
Well, that's a very interesting question, and I'm sure it's one that'll get posed to Jay Powell because they are supposed to release new economic forecasts at this meeting. But how do you make a forecast if you don't know, A, the course of the virus, and B, whether or not there will be any kind of economic fiscal stimulus? So the Fed is in a tough position. There's three things people think they could do. One is tie their rate increases to numerical targets for unemployment and prices. That way it suggests to the markets this will be lower for longer. Two is increase QE, buy more stuff. But right now the Atlanta Fed GDP Now tracker is at 11%. So things have slowed. The Fed thinks they're going to get worse, but the economy is not in that bad a shape. Finally, they could buy more at the longer end. You look at the 10-year note yield, and it is struggling to get above 1%. It almost got there this week, but now headed back down again. So do they need to do anything to try to push down on long-term rates? Those are the questions they're going to have to answer.
This is the first meeting that they're having since Steven Mnuchin, the Secretary of Treasury, asked for his money back, so to speak, on those 13.3, the so-called 13.3 facilities. Do we expect to hear anything on that, about the need maybe to re-up them with the new administration coming up?
That's going to be a very interesting question to put to Jay Powell, because does he want to say anything that would upset the current administration? He's got to live with them for another 6 weeks, and if things are really going badly, he might need their help. And there is money in the Exchange Stabilization Fund that Treasury Secretary Mnuchin could contribute. But on the other hand, is this a good opportunity for him to say, we need help and we need to make sure that we have it in place, ready to go if the economy turns down? Be a tightrope walk for him.
Well, talking about a tightrope, right now this week, I think Congress is finally going to have to decide one way or the other on the fiscal stimulus. In the past, Jay Powell has been reasonably explicit, I think it's fair to say, in saying we need more fiscal stimulus. Is he going to step into that, given the real pressure being put on that issue just today?
Probably not explicitly. He may say, yes, we need more fiscal help or the economy needs additional help, but he's tried very hard not to give advice to members of Congress who don't really like to get it on what they should be doing. But you can expect him to make the point that the Fed can't do it by itself. And getting back to your original question, all the things the Fed could do tomorrow are to push down on interest rates, but they're at record lows and mortgage rates are at record lows. So there isn't much the Fed can do to help the economy at this point, particularly with those lending programs going away.
Okay, Michael, it's always such a great treat to have you with us. That's Michael McKee. He's our international economics and policy correspondent. Coming up here, we're going to talk with Greg Fisher. He is both the mayor of Louisville and the president of the U.S. Mayor's Conference about what his city and what cities across the country need in the wake of this pandemic. That's coming up next on Balance of Power on Bloomberg Television and on radio.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Cities all across the country have been hit really hard by the pandemic. Both their healthcare systems have had a lot of pressure put on them. At the same time, their businesses and their economies are really racked. We welcome now the mayor of Louisville, Greg Fisher, who knows the situation firsthand on the ground. He also is the president of the U.S. Council of Mayors, so he speaks for a lot of cities across the country. Mr. Mayor, thank you so much for joining us. Let's start with what's really timely in Washington, at least right now, which is this proposed stimulus compromise, something that may go forward finally this week, although apparently at the cost of having assistance for state and local government. How badly does your city, your cities across the country, need this help from the federal government?
Well, hey, David, good to be with you. No, this is a dire time, not just for individuals and small businesses, but state and local governments as well, because the pandemic obviously has racked the economy. The tax receipts are down, so that's the fuel that comes into local government. And when you put a personal face on it, think about the police officers that you depend upon, the emergency medical workers that you depend on, firefighters. That's what we're talking about, not having enough money to pay those salaries, so you're going to have to downsize local government to have fewer services at a time when people need them more than ever. So what we're seeing in D.C. right now, obviously, is we got two separate bills up there. One that's got a bunch of good stuff in it that I'm excited about for our small businesses, for extending the eviction moratorium out 30 days. It needs to go out a lot further than that. We're going to have an eviction crisis here on December the 3rd. If Congress doesn't act on that, potentially tens of millions of households without a place to stay. So that needs to be extended past January 31st. Unemployment insurance is in the big bill, so that's good. And then ability to make sure the vaccine gets out. The other bill, the smaller bill, it's $160 billion, I believe, with about 40% going to local government, 60% to state. That's the bill that's going to stabilize local government services, which is all the stuff people take for granted, you know, garbage pickup and firefighting, the things I just mentioned before. And the rub there is they're trying to get some liability protection on one hand from the Republicans. Democrats are arguing back and forth on that. And what's being held at bay is this local and state government assistance, which could have a devastating impact on local government. So we really need Congress to figure that out here in the next couple of days.
Well, leading the vanguard on the resistance to the state and local assistance, as well as the limitation on liability, has been Mitch McConnell. Last time I checked, he is a resident of Kentucky. What doesn't he get? Because if you talk to Mitch McConnell, what he says is, look, at that money for state government is really just going to go for some states, typically talks about California and New York, that have just been profligate, have spent too much. And in fact, we don't need it in states that are more reasonable, maybe like Kentucky.
Well, the data doesn't bear that out. Every state, whether they're red states or blue states, has been really hurt by the pandemic. So I know that was an early talking point. It's been moved way past that. I think the leader understands that there needs help at the state and local government. He wants to see some type of liability protections and reasonable liability protections. I certainly understand that as well. And that's the challenge facing Congress right now, to figure that out. And I hope what they don't do is, when they pass this larger bill, that they declare victory and go home, and they leave all the states and local governments in a position where we cannot continue basic services, life-saving services that people depend on. And what we learned in the Great Recession was, by not investing in the local and state governments, it extended the period of our recovery by a year or two. So we don't need to make that same mistake again. Now is a vital time to think about public safety, emergency services. We do not want to jeopardize those services for the benefit of the people in the cities of America.
Mr. Mayor, please give us a sense of what's going on in Louisville and other cities as well, insofar as you know, with respect to the pandemic right now, the infection from the disease, and also the vaccination program, which has now started as of yesterday.
Which is super exciting. And we're proud here in Louisville. We're the home of UPS's Worldport. So the distribution of the vaccine is going to be happening out of our city toward the eastern United States. The first people, healthcare professionals, started getting inoculated yesterday. So, and finally, David, you know, after what's it been, nine months of torture, there's a little light at the end of the tunnel. But in Louisville, like everywhere in the country right now, infections are continuing to increase. We're kind of stable at a higher plateau. We do have adequate healthcare capacity here, but we're just getting people, we just need to get people to hold on in this multi-month period between when we have the vaccine and when infections are still out there. This coronavirus is not taking a break. It's not taking a Christmas holiday, and it sees that as a real opportunity to spread. So we just keep sending the basic messages, right? Masking, distancing, you know the drill on that, so we can get through to the vaccine. But mayors are going to be in charge of what I call the last inch. And the last inch is that inch between the needle and your arm, to make sure that we're getting the right people in the right place, in the right priority to get vaccinated. And that's being done with the right messengers at the right time as well, to build trust in the vaccine, so people will go out and say, I want to get this as soon as I possibly can. So it's that nitty gritty local distribution issues that mayors will be working with their health departments, with the state on, to make sure that everybody gets vaccinated in the proper way as soon as possible, so we can get to herd immunity, get our economies back open. It's just been, it's been a killer to see what's happened to some of our restaurants and small businesses here that people have invested their dreams in, and they're just gone. So that's another reason why we need this fiscal stimulus ASAP.
It's a terrible situation for so many people, businesses and individuals. And one of the things we've seen through this pandemic is it hits some people disproportionately, particularly the less fortunate, particularly the minorities across the country. What can we do coming out of this to address some of the racial and economic injustices that have really been brought to the forefront by this experience?
Well, that's right. And if we don't do that, we will not be as great a country as we can be. Diversity, in my view, is our secret sauce compared to our foreign competition. So we've got to make sure the vaccine comes out in an equitable manner. We've done that with the testing for the vaccine as well. We've put disproportionate amount of testing sites in low-income communities of color because the infection rates are higher. And throughout the country, mortality is higher in those categories as well. So the vaccine needs to be equitably distributed as well. So after we get through the healthcare workers and the long-term care facilities and first responders, and we need to go into a category of age inequity. So in Kentucky, for instance, 91% of our deaths come from long-term care facilities and people over age 65. And then our Black and brown communities, as I said, are disproportionately affected. So you can address that with a strategy. Now, like some good news coming out of this is the emphasis that we're putting in our lower invested communities on workforce development with the public partnerships. For instance, our Future of Work initiative with Microsoft, partnered with Humana, a great local company, where we are intentionally reskilling and upskilling folks so they can go from low wage jobs to career jobs in technology. So while all this is going on and people are teleworking, we're repositioning our citizens so they can participate more in the digital economy.
And Mayor, that's a terribly important subject, a bigger subject. I hope you'll come back and really have a whole segment to talk about just that. In the meantime, thank you so much to Mayor Greg Fisher of Louisville. Meantime, coming up here, we're going to talk about the relationship between Hong Kong and the mainland, and that is with the outgoing CEO of Hong Kong Exchange and Clearing. He's Charles Lee. That's next on Balance of Power on Bloomberg Television and on radio.
I think we have a lot to be optimistic about in this country, but in the near term, even with these vaccines, Moderna and Pfizer, we just got to allow them to be given to the people who need them the most, but that's going to take more than 6 months.
Charles Lee is leaving his position as CEO of Hong Kong Exchange and Clearing after 10 years, and our colleague Sophie Cameroon sat down with him for his closing thoughts.
The Chinese market will never be like the international market in its entirety. The international market will never be able to suit into a Chinese market, but there will be enough, middle ground where they do intersect. It is in that intersection that Hong Kong have to find the most relevant role to play. Because Shanghai will play in that role, Singapore will play in that role, other people will play in that role, but Hong Kong is the only one who can truly go in between and need to find a way, because that role initially is small, becoming bigger and bigger, and then eventually stabilize so that the American will still be here, the Chinese will be here, there will be something in the middle. Then when that middle size is no longer growing, then Hong Kong just need to go deeper.
Now, there was momentum towards embracing Chinese assets. We've seen index compilers, for example, including those equities on their indices. That has stalled somewhat given the U.S. sanctions imposed by the Trump administration. What are the implications of that on China's attempts to integrate into the global markets and its liberalization on the mainland, as well as Hong Kong's role in this?
If you look at that global map, invariably you will walk away with the conclusion that China is the place where yield is going to be, because fundamental economic development is stronger there. The consumer class is growing there. The people are getting more wealthy. The currency is becoming stronger, and their supply chain is as resilient, as strong as ever. While this decoupling will continue to put stress on the respective economies of each other, I think relatively speaking, the Chinese market will become increasingly more important for global investors. So, yeah, government, policy makers, individual political figures can always do whatever they wanted to do that could potentially create short-term temporary impact on a more localized target. But as I said, finance money is like a water. You can't block water. You can block water from one area. You can't block water all the time. Water is going to sip through it. If you block it, it's going to sip through it. It's going to go up to the sky, and then it's going to rain into the other side. They will find a way to get there. You can't really block it. It's not very easy to push water uphill.
And what are your thoughts on banks complying with U.S. sanctions on Chinese and Hong Kong officials?
Well, I think banks are global businesses. A lot of the government have developed very intrusive, sometimes arguably quite arbitrary tactics when they want to achieve certain policy or political or regulatory goals. So the banks have no choice, and they need to be overly compliant. And sometimes that brings unnecessary and also unfair and unjust consequences to their customers. But as I said before, our societies, our politics today, nothing is free. Every action has cost. It's just sometimes, unfortunately, if you happen to be the one who have to incur the cost, you know, what can you do?
Charles Lee, outgoing CEO of Hong Kong Exchange and Clearing, joining us for our second hour of Balance of Power on Bloomberg Radio. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
I'm Mark Crumpton with Bloomberg's First Word News. New Yorkers can expect a shutdown of all but essential businesses soon after Christmas. That's according to Mayor Bill de Blasio today. Although Governor Andrew Cuomo will make the final decisions, Mayor de Blasio says closures will be similar to what the city experienced last spring, with the exception that schools will remain open. New York has seen its COVID-19 infections and hospitalizations rise in recent weeks. President-elect Biden's team plans to bring the U.S. closer to normalized relations with Cuba. Bloomberg has learned the new administration plans to reverse many of the sanctions and restrictions imposed under President Trump. Still, some measures that target Cuba for human rights abuses could stay in place. Vladimir Putin has become among the last world leaders to congratulate Joe Biden. The Russian president sent Mr. Biden a telegram after the Electoral College formalized Mr. Biden's victory. President Putin wrote that he was, quote, ready for cooperation and contacts with you, end quote. Here at Bloomberg, we're mourning the passing of one of our own. Richard Breslow had a successful career as a trader at Goldman Sachs, Bank of America, and West LB before coming here in 2013. His daily column, called Trader's Notes, was immensely popular with readers. It quickly became a must-read for people in the markets. He was just as popular here in the newsroom. Richard was never too busy to help out a colleague who wanted his insight. We will miss him terribly. Richard Breslow was 61 years old. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
It is 1 p.m. in New York, 6 p.m. in London, and 2 a.m. in Hong Kong. I'm Bonnie Quinn. Welcome to Bloomberg Markets. Here are the top stories we're following on the Bloomberg and from around the world. Clearing the way for a second vaccine, Moderna's COVID vaccine 94% effective at preventing symptomatic illness, according to the FDA. We'll have all the details. Pulling ahead, China surpasses other major economies as industrial output and retail sales strengthen. Does that give China an edge going forward? We'll speak with Leland Miller, China Beige Book International CEO. And Mayor of Stockton, California, Michael Tubbs, will join us to talk about the guaranteed income program he piloted for residents and how the pandemic is disproportionately hitting poor neighborhoods. Let's check the markets now. We did see some risk appetite this morning at the open. That continues now with the S&P 500 pulling away. It's up 1%, actually leaving the NASDAQ behind. The NASDAQ still up about 0.75%. The dollar index is below 90.50. We have a stronger sterling today. The British pound at 110.50 versus the euro, 121.59 versus the US dollar. And yields creeping ever so slowly higher as well. 91.13 on the 10-year. We also see some boost there for crude oil, 47.43 for a barrel of WTI. So then China pulling further ahead of other major economies in November. Industrial output and retail sales strengthened, reinforcing expectations of healthy growth next year. Joining us with more insight is Leland Miller, head of China Beige Book International, which of course surveys thousands of Chinese firms to gauge business conditions in the country. So Leland, there's the official data, and then there's people like you that can give us an inside read. What is your data telling you about China growth?
Well, you know, it's telling us the same story that's been telling us for months and months and months, which is, you know, we're seeing the same things that official data are. We're seeing an improving Chinese economy. We're seeing growth accelerate. We're just not seeing it to the degree that the Chinese government is claiming. There's a political narrative that dictates they have to be back to growth this year. It's very important for the party to show that their successes over the virus. And so if you take away the growth number, which shouldn't be the most important part of this conversation, what we're seeing is very, very close in some ways to what the Chinese are announcing. On the other hand, you know, we're not seeing this year-on-year growth trend improve, and so growth improve year-on-year. So, you know, it's give the Chinese credit for the successes here, but let's not overdo it.
So maybe exaggerated, Leland, but there's no doubt that China has dealt with the economic impact of the pandemic in a different way to the US. Explain how that might give China a leg forward into the new year and beyond, if that's the case.
Well, look, Beijing has tools at its disposal that almost no other country in the world have. They can shut things down, and what they say goes. There's not a personal freedom aspect to it. They also shut things down rather competently, at least after the initial crunch down. So the economy came roaring back much faster than anywhere else. I don't think this would surprise anyone. Their real challenge right now is that their trade surplus is hitting such numbers that it's becoming a politically sensitive issue around the world, including the United States. And I think it's one reason that they're letting their currency appreciate. Because the trade surplus is creating some political uncomfortable moments.
Yeah, Leland, what happens to that surplus? So yeah, you as you point out, we have seen the yuan strengthen offshore. We're actually looking today at 652, which is a long way from where we were this time last year. But that's not taking care of all of the problem. What will China do with that extra?
Well, truth be told, they can't help themselves on this. The recovery from the very beginning has been a supply-side recovery. It was based on the industrial economy gearing back up and going really, really aggressive. So you saw manufacturing do well, commodities do well, property do well. The consumption sector is doing much less well, and that's not just CBB data; that's official data as well. You're seeing retail sales, still doing poorly year over year. So what you have is a supply-side recovery, and what that does is that puts goods into the marketplace, and it causes you trade surplus problems. So they would like for there to be more household consumption. They'd like for there to be more demand at home. But this is the universe they're stuck with for the time being.
Leland, what actually happens if China continues to pull away and the US continues to suffer economic consequences? We're sort of at the limit of what the Federal Reserve can do. Monetary policy can only do so much for the labor economy in the United States. And it looks like whatever fiscal support we get, it's going to be less than what we might have hoped for, or what, ordinary American consumers need. So what happens in that scenario?
Well, there's certainly consequences that have to do with China, but I think the major consequences back home, if we fail ourselves, then we're going to be having real problems, even with the vaccine, hitting the ground right now. We're going to lose a lot of jobs. We're going to have a lot of businesses that go out that can't be resuscitated. So this is really not as much of a China issue as it is a confidence issue on the home front. If the United States does not improve its testing, its vaccination process, its basic the way it deals with the virus, we're at the end for a lot of businesses. There's not going to be a long roadway where these businesses can stay afloat no matter how much Federal Reserve firepower we have. So the clock is ticking, and it's going to be a very, very, very critical time early for the Biden administration.
So, Leland, foreign buyers in the US have disappeared. And when we talk about foreign buyers, we talk largely about China buyers, right? Chinese buyers, just everything from real estate to real assets in general. Where is that money going if it's not coming into countries like the United States and other countries? And is it more than a drop in the bucket, or is it a tiny amount relative to the GDP of China, let's say?
No, look, this was a trend that we were seeing long before coronavirus hit our shores. This has been the last several years. We got rich and fat off the idea of lots of Chinese and Japanese money coming over here and buying our bonds and creating surpluses. But that's at the same time, we were never going to be relying on that for the long run. Coronavirus has made this more difficult. So look, it's a situation where we're going to have to find ways of fixing things back home. There's not a lot of foreign demand we can just be sucking out from around the world. Everyone else is trying to do that to their own economies. There's not a lot out there to fuel the U.S. Economy.
Leland, given the data that you're seeing, what kind of growth figure would you anticipate for China in 2020 and in 2021?
Well, the funny thing is that because we're seeing data that are roughly mildly in contraction still, I think the 2021 numbers will be fantastic. They'll be better than what's being talked about by markets, but that's because markets have sort of absorbed these recent Chinese numbers, which are overjuiced, and so the numbers will be a bit lower. If you have a shut down economy and you go back to real on-year growth and really accelerate from there, you could certainly seeing double-digit GDP growth in China next year. The reality, though, is that you're not seeing the levels of growth Beijing's talking about right now. So it's a little bit of what you will acknowledge now affects what you'll be able to forecast next year.
What will the PBOC do, and how much more does the yuan strengthen, Leland?
Well, look, I mean, if you look where we were 4 years ago when President Trump was just entering office, there was or a little bit before that, you've actually saw a much weaker yuan at that time. I think that they have some ability to continue to appreciate it. They don't want to see a super appreciating yuan. And the fact that the dollar has such potential weakness over the coming months and years has to make them a bit nervous. I think the PBOC's bias would be stability with an upward bias for mild appreciation. But they might got to make sure that doesn't fly off the handle if you see dollar weakening become a long-term trend. So I think what the PBOC wants and will always want is basic stability, but they have to be worried based on the finances of the United States whether we're going to do something on the monetary side which will weaken the dollar and cause problems for the PBOC.
Yeah, and the dollar has been weakening, and it's not quite clear that Janet Yellen won't prefer a weaker dollar scenario. Leland, thank you for joining. Expect to talk to you again very, very soon. That's Leland Miller, China Beige Book International CEO. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Markets. I'm Bonnie Quinn. Now that the administration of the coronavirus vaccine has begun, is the rollout working as it should? Bloomberg TV's Francine Lacroix spoke with Johns Hopkins University senior scholar Dr. Amish Adalja on the matter. Have a listen.
So far, so good. But remember, this is when we're just kind of vaccinating healthcare workers and nursing home residents, so they're kind of a captive audience, much easier to do. Many healthcare workers can be vaccinated at hospitals where they don't have to worry as much about the cold chain. When the real challenge comes is when we're vaccinating people that live in the community and more of the general population. So right now, I suspect everything is going as expected. Hopefully, I'll be vaccinated by the end of this week.
How will hospitals be coping during the holiday season?
It's going to be rough no matter how we look at it, because this vaccine isn't going to have an impact on the patients that are at the hospital today, tomorrow, or next week. And what we know is that we are at record numbers of hospitalizations, and we have a very uncontrolled outbreak all throughout this country. So we do anticipate more people getting hospitalized, more people dying, and hospitals really struggling on a day-to-day basis, worrying about their capacity, worrying about their staffing. So I think it's going to be a dark several weeks ahead.
Dr. Adalja, how much time do you also spend trying to figure out how we roll out the vaccine in countries that don't have the funds that the UK or the US actually have?
I think this is going to be one of the biggest challenges, and this will likely stretch into 2022, especially because the vaccines that we have now, the first-generation vaccines, are all three two-dose vaccines, which are logistically difficult. And some of them, the Pfizer and Moderna, have cold chain requirements that are very hard to establish when you're talking about a place that doesn't have stable electricity, where they have difficulty with ordinary vaccines that require normal refrigerator temperatures. So I do think that likely you're going to probably see second-generation vaccines play a bigger role in the developing world, because it's going to be so challenging. Although there are organizations like the Bill and Melinda Gates Foundation, CEPI, the COVAX consortium that's trying to get vaccines to this part of the world, it's going to be one of the biggest challenges they face, because we're still trying to eradicate polio and eradicate measles in some of those countries. So this is going to be a really Herculean task.
So I keep on reading conflicting reports. It'd be good to get your sense of this one way or the other. Do we know, once you get vaccinated, do we know if you can still transmit disease? Are you still able to pass it on to someone?
This is an open question. We know that the vaccines are very effective at preventing what's called symptomatic disease, but we don't know if they're effective at preventing asymptomatic disease. And if you get infected, despite the vaccine, and you have an asymptomatic case, are you contagious to others? That's something we need to study and know in more detail. I suspect there's some effect. I don't know how high the effect is. And Pfizer and other companies are going to be doing studies to determine whether or not people are getting infected asymptomatically.
Johns Hopkins senior scholar there, Dr. Amish Adalja. And of course, as we know, Johns Hopkins School of Public Health, supported by Michael R. Bloomberg, founder of Bloomberg LP, the parent company of this news network. This is Bloomberg. We have some breaking news out of Europe concerning European bank shares. It is, of course, post the close in Europe, so there are no movement in bank shares. But the European Central Bank is basically asking banks not to pay out a dividend until September of next year. And there are more details as well. So for all of the news and some context, let's send it over to Bloomberg's Paul Gordon with ECB Supervisory Board Chairman Andrea Enria. Paul.
Thank you very much indeed. Yes, I'm joined now by Andrea Enri. He's the chair of the supervisory board, the single supervision mechanism at the ECB. In other words, the top bank supervisor in Europe. A very good day. Thank you for joining me. I know you've had quite a tough day to get this decision out. So you're asking banks to refrain from issuing dividends. You're going to judge them on a case-by-case basis whether they should go ahead when they come and request, yes?
Well, it has been an important day, yes, an important decision, but it is an opening to payments of dividends, actually. So we are enabling banks to pay within a certain threshold, so within a so-called guardrail, and this is a change with respect to where we have been up to today. So it's an important opening, which has been broadly supported in the supervisory board, and which recognize that we are moving slowly back to normal, although we are not in the normality yet.
So broadly supported, which does suggest not everyone supported it.
No, but there was a very broad support,
Okay. So the conditions that you're putting in place, that the limited dividend payouts you will allow on a case-by-case basis, are a bit stricter than those we're seeing recently announced in the UK. They're stricter than we're seeing in the US. Is that going to be a problem for the banking sector in terms of competing for investment, competing for staff and so on?
I don't think so. I mean, the important signal is the opening to dividend payments, and we also gave forward guidance that basically we intend to repeal this recommendation in September when, let's say, when it will come to an end. So we are going back to the ordinary situation in which supervisors will vet the dividend payments decisions by banks in the normal supervisory process on a bank-specific basis.
You could also argue that bank shareholders shouldn't really be getting anything yet as long as the banks themselves are getting the benefits of regulatory relief, the benefits of the TLTROs from the ECB. There is that argument out there. I mean, why have you decided to go ahead and let bank shareholders get something?
Well, there has been an intense discussion in the last months, actually, in my board. On the one hand, we recognize that there has been a reduction in the uncertainty. So now the macroeconomic path is clearer. Our economies has been more resilient, and it seems that by 2022 we would be back to pre-crisis level. That's positive news, and that is what is pushing us to reopen to dividend payments. On the other hand, we still have not a lot of visibility on the asset quality trajectory going forward, on credit risk. And also, as you correctly said, there is a lot of support coming from the central bank, the supervisors, and fiscal policies, which is supporting also bank profits. And this is behind the recommendation to remain prudent in distribution for some time.
What about bonuses? What's your stance there?
Well, we are also prolonging our general recommendation to remain extremely moderate in the payment of bonuses. And also here, however, we are giving forward guidance that by September, we plan to go back to the old normal.
The banks would say, look, they need to pay their staff. They've had a good year in trading for various reasons. And if they can't pay the bonuses, they risk losing their best staff to non-euro area banks. Does that concern you?
Look, we have never asked banks not to pay their bonuses. We have said to banks, be moderate in paying your bonus, consider paying bonus more in instruments, to have maybe more, let's say, postponement of these payments, and so be moderate given the conditions we're working in.
What are you going to be saying to banks when they come to you and say, we want to pay dividends and we want the amount to be such and such? What is your threshold? What is your test?
Well, again, we set these broad, let's say, criteria, and we expect the banks to operate within these boundaries. If the banks operate within these boundaries, the overall ballpark of payments that we expect to be made is in the region between 10, 12 billion, which is approximately 1/3 of a normal year. So we would say that probably this would be reasonable. So we don't expect to have to intervene too much. We have seen already the plans of the banks for distributing. Most of the banks are already deciding to be moderate. So we don't expect to have a great need to vet on a bank-by-bank basis. But of course, we expect banks to engage with us before taking the decision.
Well, precisely, because you're recommending that this is the process that banks undergo. You're saying that banks need to be reasonable. What if banks, any particular bank, wants to be, in your view, unreasonable and make a higher dividend payment? What can you do?
Well, look, I mean, we have been very, very positive of the reaction that the banking sector in Europe had to our first recommendation and to the renewal of that recommendation in July. So banks have followed our guidance quite closely. We expect them to do so also in the near future.
The banking sector as a whole is going to come out of this crisis like the rest of the economy. But you've called many times for the banking sector to restructure, to reduce its cost base, to merge. Is this a message to them now saying, look, OK, we helped you through this. Get your act together once this crisis is over? Because we've heard warnings of a solvency crisis coming.
Yeah, we actually are putting a lot of pressure on banks to move into that direction. But to be honest, that's an area where I see a silver lining in this crisis. Banks have realized when they move to remote provision of services during the crisis that they can really gain a lot in terms of efficiency, profitability, by revising the way in which they provide services, by investing more in new technologies, in digitalization, by revising the number of branches downwards, by cutting staff sometimes, and by refocusing their business model. So we see progress there, and consolidation also is taking up. We've seen some operations. So we see that something is moving in that space, and we are happy about that.
OK. Andrea Enria, thank you very much indeed. Vonnie, Andrea Enria, the chair of the Single Supervisory Mechanism, and banks will, in a limited vein, be allowed to pay dividends again here in the Eurozone. Back to you. And a reassessment next September as well. Paul, thank you for that wonderful interview. That's Bloomberg's Paul Gordon with the ECB Supervisory Board Chairman Andrea Enria. And I do want to point to another headline just crossing the Bloomberg from Portugal. In fact, Portugal is going to tap a restructuring plan which includes losses for creditors. So once again, Portugal is tapping a restructuring plan which will include losses for creditors. We'll have more on all of these European stories as well as plenty more, including the Mayor of Stockton coming up right here on Bloomberg Television. For now, US markets are higher. This is Bloomberg.
Saving for retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
There is a need and a clear need for me to spend money. I need to spend money to boost the economy, the necessary push. And therefore today, as of now, and for this fiscal, I shall not worry about the deficit number.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points. So continuing in this knee-jerk risk-off feel.
I'm Mark Crumpton with Bloomberg's First Word News. Hundreds of hospitals in the United States are gearing up to vaccinate their workers against COVID-19. Packed in dry ice to stay at ultra-frozen temperatures, shipments of Pfizer's vaccine began arriving at 400 additional hospitals and distribution sites, a day after the nation's death toll surpassed 300,000. The first 3 million shots are being earmarked for frontline health workers and elder care patients. Federal regulators today issued a positive review of a second coronavirus vaccine. For the first time, Senate Majority Leader Mitch McConnell is acknowledging that Joe Biden won the presidential election. Speaking on the Senate floor today, Leader McConnell said the U.S. officially has a president-elect, and he congratulated Mr. Biden. He also praised the accomplishments of President Trump and said it's hard to list all Mr. Trump's, quote, major wins. President-elect Biden is back on the campaign trail today. He'll go to Georgia to rally support for the two Democrats in Senate runoff elections next month, John Ossoff and Raphael Warnock. Victories would give the Democrats a majority in the Senate. The crude oil glut left behind by the coronavirus pandemic will clear up by the end of next year. That's according to the International Energy Agency. The IEA says demand will clearly be lower for longer than expected. The agency trimmed forecasts for world fuel consumption following a new wave of lockdowns. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Live from Ontario, I'm Amanda Lang. Welcome to Bloomberg Markets.
And from Bloomberg World Headquarters in New York, I'm Vonnie Quinn. We're now joined by both our Bloomberg and BNN Bloomberg audiences. Here are the top stories we're following from around the world. Moderna's vaccine, safe and effective. A report from the FDA likely clears the way for a second shot now to gain emergency authorization. Wall Street hunkers down. Despite vaccine progress, the reality is sinking in that offices and trading floors will stay mostly empty for months to come. And Stockton, California Mayor Michael Tubbs joins the Mayors for Guaranteed Income program and how his city is faring amid the pandemic. Amanda.
And Vonnie, it is a better session for stocks today, positive sentiment and a fairly broad-based move across the subgroups of the broad S&P 500. We have got a lot of momentum to the upside. We do have a slightly more mixed picture for those heavyweight tech stocks. Despite Apple's 4% advance, some of the other big names, including Facebook, are soft today. But overall, you're seeing an enthusiasm for certain groups. Big Pharma is in focus again. Eli Lilly's up almost 4%. And in the industrials, Deere is up just shy of 3.5% at last check on its outlook. So certainly still reopening, vaccine kind of optimism being priced in here. It is obviously a Fed week, and we'll watch the yield on the 10-year to see whether that creates any kind of pivot away from riskier asset classes. But it is optimism that is well placed today as we learn that Moderna, as Vonnie said, is as efficacious as the company had said, according to the FDA. It is now expected that it might receive emergency use approval as soon as Friday, and doses in arms to follow not long after. Anna Edney is with us now. She covers the FDA for Bloomberg. And Anna, obviously a good day to have more good news, and more volume, I suppose. But give us some context around what happens when both Pfizer and Moderna's vaccines are kind of in the market. Does it obviously more sounds better? Is it actually going to be better to have two different kind of competing vaccines out there?
Yeah, I think in this case, more is helpful because these companies are trying to ramp up their manufacturing to keep pace. There's not going to be nearly enough vaccine for everyone in the U.S. right away, and so they're going to need to do a lot more work to get those millions of doses to people. And in addition, Pfizer's vaccine, while both are very efficacious, Pfizer's vaccine, it needs to be kept extremely cold, so it needs a special freezer. With Moderna coming online, you might be able to get this vaccine to places that weren't able to have those freezers. This just can use kind of your regular household type freezer to keep it.
Anna, just give us the details. 94.1% effective is more than we had thought about the Moderna vaccine, right? And also just clarify, is it one dose or two doses for this particular vaccine?
The 94.1% is right in line with what the company had said. They did kind of an earlier analysis, and then they did a final analysis, and their final numbers came in at 94.1% effective. So the FDA was confirming those. And this Moderna's is a two-dose shot, which is exactly like Pfizer's. With Moderna's, you get your first shot. You'll go back 28 days later to get your second shot. And both of them are also based on this new technology called messenger RNA. It transforms the cells in your body so they can fight the virus. So they're very similar in a lot of ways, particularly with, as you point out, the two-dose regimen that people need to do.
And so far, certainly according to both Health Canada and the FDA, no big concerns on the safety front. Would you expect, as we see the vaccines deployed across a larger group of people, to hear anecdotal stories about reactions and the like, just as the numbers climb up of people who are receiving the doses?
I think certainly there'll be possibly some scares, and they won't be even related to the vaccine. But, just as happens every day in life, people have medical issues, and they're going to happen right after they get a vaccine, and those are going to make their way to the public. And there are many, many people in the federal government who are already trying to gather the background data so they can know whether that kind of event would be related to a vaccine or just a normal thing that happens every day. And they'll be keeping an eye on all kinds of side effects that are likely to crop up to see if there's any relationship or if it's something that that they should normally expect in kind of every, how our bodies respond to everyday life.
So the first doses from Pfizer and the BioNTech vaccine were sent to about 600 sites around the country. Anna, what do we know about where Moderna's will be sent, and roughly how many shots we can get out the door as quickly as possible?
So Moderna will be able to get to more sites than Pfizer's will initially, presumably because of the ability to transport them easier than Pfizer's. And they have said that, this Operation Warp Speed officials have said that between Pfizer and Moderna, they expect there'll be about 20 million people in the U.S. who are able to get their first shot by the end of the year. And those are going to be healthcare workers and people living in long-term care facilities. There are, the CDC estimates about 23 million of those. So the shots that are available will probably reach most of the people that the CDC has said should be prioritized, and then everyone else will start falling in line after that.
Anna, real quick, the stock is down 7.5% right now, but it had been at records. Is it just selling off because now the news is out there, or is there something else going on here?
I imagine it's just because the news is out there. There hasn't been anything negative in relation to the vaccine.
Exactly. Okay, Anna, I just want to mention that year over year, though, Moderna is up, get this, 674%. Our thanks to Bloomberg's Anna Edney. Coming up, we're going to be talking with the mayor of Stockton, California, Michael Tubbs. He has instituted a guaranteed income program for his city's poorest residents. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. This is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Markets. I'm Bonnie Quinn in New York City, alongside Amanda Lang in Ontario. Well, while the debate over stimulus continues in Washington, some U.S. cities are tackling the issue of poverty with a guaranteed income program. One of those cities, Stockton, California. In February, it started a program for 125 residents living at or below the median income line of about $46,000 a year. Joining us now is the mayor of Stockton, Michael Tubbs. Mayor Tubbs, thank you for joining. First, give us some of the statistics about Stockton in the last few months during the pandemic. They make for chilling reading.
Yeah, Stockton, California is the largest city in San Joaquin County. 8% of all deaths in this county this year have been because of COVID-19. It's a city of about 315,000 people, about 20%, 22% at poverty, another 30 to 40% one paycheck away. A city full of resilient, brilliant people, many of whom are essential workers, many of whom who work without the dignity of paid time off and other protections. And that's why sort of our basic income program has been so important. While waiting for action from the federal government, folks have been calling my office saying, I'm a migrant field worker and I'm paid hourly. And if I'm told to quarantine for 2 weeks, how am I going to eat this winter? We have mothers who are talking about the cost of childcare because they're called essential workers and have to continue to go to work without making much at all. So that's why we started our basic income demonstration in 2019 before COVID, but we extended it during COVID because we understood that our residents and people across this country are really hurting at a time when billionaires are making trillions of dollars, when we have millions of people waiting in food banks. And that lack of balance is one that's deeply troubling. And I'm excited about the other mayors who are stepping up to do basic income pilots as well.
Yeah, I mean, it's such an interesting time for that because it's an idea that's been around a long time, the kind of guaranteed income, but we're seeing it kind of take root around the world, but certainly across North America, both in the U.S. and Canada. How has it been? If you could kind of analyze the performance of, people have fears about it, that people will stop working or that it'll sort of become perverted in some way. Did it work? Is it working?
Yeah, and I remember growing up, my mom would always say fear stood for false evidence appearing real, and that's what we see in a lot of the arguments against a income guarantee or a basic income. One of the things you mentioned was this idea that people wouldn't work. We know that the vast majority of people in this country who can work do work, and those who don't work oftentimes can't because of child labor laws or because of a disability or illness or formerly a record of issues with law enforcement maybe. But we also know that the issue isn't that people aren't working, it's that work isn't paying. And we also know that during COVID-19, the issue is that people can't get to work because they're told to quarantine for 2 weeks, or because they're laid off, or because their jobs don't exist anymore, or because their hours have been cut. So even before COVID-19, I was arguing that a guaranteed income makes sense, but it is painfully obvious now at a time, again, when folks are told to stay at home, when people are cutting hours, when small businesses are struggling, when people still have to pay for rent and mortgages, that there has to be some sort of income guarantee, an income floor, because it allows folks to build economic resilience. And what we've seen in Stockton is that the vast majority of people spend money the way me and you spend money. So they spend money on food, on their kids, on utilities. One gentleman talks about how the $500 actually allowed him to take time off work to interview for a better job, which he received, to work more hours with more pay and provide for his family. And then lastly, during COVID-19, we've heard from countless individuals while waiting, again, for Mitch McConnell and the Senate majority to act and pass the stimulus, or waiting for sort of the unemployment benefits they already paid into for months, not because they didn't qualify, but because the system is archaic, that the $500 was a lifeline. It allowed them to keep up with their bills. It allowed them to put something down on rent. It allowed them to buy more food since their kids were home with them all day as schools have been closed.
And, to be clear, this is $500 a month. We're talking about $125 a week or so, and it's not even to everybody. Mayor Tubbs, how much of the population can you give this to, for how long, and where are you getting the income to do that?
Yeah. So the sad part is that we've been able to do this, and now we have 30 other mayors through Mayors for Guaranteed Income doing the same because of generous donors like Jack Dorsey from Twitter. But that is an indictment of the lack of leadership, again, of Mitch McConnell and majority-led Senate, and also just a troubling issue for our country, where we have articles in the Washington Post about people stealing food because they can't eat, about 1 in 8 Americans being hungry this holiday season. And you have mayors like me not going to the government, but going to the private sector to help a small subset of our population. And that's why I've been adamant that the goal behind these pilots are to get to policy, that we clearly need during COVID-19 an income floor, and the mayors and myself and the other mayors are going to be courageous enough to show that we can trust our residents, that we owe it to ourselves to build what Dr. King called the beloved community. And but it has to be a policy at the federal level. And that's why we have sent letters. That's why the U.S. Conference of Mayors has passed a resolution saying as much. And there's literally bills in the House and in the Senate right now that will provide that haven't been brought to the floor to vote because, again, of Mitch McConnell's leadership in the Senate.
Despite a lot of attention to this, and obviously as COVID caught up to it, it seemed like an idea whose time has definitely come. You did lose your re-election bid recently. Was that connected? I mean, to what do you attribute that? And what are your hopes that the program outlives it, that it continues despite the fact that you will not be mayor?
Yeah, well, the program was slated to end in January anyway, and then we extended it for 6 more months. So it will continue as planned to end in January. In terms of my own election, I think there's been countless articles written about the impact of disinformation in a 4-year disinformation campaign rooted in racism and bias, and also on some of the ignorance of many parts of the community that unfortunately in this instance was successful. But I'm very adamant that when I got into elected office as a 22-year-old, that I understood that this wasn't a forever thing, and that anytime you speak about justice, anytime you speak about dignity for all people, and anytime you fight against a failing status quo, there's going to be pushback and backlash. So unfortunately, I won't continue as mayor of Stockton for the 4 more years I had maximum anyway, but I will continue being a voice and fighting for a country that we all deserve to live in. So I'm excited about what's next and thankful for the opportunity to have served my hometown through my whole 20s. I started as a 22-year-old council member, was elected as the youngest mayor ever at 26. Not many 20-year-olds can say they spent their 20s in local government, and I'm so thankful for the opportunity to lead.
Exactly, and you've learned the system as well, Mayor Tubbs. I mean, you've spent 4 years, leading a major city in the United States. Surely your political aspirations are not gone, though. What will you do next? Who have you approached? Who has approached you?
There's so many options out there. So I think over the holidays, my wife and I will sit down and take stock around sort of where can we make the most impact, but then also understanding, to your point, as a 30-year-old, I have at least 40 more years of this. So there's a bunch of things that could be done, whether in government or in private sector, et cetera. But I guarantee you, I will continue pushing for policies like guaranteed income. And I'll continue pushing for us, again, to remember that we're all neighbors, that we all do better when everyone does better, and that we can live in a democracy that treats everyone with dignity. So I'm not sure what position or title that is, but I'm very clear that's the work I'll be doing.
All right, and we'll be watching. Mayor Tubbs, appreciate your time today. It's great to have you with us. Michael Tubbs is the mayor of Stockton, California. Coming up, vaccines may be on the way, but Wall Street still seems set to work from home for the foreseeable future. We'll take a closer look at the implications after this. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I feel really lucky having stared into what felt like an abyss for travel, and then to kind of rally together with thousands of people and rebuild the company from the ground up. Something that I think is stronger than it ever was before the pandemic.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Welcome back to Bloomberg Markets. I'm Amanda Lang in Ontario alongside Bonnie Quinn in New York. And just some breaking news crossing the wires here about President-elect Joe Biden naming Pete Buttigieg as his transportation secretary. So the latest name to be added to the list of those who would be in a Joe Biden presidency. We'll continue to follow that for you. We have also, of course, been watching vaccine rollouts and fresh news on that front today. But even as there's optimism about some kind of post-vaccine return to whatever that normal looks like, it appears that Wall Street is still planning to hunker down beyond the access to vaccines. Jenny Surain is with us now from Bloomberg. Jenny, thanks for being with us. And let's just start with what we understand about Wall Street, because it felt at some point as though they were going to get back to their trading desks and back to their floors. That's not the case. They're shifting gears.
Yeah, it seems like, earlier in the fall and certainly at the end of the summer, there was a lot of optimism from top bank executives that they would be able to have more and more of their staff return to offices. But with this latest wave of cases, especially here in New York, they've already started to see staff in their main headquarter buildings thin out. Some banks like Citigroup have already taken the step of saying, no, actually anyone beyond absolute essential personnel can't come in. And so, you're starting to see them already have to send folks back home.
So I was fascinated to see that BlackRock actually had most of its staff in, Jenny. How do they manage that?
Yeah, Blackstone has most of their investment professionals in, and they're really focused on testing really frequently, and that's something we've seen from a lot of the banks now. As for the folks they do have in, offering a more robust testing program. But for the most part, it does seem like more and more are taking that break a little bit and kind of sending folks back home. But it'll be interesting to kind of see how these next few weeks shake out with the holidays and more folks traveling. It'll be interesting to see how the banks respond.
Yeah, and one question would be how different it is inside New York versus other jurisdictions, and are the banks changing their thinking about where they want to locate?
Yeah, we've seen news in the last week or so from our colleagues reporting about Goldman's ambitions to move to Florida, and big banks like J.P. Morgan and Citigroup, they have lots of satellite offices in Florida and Kentucky, Ohio, places like that. Those places have already been in kind of this resurgence mode. And so we know that they've already been, sending more folks home. And now that kind of same worry has made its way to their New York headquarters, where most of these banks had been really looking to get back up to 30% of staff being back in. So definitely seeing a little bit of a break. And I know even with all this vaccine news, it seems like they kind of still expect that to kind of be the case for the next few months.
Right, and it's interesting the side by side, all the vaccine news, and then of course people still knowing that there's a deadly disease out there. How frequent are the emails urging people to come back these days, Jenny?
I think those have taken a little bit of a different tack now, and it's interesting too. We haven't heard a lot about banks, wanting to get a lot of their employees to the front of the line. I think a lot of these banks understand that healthcare workers or residents of long-term care facilities, those guys are first. And so I think that's part of what's kind of influencing their thinking around this now.
All right, Jenny Surain, thank you so much. A wonderful story about Wall Street hunkering down and preparing for some more months to come before employees can come back en masse into the office. From myself in New York and Amanda Lang in Ontario, this is Bloomberg.
건강 등급이 좋으면 보험료를 더 할인받는 새로운 상식 ABL생명.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I'm Mark Crumpton with Bloomberg's First Word News. President-elect Biden is asking Americans to stay home to mark his inauguration on January 20th. He plans to hold what he's calling an extremely limited swearing-in ceremony to avoid spreading the coronavirus. The Presidential Inaugural Committee will not hold the traditional mass gathering on the National Mall. Biden and Vice President-elect Kamala Harris will take their oaths of office at the U.S. Capitol. The transition to a Biden White House is continuing despite President Trump's refusal to concede. Multiple sources say Secretary of State Mike Pompeo will meet this week with his designated successor, Antony Blinken. It would be the first face-to-face cabinet-level transition contact between the outgoing and incoming administrations. Secretary Pompeo has been one of President Trump's strongest defenders. The nation's top infectious disease expert expects to be vaccinated against COVID-19 as early as this week. It's not just because Dr. Anthony Fauci is still seeing patients. He tells the Washington Post he believes getting inoculated on camera could help boost Americans' confidence that the vaccine is safe to take. Dr. Fauci says between 75% to 85% of the U.S. population must be vaccinated to achieve herd immunity. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
2 p.m. in New York, it is 7 p.m. here in London, and live from Bloomberg's world headquarters. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Kaylee Lyons. Taylor Ricks is off today.
And the bounce back is on. U.S. stocks halting the longest slump since September. The S&P 500 rebounding from a 4-day slide. Every industry group higher on the stimulus hopes. Meanwhile, there's more help on the way. Moderna's vaccine found safe and effective versus COVID-19 in the U.S. ahead of Thursday's meeting on its emergency authorization, building hope on day 2 of Pfizer shots being administered across the country. We hear from one hospital system about the rollout so far. And a last-minute rush for relief. House Speaker Nancy Pelosi reaching out to Senate Majority Leader Mitch McConnell for a meeting on stimulus. That's as leader McConnell recognizes Joe Biden as president-elect for the first time. All that and so much more coming up.
Yeah, Caroline, a lot of confidence really coming back into this market today. I guess you can tie some of that to the prospects for fiscal stimulus finally making its way through Congress, it appears. You see the S&P 500 here up 1%. The Russell 2000, once again, your outperformer on the day, up more than 2%. And materials, though, interesting move here. We talk a lot about how commodities are a really good barometer of current sentiment about economic conditions. Well, materials, the stocks there, that gives you a little bit of a clue into the sentiment, looking out a little bit forward here. So you're seeing not only sort of the asphalt makers like Vulcan, the chemical companies, packaging stocks on fire today. Keep an eye on that sector as we move forward, because that could be an interesting barometer. Of course, we're also keeping an eye on treasuries. You're looking at 10-year treasury futures right now, down again for a second day ahead of that Fed announcement tomorrow afternoon. And wow, the dollar, the trend line on the dollar continues to be lower, below that 11.27 mark. Remember, that was your low back in 2018. Right now, the technicals seem to suggest that we could see further dollar weakness, Kaylee.
All right, Romain, well, let's talk a little bit more about fixed income because Treasury yields are moving higher today to the tune of around 2 basis points on the 10-year note, right now sitting around 91, 92 basis points, but still stubbornly below that 1% threshold we last breached in March. Time and again, yields have tried to break to that level, and time and again, they have retreated. The question is whether that changes this week, depending on what we're going to hear out of the Fed tomorrow. And since there are just a handful of trading days left in 2020, I do want to look at what's expected for the Treasury market into next year. There is broad bearish consensus. Most strategists seeing that yields will move higher over the next 12 months. I would point out, though, as what we're looking at here, they basically always think that. The average forecast in every year for the past decade has been that yields will move higher. And as we know, that hasn't always happened, Caroline.
What's the definition of insanity again? I wonder. Kaylee Lyons. Great, thank you so much. Let's focus in now on where yields are going. Let's get to it with the outlook for fixed income with Nick Maroutsas. He is, of course, head of global bonds over at Janus Henderson, who joins us from Newport Beach, California. Nick, it's always great to get your voice on the show. Where do you think yields are going?
Look, I don't think they're going to move materially higher. Positive news around equity markets. Obviously, the vaccine distribution is a huge. But ultimately, at longer term, bond yields are going to stay relatively in check. Permanent employment as a result of this crisis, we're still not out of the woods entirely, even though the vaccine is happening. You could see a bounce in yield in what the Fed does this week and with the vaccine news, but I think that you're going to stay low for longer.
Nick, I mean, the market isn't expecting, obviously, any change in benchmark rates. They do seem to be expecting some sort of update, I guess, on these Treasury purchases and whether that duration gets extended. I mean, our market participants right now may be a little too presumptuous that the Fed is going to do anything at this stage.
That's exactly what I mean. The market will likely be disappointed to some extent if it doesn't issue some form of forward guidance. You know, Powell, it's in his nature to try to outdove the doves, and he's done that previously through communication and other programs they've put in place. But I think it's okay for them to disappoint the market. Going on, you have markets at all-time highs. They've continued their purchasing program. Like I said, the distribution of the vaccine is happening. Save that bullet for when it's heightened. Georgia election that's coming up the first week in June, which is going to be telltale sign as to what the fiscal stimulus plan is going to look like. And if it doesn't go the market's way, then that's when the Fed can look to act. But ultimately, I think that they will, and you will see some form of guidance or yield curve control because it's really not in the best interest to move significantly higher. It is okay for them to push higher over a period of time, slowly, because ultimately higher yields is a good thing for the economy. It's not really good for the market right now.
Nick, you mentioned yield curve control there as a possible option. Do you think the Fed would actually formally adopt that?
You know what, Kaylee? I don't think they will. They need to be very particular because the market tends to digest every single word, every single change in words. That they might issue some form of forward, but you will hear a lot more rhetoric come out of their mouths when it comes about where the yield is, which is why firm believers that the yield curve is going to steepen materially because standing behind there, and they can actually keep yield pretty aggressively. Not to mention the fact that, and what about previously is that, you know, globally, U.S. yields they're pretty attractive on a relative basis compared to other sovereign markets, and ultimately, when things there is a flight to quality, be to treasuries.
I was going to go exactly there. When you look at global bonds, as in your name tag, I'm interested in where else does look in any way attractive. Where else are you putting your money? If you're thinking that there's a cap on yields in the US and perhaps it's the most attractive game in town, how much further are you going down the food chain into corporate, into high yield?
So that's the million-dollar question, Caroline, and there's no doubt that our opportunity set within the fixed income market is shrinking. There's fewer and fewer compelling opportunities. It's really difficult to call spreads wide at this point. The caution against investment, particularly in this late in the game when it comes to where we are in terms of how much things have appreciated is to move down the capital structure too aggressively, because the further you move down the capital structure, higher yield or emerging market debt doesn't mean that it's not attractive, but it doesn't provide those effects that traditional fixed really does. What we're trying to do is we're looking globally in unique markets or Australia, Canada, New Zealand, parts of Asia, ex-Japan, particularly the U.S. dollar denominated assets, and we're trying to take advantage of the new issue market where possible, because that's ultimately where you're getting some decent value. We're also focusing on the front end of interest rate, because we believe that has the highest ratio in terms of central banks not interest rates for a significant period of time. You take out the volume of the back end, whether or not yields go to 1, 1.5, or even move 25 basis points, it largely doesn't matter for us because we're focused the front ends.
So what's the reaction function at the front end of the curve here, Nick? I mean, we're looking at a 2-year a couple of sessions ago that was retesting those all-time lows. Is this purely a function right now of whatever policy change the Fed makes, or is there something more going on the front end of the curve that we should be paying attention to?
So, Romain, I don't think there's much more going on than we already know in the front end. I think people are trying to look for yield where they can, and let's face it, 11 is really not that exciting, particularly when equity markets are up 2% in a particular day, right? It's hard to make a case for a decent amount of yield in that space. But for us, it becomes, again, more about where is this risk that you can take in the fixed income market, and that continues to be the front end, because, like I said earlier, the bar for central banks to be hiking interest rates is right now. The Fed has said they're not going to be hiking it. Not 2020, notoriously been over-promising and deliver. If you look back to the crisis back in, they waited 7 years to start hiking interest rates.
Yeah.
The year they promised 4, and they only did 1. The following year, they promised another 4, and they only did 1. So our expectation is going to be on for much, much longer than what people think, because they're going to have to unwind a lot of this stimulus, make sure that we're out of the woods entirely.
Nick, always a pleasure to get you on this program, get your thoughts on things. Nick, we're going to have to leave it there. That's Nick Marutzis, head of global bonds over at Janus Henderson. Now, coming up, a lot more on this program. The next stamp of approval, the Moderna vaccine found safe in an FDA report. We're going to talk about how that second shot could boost the country's immunization efforts. Plus, a negative outlook. We're going to speak to Emily Rams of Moody's. We're going to talk about the long-term impact of the economy on state and local governments. Taylor's gone, but Muni moment persists. And let it snow, let it snow, let it snow. If you live in the Northeast, brace for the biggest snowfall that we've seen so far this season. Could have a big impact for anybody up and down the I-95 corridor. All that and more coming up next from New York and London. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
Progress continues to be made on the COVID-19 vaccine front. Moderna, in all likelihood, set to become the second vaccine candidate approved by the U.S. after an FDA staff report released this morning found it safe and effective. And of course, Pfizer has already begun to roll out its vaccine this week. But the fact of the matter is, it could be months before enough of the country is vaccinated to achieve herd immunity. And in the meantime, the virus is continuing to rage. You can see cases climbing here on GTV Go and hospitalizations climbing as well from New York to California. 3 of 5 regions in California are now under mandatory lockdown. And here in New York, Mayor Bill de Blasio saying today, we can expect a shutdown of all essential businesses soon after Christmas. So things could get a whole lot worse before they get better, Romaine.
All right, for more, let's bring in Dr. Dan Roth. He's the Chief Clinical Officer over at Trinity Health. It's a health system that operates 93 hospitals in 22 states, as well as 120 continuing care locations, such as home care, hospice, senior living facilities, that type of thing. Dr. Roth joining us today from Livonia, Michigan. Beautiful Livonia. Hey, so Dr. Roth, let's start off here with the general idea of what's being approved and how it was being approved. Generally, the FDA process is pretty long. You go through a process to try to determine not only whether the drug works, but whether it's also safe. Based on the speed of which this made it through the system, how confident are you in both of those two metrics?
Thanks, Romaine, and it's great being with you today. We're very confident, and we think that the process that the FDA and the CDC has followed really struck the great balance between having a treatment and a vaccine that's available as quickly as possible, given the pace and the impact of the pandemic, as well as making sure it's safe. As we know, they waited 60 days after at least half of the participants had been in the process. And so that's almost 50,000 people between the two studies, making sure that it was safe. And the data that we've seen now, both from Pfizer and then starting today with Moderna, has shown an effectiveness of the vaccines that was really in excess of our expectations. We did not expect to see almost 90% or greater than 90% effectiveness. So on both accounts, we're very comfortable that these vaccines are a great next step and are safe.
Dr. Roth, from a distribution perspective, you're on the ground, you're seeing how Pfizer is being disseminated, the vaccine through your hospitals and senior care facilities. You're going to look at Moderna, which arguably is a little bit easier as it needs less freezing temperatures. But from your perspective, compared to other vaccines, how difficult is this to get into people's arms?
It's slightly more difficult, but it's not undoable. We've been preparing for this for months. We've known about the ultra cold chain requirements for Pfizer, and we've been preparing for that. And I think the work that Pfizer has done, and we've been in contact with them, as well as the FDA and the CDC has made that process that we're going to be able to navigate very well and make this available not just for our own healthcare workers, but for the community. So we're prepared for that. I think we can make it work. It's not as hard as it seems. We just have to be thoughtful about the process, and I think we're very prepared for that. Obviously, the Moderna vaccine does not have that same degree of requirement. That will make it a little bit easier, but I think we're prepared, and we'll make sure that we can get vaccines to people, because this is the beginning of the end of the pandemic, and that's the most important thing.
Dr. Roth, I mentioned at the top of this segment New York and California, where the issue is hospitalization capacity that is really on the brink. How is Trinity Health doing in terms of capacity? Where do your hospitals stand right now?
So it's a difficult time. There's no doubt about that, both across the country and for Trinity Health. And the irony, right, of facing this highest surge yet. So we are at a peak of the number of hospitalized patients with COVID that we've seen yet in the last couple of weeks. We've hit that peak, and that has created a significant strain for us, and in particular our care providers. And so we're managing it, but I will admit it is a significant strain, especially for caregivers who have been going at this for 9 months. And so it does have an impact on our ability to provide services in some locations outside of COVID, which we don't want to do because we know that it has a broader health impact as well. But we work hard to be able to maintain critical services for everybody. But it is not lost on us that while we're trying to roll out the vaccine, we are facing the highest impact of COVID in all of our communities across the country, and across we have more than 2,000 people in our hospitals with COVID today.
So the impact is, by many measures right now, doctors, surpassing what we saw back in the spring, March, April or so. With regards to the preparation and the abilities of healthcare providers to deal with the influx of patients and, more importantly, to keep the death rate down, how much better or worse are we now than we were back in March?
So there are a number of things which are much better today compared to the spring, and that has made it doable because we are, as you point out, at a much higher level of hospitalized patients impacted by COVID today than we were even in April. But we know that that the treatments that have come to the fore over the course of the last few months, as well as our learning and healthcare is learning about how to better care for patients with COVID-19, have made a significant impact. We've seen our mortality rates decrease by more than half on patients who were admitted to the hospital, and our time in the hospital has also been cut by almost half as well. So that has made that burden more doable, and obviously, most importantly, better outcomes for people. And that's not to minimize the impact on these patients and their families, particularly the 3,000 people a day who are passing. But we are in a much better position.
Are you being able to vaccinate your own staff as quickly as you'd wish?
Well, I think we would love to have as many people vaccinated as quickly as possible. It was heartwarming, I will admit, on a personal basis, to see our nurses, ER nurses, and physicians and ICU nurses being vaccinated in a couple of our markets yesterday. And so it's heartwarming for us, and it's been a long time coming, and we know that's the beginning of the end. We obviously want to get this as quickly as possible. We know the process will take a little bit of time this week and over the course of the next few weeks in order for us to get to everybody. But we are ready to go and started even yesterday.
Dr. Roth, would you advocate for locking regions back down as an interim measure until more people can be vaccinated?
I think at this point in time, some of that varies by market, but I think what we have to do is do what we know works. And what we know works is masking, physical distancing, avoiding gatherings, both gatherings in small and large settings, and using hand hygiene. We know that those work. We have to do them as a country. We have to do them together and consistently. We know if we can do that, we think we can really put a dent in the number of cases, especially with the holidays coming up. That becomes a critically important part. So I don't know that we have a position on locking down as much as we want to make sure that everybody is doing those things that we know work, especially wearing masks.
We want to thank you so much for taking some time with us when you've got so much else on your plate. Wonderful to hear some of the heartwarming stories from Dr. Dan Roth, of course, Trinity Health Chief Clinical Officer there. We have breaking news for you. Of course, the ongoing stimulus will they, won't they debate over in Congress. And we currently understand that Mitch McConnell, of course, majority leader of the Senate as it stands, is again suggesting putting off state aid and liability. But he says that they won't leave for the year without a relief package. At the moment, the markets have been trading higher on the hopes of the stimulus deal coming as soon as today. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
Time now for a quick check on the latest business flash headlines. Credit Suisse Group signaled that business continued a mixed performance in the fourth quarter. The investment bank is doing well with higher revenue than it was a year ago, but Credit Suisse warns that write-downs and legal provisions will weigh on earnings. It's the latest sign that the U.S. economy is hitting a snag. A growing percentage of American homeowners are looking to delay mortgage payments. In the first week of December, the proportion of mortgage borrowers that started seeking forbearance relief rose to its highest level since August. That's according to the Mortgage Bankers Association, and that could eventually lead to more foreclosures. And the New York area is bracing for what could be the worst December snowstorm in a decade. The National Weather Service says a foot or more of snow could blanket the mid-Atlantic and Northeast starting Wednesday. The storm threatens to snarl road, rail, and air traffic just as trucks carrying Pfizer's COVID-19 vaccine from Michigan fan out nationwide, and carriers are busy with holiday package. The New York City Department of Sanitation has declared a snow alert and suspended outdoor dining on city streets starting at 2 p.m. New York time on Wednesday. And guys, I want to talk more about the snowstorm, A, because it really gets me in the holiday spirit. I love snow, but also because we have a really cool function to highlight on the Bloomberg terminal. This is Map Weather Go, and it can show you the probability of snow in the Northeast region. Tomorrow, it is above 90%. We could get 12 to 18 inches of snow here in New York. And as I just discussed, maybe a snow day is not that exciting with everyone working from home, but it really could impact some of the critical transportation infrastructure, both in terms of the vaccine and everybody trying to get out their Christmas presents. Caroline.
That's such a good point. I'm sad personally to be missing the snow, but I wish that it doesn't impede the vaccine in any way, shape or form. Meanwhile, I'm shining a light on probably what would be one of the most talked about stories if we weren't in the middle of a global pandemic. And it's this unbelievable rampage of, well, cyber hacks that are going on in the US. At the moment, we understand that at least 25 entities have been victims thus far, but there could be up to 18,000. So says SolarWinds, which is, of course, well, the software maker that's seen itself the vulnerable element here that seems to have been spreading this particular attack. We understand it's the Russians that are behind it, an elite group of Russians, we understand. FarEye first found it, but keep an eye out, Romain.
You know, Caroline, there's a Fed meeting tomorrow. Kaylee, there's a Fed meeting tomorrow as well. Let's hope they don't get snowed in down there at the Eccles building. You take a look at this next chart here. You get some sense here of this idea, this negative rate environment. Everybody was betting on it. Basically, you take a look at that chart and you see that box that's highlighted there. You're talking about contracts going out to December 2021, March 2022, and June 2022. So 12 months, 15 and 18 months. Back in the summer, everyone said negative rates were we're going to see. You saw those trades start to get pulled back, reassessed in August, and completely unwound in September. You see where we're at now. Nobody's expecting a negative rate environment, but they are expecting snow.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger,
We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I'm Mark Crumpton with Bloomberg's First Word News. President-elect Biden is asking a former rival to join his administration. Bloomberg has learned the president-elect has chosen former South Bend, Indiana Mayor Pete Buttigieg to be his transportation secretary. Buttigieg was one of the most high-profile rivals to Mr. Biden during the Democratic primaries, narrowly winning the Iowa caucuses. He later endorsed Mr. Biden after dropping out of the race. If approved by the Senate, Buttigieg will become the first openly gay person to lead the U.S. Department of Transportation. Hundreds of hospitals in the United States are gearing up to vaccinate their workers against COVID-19. Packed in dry ice to stay at ultra-frozen temperatures, shipments of Pfizer's vaccine began arriving at 400 additional hospitals and distribution sites a day after the nation's death toll surpassed 300,000. The first 3 million shots are being earmarked for frontline health workers and elder care patients. Federal regulators today issued a positive review of a second coronavirus vaccine. As we've been reporting, New Yorkers can expect a shutdown of all but essential businesses soon after Christmas. That's according to Mayor Bill de Blasio today. Although Governor Andrew Cuomo will make the final decisions, de Blasio says closures will be similar to what the city experienced last spring. With the exception that schools will remain open, New York City has seen its COVID-19 infections and hospitalizations rise in recent weeks. President-elect Biden's team plans to bring the U.S. closer to normalized relations with Cuba. Bloomberg's learned the new administration plans to reverse many of the sanctions and restrictions imposed under President Trump. Still, some measures that target Cuba for human rights abuses would stay in place. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Kaylee Lyons.
A little after 2:30 here in New York. Let's get you caught up here right now on settlement of NYMEX crude futures, flirting at one point here with almost $48 a barrel. Of course, there was some negative reports here about demand in 2021 coming out of the IEA, but some of the optimism here surrounding the vaccine providing a little bit of a boost. Gold actually getting a bid here today. Of course, people looking at that additional stimulus. Of course, the idea of lower for longer rates and a weaker dollar, and that continues that bid into gold. Lumber price is interesting. We hit about $845, a record on intraday on lumber futures on this day, something that's pretty rare. You don't see this time of year, but right now, one trader that Bloomberg News spoke to basically said that lumber buyers are basically living hand to mouth at this point, Caroline.
One to keep a close eye on. Meanwhile, we go from commodities remain over to the world of credit markets, because without a doubt, sure, yields are pushing a bit higher today, but interest rates ultra low right now. Credit investors everywhere anxious to put their money to work. For more on, well, what to expect in the new year, let's bring in Bloomberg Shonali Bassett with one of the biggest voices in the industry. Shonali.
Thank you, Caroline. And joining me now exclusively is Carlyle's Mark Jenkins, the global head of credit for the $53 billion credit business at Carlyle. Mark, thank you for joining us.
Thank you for having me.
It sure does seem that investors are impatient. They're anxious to get money to work. What are you telling them?
Well, I think what we're recognizing today is, and we spoke back in August, is that we, typically go through, a phase of like survival in credit when there's a dislocation to recovery to prospering. And right now, we've really experienced a lot of those in a very compressed period of time. So what we're telling people now is, for credits that have actually prospered in this environment, and there have been a number of them in the healthcare and tech space, we're looking to just invest in them in a regular way credits as going concerns. There's a lot of opportunities where companies are looking to transition, if you will, to look to the end of this pandemic, which thankfully with the vaccine seems to be coming near to an end, and how we can help those companies get there. And then finally, a lot of people are talking about the distress cycle, which we're not seeing just yet, but we're watching very closely. So it's really looking at all three of those strategies in tandem.
Right. So your colleague, Jason Thomas, had written this report recently, and it really points to the spike in the high-yield default rates. It makes the point that we're at historically high levels of indebtedness of corporate America. How are some of these issues concerning you?
Well, I think, as Jason wrote in that paper, that we've got a spike, obviously, in leverage in companies. I think we also, with the low interest rates, are actually at debt service levels that are actually comparable to, sort of more prosperous times, if you will. But I think that the main concern is that we've now got companies who've solved their liquidity issue. And the question is, are they actually solvent? So i.e., is their going concern value going to outweigh the amount of debt indebtedness that they have? And in particular, when we get to the other side of this pandemic, will those capital structures support that new world of growth that we're going to experience for those companies? And I think that's really the focus of that paper, is to say we've dampened, probably for the next 12, 24 months, we've dampened that default cycle, right, but we've really pushed that issue out.
Well, if we push that issue out, there's a lot of talk about the zombification of companies. How are you thinking about that issue?
Yeah, I mean, for us, it's an opportunity to some extent, but also it's also a threat. So when we're investing in transitional companies that we believe when they get to the other end, when they actually, when we come out of this pandemic and there is a more sustained recovery, that those capital structures are actually going to work. And that's really transitional capital, helping companies get to the other side with an appropriate capital structure. So there's a lot of those opportunities because some of those companies just don't have access to the regular way capital markets. And then secondly, it's identifying, following, and figuring out how to get involved in these companies that are going to have to go through some sort of restructuring. And so really, again, it's pursuing two strategies in tandem on behalf of our investors. Mm-hmm. And that's enhanced by the fact that today, really understanding the enterprise value as business models are going to change as we come out of this pandemic, is really leveraging the platform of a broader firm to help understand those business model changes that we're seeing in our broader portfolio today.
As a credit investor, another question that is underpinning the market is inflation. What are your inflation expectations?
Well, I think I'm a credit investor. I'm not a good macro investor, so I won't put my point of view out there. I think what I would say in terms of inflation, what I would worry about as we come out of this pandemic and through into a recovery is there's a lot of pent up demand, right? There's been so much demand destruction in certain areas. And also there's issues around the globe with global trade agreements or lack thereof, and the type of disruptions that's causing supply chains. So I believe that as we come out of this, I'm more concerned about the bottlenecks and inflationary pressure in certain areas that affect certain industries as opposed to macro inflation. But certainly, over a long period of time, would we expect some inflation? Sure. But, I'm more focused on how it affects the underwriting of credit in specific industries.
Well, speaking of specific industries, you pointed to the idea that we might start to see some more distress. How does that start and when does that start to play out? The Fed has really lifted a lot of tides this year, and I think that idea of distress is something a lot of people are looking to get to work in.
Yeah. Well, I mean, if you think about what's happened so far, really 2/3 of the defaults and sort of restructurings that have happened have really occurred in retail and energy. I'm sure you've heard that before. And those were sectors that were having troubles before the pandemic. So it just accelerated that. To your point, a lot of companies have just been, given that liquidity bridge to some point in time. And really it's going to impact companies that can adopt to this new environment, where if you look at our anybody's portfolio right now, what you've noticed is the winners have been the ones who've been able to adapt technology to interact with consumers and businesses in a more effective, efficient way. And there's going to be plenty of companies that aren't going to adapt to that. And I think they're going to have capital structures that will require restructuring. Right. And that's where we're going to focus.
So it's early next year, finally, the time for you to start distress investing a bit more.
I think it's still early. I mean, what's happened is the ability to enter, like when you distress invest, I mean, you have to enter into that either through a company either going through a process or us buying their securities in the secondary market. And the challenge right now is because everybody's been provided with liquidity, prices are high to buy in the secondary, point one. And number two, people have that liquidity line to keep them going. So I actually think, we'll start, I don't want to predict, but it just doesn't feel like, we're going to see a rush of distress in 2021.
Mark, thank you so much for joining us. That was Mark Jenkins, Carlyle's Global Head of Credit. Romaine, back to you.
All right, thanks, Shanali. Coming up here next on this program, Carvana, the shares there at one point today at a record high. We're going to talk about why the online used car seller getting a vote of confidence from some analysts out there. It's our stock of the hour. Coming up next, this is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
With a new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
Let's talk deals now, because earlier this year, Goldman Sachs appointed new co-heads to lead the bank's M&A unit. Stefan Feldgois, who has been with the bank since the late 90s, sat down with Bloomberg senior deals reporter Ed Hammond to discuss what the activity he's seeing as a very unusual year wraps up. Take a listen.
2020 was certainly what I'll call a barbell year. The first third of the year was quite active up until the pandemic. In the pandemic, we certainly hit what I'll call an air pocket. But as you say, coming out of the pandemic, it's been an extraordinary level of M&A at the highest levels we have seen. Now, some of that was pent-up demand, but as you look at the fundamental drivers of M&A, so equity markets at significant levels, debt markets and the banks being very willing to lend, those fundamental drivers remain in place. So as you look towards 2021, you feel that the support or the fundamental drivers of M&A remain very strong.
And David Solomon this morning gave an interview saying he was concerned about the euphoria in the market, I think specifically referring to the IPO market. Are you similarly anxious about just the level of activity we're seeing in the M&A market at the moment?
So I certainly wouldn't characterize the M&A markets as euphoric. I think what I'd say is that the fundamental drivers, in addition to what we talked about before about companies thinking differently or more broadly about risk and where M&A should happen, are really the fundamental drivers. I won't comment on the IPO markets, but again, when you look at the fundamental drivers of M&A, CEO confidence, equity markets, debt markets, risk in a different light, in a different lens, all of those remain, I'd say, as fundamental drivers that continue to drive the M&A market.
And in terms of fundamental drivers on the side of the seller, obviously a lot of companies have seen their own valuations crushed and maybe recover less than some of the potential acquirers out there. What does that mean in terms of just the dynamics of some of these conversations? Are we going to see more unsolicited activity, more pure hostile activity, or indeed more activity driven by the sort of activist investor campaigns that we got so used to in the years maybe 15 to 18?
So I think a couple of things I would say. You certainly see more stock deals. So a seller who may not feel that their valuation has achieved what they would like would be willing to take equity in a transaction and participate in the synergies and the upside. You also see significant activity from activists. During the pandemic, activists backed off to a degree as it wasn't as active a period. But certainly now and going forward, activists will continue to push, and we see them being very active in many, many different markets.
In terms of the advisory part of deals, which obviously is where you spent most of your career, talk to me about how that's changed during the pandemic, from the pure physical changes of not actually being in the room with a lot of the people making the decisions to actually the way that the deals are being played out and perhaps around the timeline of getting done.
So the timeline hasn't really been extended in M&A. I think what we found during the pandemic is that we were impressed by the amount of transactions and the number of transactions that were actually able to be done all or nearly virtually all from a virtual perspective. Zoom and other methods of interaction were very effective. And of course, M&A is about relationships, but we found that was able to be carried on during the pandemic through virtual interactions. And so you certainly saw a lot of activity that carried forward regardless of the pandemic.
Do you think it will ever return to the sort of pre-pandemic world of bankers being on airplanes all the time, flying to and from clients?
I think it'll be somewhere in between. Client meetings, seeing clients, seeing people will still be a very important part of M&A. That being said, certain things like data rooms, which were electronic, certain things like management presentations can be done very effectively over virtual networks, but still there will certainly be a return of getting on an airplane and going to see people and people getting together.
All right, co-head of global M&A over at Goldman Sachs, speaking a little bit earlier with Ed Hammond, our deals report. Let's turn from that now to our stock of the hour. We're talking about Carvana today, getting a vote of confidence over at Truist, which is adding it to its performance. In a year when city dwellers find reasons to buy used cars, Carvana, let's just get to the shares. Right now, up 3% on the day. Dave Wilson joining us right now, talking about a stock, Dave, that's almost tripled already this year. What's going on? How much higher can it go?
That's the real question. It isn't just about this year because the stock more than doubled last year, too. It's up more than 17-fold since the company went public back in April 2017. They sell used cars through these dealerships that they call car vending machines. This year, they shifted and allowed people to buy cars entirely online. Sell them, too. You get them delivered. You get a 7-day return policy. And so even though the company's had this history of losses, analysts not expecting an adjusted profit until the third quarter of 2022, according to our data, I mean, the company's just taken off, $40 billion plus market value. And so now you have Truist Securities. Naved Khan, he's an analyst who focuses on the e-commerce business, coming in, giving the stock a buy rating, and setting a 12-month share price estimate of $314. That's the highest projection among 21 analysts in a Bloomberg survey. And among other things, he figures they'll be able to expand their vehicle selection, increase their coverage geographically, deliver faster. People getting more familiar with the brand. I mean, Carvana's television advertising is certainly a part of that. He also notes the auto dealership business, kind of a fragmented market. I mean, the top 100 dealers with less than 10% of the total market share, and relatively few vehicles sold online, less than 1% back in 2018. So there's a lot of room for Carvana to grow here, even to the point where he figures it's an $85 billion revenue company in 10 years.
Yeah, everyone out there buying cars. Carvana, our stock of the hour. Dave Wilson bringing us that. Of course, those shares up 3% here on the day. Coming up next here on this program, lawmakers in Washington negotiating another stimulus package that could be passed before year-end, but state and local governments, they fear rising costs and weakening revenue growth into early 2021. This is the moment I've been waiting for. Taylor's gone. Muni moment with Romaine and Caroline. Emily Rames of Moody's Investor Service joining us after the break. This is Bloomberg.
I think we have a lot to be optimistic about in this country, but in the near term, even with these vaccines, Moderna and Pfizer, we just got to allow them to be given to the people who need them the most, but that's going to take more than 6 months.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
All right, time now for our top calls to look at some of the movers on the back of analyst recommendations. First up, take a look at Marriott, upgraded to buy over at Citigroup alongside its peers, Hilton and Host Hotels. Citi turning bullish on the broader lodging sector and says the space stands at the beginning of a multi-year recovery. Shares up 2.5%. Next up, let's take a look at Redfin. Right now, trading at a record high. The price target being raised to a street high, 73 over at Piper. The analyst says real estate tailwinds could continue into 2021, given the favorable demographics and those economic conditions. You see the shares here up 5% on the day. Finally, let's take a look at Tenet Healthcare. Getting an upgrade today to buy over at Deutsche Bank, street high, $69 price target. The analysts citing the recent purchase of Surge Center Development. This is an efficient use of capital, according to the analysts over there, saying they should be immediately accretive to earnings. Shares here up 6% on the day. And Kelly, those are some of our top calls.
All right, Romaine, well, time for the moment you've been waiting for, the Muni moment. A bipartisan group of lawmakers outlining their proposal for a $908 billion stimulus stimulus package. But the proposal is split into two parts with a separate bill for aid to state and local governments. Joining us now to discuss is Emily Rames. She is Vice President and Senior Credit Officer with Moody's Investor Service. Emily, it's great to have you. It's unclear at this point if this will even pass, but the one that seems most likely to pass is the core bill that doesn't include that state and local aid. If that doesn't happen, what kind of additional pressure could that put on state and local budgets?
Sure, and Kaylee, thanks so much for having me. We are not expecting another round of federal stimulus in our ratings on state and local governments, our outlook for state and local governments. We're not expecting it. They got one big round already. What we have seen historically is that the federal government has supported state and local governments in downturns. So it is possible they will pass another round. We're not expecting it at this time. I will say that there are a number of state and local governments, the areas that rely a lot on travel and tourism, those areas that are hoping for it.
Certainly hoping for it. When do we start to see the lagged effect? Because it doesn't all happen right at once.
Sure. We're seeing a lot of state and local governments that are having a very challenging economic environment, business conditions, but a number of them, in fact, most of them, their budgets are okay and their revenues are doing okay. And that's because they've gotten that first round of federal assistance, the CARES Act, that really helped them. Most of them budgeted very conservatively for the current fiscal year they're in, and most of them came into this situation very well prepared. They had, a lot of reserves, a lot built up, so they're doing okay for now. Depending on how long this pandemic lasts, how long the recession lasts, we could start to see that revenues start to really take a hit.
Yeah.
That would most likely be in the sort of the areas that are most hit by this pandemic. So that would be sales taxes, hotel taxes, things like that have been the most hit, as well as areas like public transit that have not yet returned. Areas like personal income taxes and property taxes have held up well so far and would probably continue to do so.
Let's zero on one state, and we can maybe talk some examples here real quick, Emily. We'll focus on my home state of Illinois, obviously a bit of a sort of budgetary basket case prior to COVID-19, but it seems like they've actually weathered the storm relatively well, given some of the obligations, particularly on the pension side, that they're still grappling with.
Sure. Illinois is our lowest rated state, and as you said, it's due to that outsized pension obligation. They are looking for some kind of help, some kind of assistance through this so that they can afford those obligations in the future. On November 3rd, we saw voters in the state rejected a constitutional amendment that would have allowed a progressive income tax, which would have provided billions of dollars the state could have used. So the failure of that constitutional amendment means it's probably more likely that the state might borrow money for some of its obligations. On the other hand, states have a lot of powers.
Yeah.
They can increase other taxes. They could do spending cuts, and those things, there are things that could be done without voter approval. So the ability to do those things and the likelihood that they will do those things does kind of mitigate the impact.
Emily, great to have you on. Emily Rames, Senior Credit Officer, Vice President over at Moody's. All right, let's get a quick check of where we stand here on the broader market. Stocks right now pretty much hovering around the highs of the day. You're looking at S&P 500 reaching for a 1% gain. You're actually seeing the Russell 2000, your small caps, your mid caps as well, up more than 2% here on the day. Commodities also getting a boost. Looking at that rebound in crude. WTI right now trading near $48 a barrel. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
I'm Mark Crumpton with Bloomberg's First Word News. President-elect Biden is asking Americans to stay home to mark his inauguration on January 20th. He plans to hold what he's calling an extremely limited swearing-in ceremony to avoid spreading the coronavirus. The Presidential Inaugural Committee will not hold the traditional mass gathering on the National Mall. Mr. Biden and Vice President-elect Kamala Harris will take their oaths at the U.S. Capitol. For the first time, Senate Majority Leader Mitch McConnell is acknowledging that Mr. Biden won the presidential election. Leader McConnell spoke on the Senate floor this morning.
As of this morning, our country has officially a president-elect and a vice president-elect. So today I want to congratulate President-elect Joe Biden. The President-elect is no stranger to the Senate. He's devoted himself to public service for many years.
Leader McConnell also praised President Trump, saying it's hard to list all the president's, quote, major wins. But McConnell refused to acknowledge Biden's win until now, saying that Mr. Trump was entitled to pursue his claims in court. The New York area is bracing for what could be the worst December snowstorm in a decade, and the only person happy about that is Kaylee Lyons. The National Weather Service says a foot or more of snow could blanket the mid-Atlantic and Northeast starting Wednesday. The storm threatens to snarl road, rail, and air traffic just as trucks carrying Pfizer's COVID-19 vaccine from Michigan fan out nationwide, and carriers are busy with holiday packages as well. Here at Bloomberg, we're mourning the passing of one of our own. Richard Breslow had a successful career as a trader at Goldman Sachs, Bank of America, and West LB before coming here in 2013. His daily column was called Trader's Notes. It was immensely popular with readers. It quickly became a must-read for people in the markets. He was just as popular here in the newsroom. Richard was never too busy to help a colleague who wanted his insight. We will miss him terribly. Richard Breslow was just 61 years old.
We are counting you down to the close. Just 1 hour left in trading. I'm Caroline Hyde.
And look at this. Stocks right now near their highs of the day. I'm Romaine Bostic.
And I'm Kaylee Lyons. Taylor Riggs is off today. And at the highs of the day, Romaine, and no surprise when you look beneath the surface, you can see a risk on tone. Almost everything is green. 450 roughly of the stocks in the S&P 500 are higher on the day, and every single sector is as well. What's notable, leading the charge, is those cyclical trades that were under the most pressure in yesterday's session. You have energy, materials, financials higher. Take a look at that. 100% of the members in those sectors are in the green on the day. And I want to point out utilities as well. That index heading for its best day since November 2nd. And I think that has a lot to do with the snow we're about to get, Romaine.
Yeah, and take a look at some of the individual movers today. Eli Lilly and Prevail, the two big M&A names of the day. Eli Lilly buying Prevail. You see Prevail up 82% on the day, but that move in Eli Lilly, a lot of people really excited about this. It gives Eli Lilly a huge entry into that gene therapy space, potentially, not only for the drug that Prevail is developing, but really for a broader array of treatments that could come out of this. A lot of positive news there. Plug Power up here on reports of it having a deal with Walmart, a distribution deal with Walmart, giving the shares as much as 13%. And Nike moving higher on the day. At one point, it was actually at a record high. Don't forget, we get Nike earnings later this week. And I point out Nike today because it's actually the biggest jump in volume today, other than Snowflake. But the volume here right now on Nike, at least as far as large cap stocks go, double the average here. So right now, you're looking at investors positioning ahead of those earnings, which are actually going to come this week, Caroline, on Friday, believe it or not. We'll see how they stack up against Adidas.
You say Adidas, I say Adidas. You say Nike, I say Nike. Meanwhile, I'm going to be looking at what's happening in terms of the stimulus. Everyone is desperately waiting on tenterhooks as to whether will they, won't they, what size of a deal, whether it will go to the state and local municipalities. But notably, people are starting to worry in the market that it might not be big enough. Notably, we were speaking, of course, Bloomberg TV just yesterday with the head of Lazard's advisory business, that being Peter Orzeg. He worries about the size and scope of any sort of deal. Take a listen.
We are bumping up against a real constraint. Eviction rules are scheduled to expire at the end of December. Parts of the additional unemployment benefits that were provided as part of the CARES Act scheduled to expire at the end of December. State and local governments facing 15% declines in revenue for their next fiscal year. There will be more pain coming unless we act aggressively.
Businesses hurting, people hurting, many hoping that those paychecks and any sort of support can come through quickly, certainly to support the economy, remain to support the markets too.
Yeah, let's talk a little bit more about that and bring in George Borey. He's head of fixed income strategy and portfolio specialist at Wells Fargo Asset Management. George, great to have you here on this day. Let's first talk about the short-term news of the day. The Fed, of course, going to make an announcement tomorrow. The expectations a bit mixed here in the market. Any sense here that what the Fed either does or what they telegraphs tomorrow could have any sort of ramifications right now for how traders are positioned?
Yeah, sure. Good afternoon, Romaine. Thanks for having me on the show. As you point out, if you look at the fixed income markets, the bond market, we're basically in a pause mode waiting for the Fed. And the Fed this is going to be an important meeting, an important announcement. And we think it could really break one of three ways. They could try and preserve their optionality, which means they don't give the market any new information. And they basically just sort of state where we are and say that they're willing to react depending on how the economy evolves. That probably leads to higher interest rates. It's the Fed not guiding interest rates lower, not providing additional stimulus, not providing additional clarity as it relates to the trajectory of yields. In that scenario, yields go higher. The other alternative is they sort of commit themselves or become very clear about their forward expectations. Where do they expect to be 12 and 24 months out? Now, in that scenario, that probably keeps yields pretty stable, but the curve could probably steepen a bit there as the front end stays anchored, but the long end maybe kind of continues to rise a bit. And then the last is, and I think this is where a lot of folks are kind of hanging their hat and hoping for some clarity, that the Fed provides guidance with respect to yield curve control. We don't believe that they're going to be explicit about yield curve control. They may include that as a potential strategy. We don't think we're going to get a lot of clarity there. But if they were to provide that clarity, that would actually cause yields to come down and perhaps the curve to even flatten. So this is going to set the stage for at least the beginning of next year and perhaps a large percentage of next year. We think your best bet right now is that the Fed just basically extends out some of that forward guidance and tries to preserve as much optionality as possible.
So within all those scenarios, within the optionality that the Fed wants to buy itself, what's the optionality for an investor? Do you stay committed to sovereign debt? Do you go lower down into higher yielding sorts of parts of the market?
I think there's a very good chance of a cyclical recovery, or we think there's a very good chance of a cyclical recovery. We were talking about that earlier on the show. And if you just look at the equity market, obviously the equity market's doing great. Cyclical names are doing quite well. We're seeing a recovery in the oil sector. In fixed income, it's harder to play just a pure cyclical recovery. You have really kind of two components. One is just a simple fundamental strategy. And here we're strongly advocating that clients be willing to go down in credit rating, go down into high yield, go down into the lower rating parts of the credit markets, and really trying to position yourself for that cyclical recovery. Energy as a sector is largely represented in the high yield market. And so you can almost make a soft bet on energy simply by buying high yield. And we would certainly advocate that. We think energy is going to do well next year. The other is just simply the shape of the yield curve. And as we've seen up until very recently, the yield curve has been steepening. And so we've been trying to pull that bias down the yield curve, try and stay invested towards the front end of the curve, letting longer term yields kind of shake out. We want to be kind of neutral duration sort of overall. So that would be kind of our highest conviction view, if you will, short duration, short maturity, high yield, that lower maturity profile, but a lower rating, a much higher yield, say 3.5%, maybe as high as 4%, looks pretty good going into next year, especially if we get that cyclical recovery that kind of helps the fundamentals of those companies kind of improve as we go into next year.
Well, George, continuing to look ahead into next year, this year we have seen record corporate issuance volume, something like 32% above the previous record from back in 2017. Does that appetite, that demand continue?
We think that demand remains pretty robust for fixed income in general. Although yields are likely to go up modestly, they're still likely to stay low by historical standards. A 10-year yield at, let's say, 1.5%, which is where we think we could get to by the end of next year, is still very, very low by historical standards. The other is that if we look at the U.S. versus the rest of the world, right now the U.S. makes up 90% of all positive yielding debt in the world. That's a tremendous statistic, and that other investors from around the world continue to come into the U.S. So we see a good reason why investors are going to continue to stick with high yield. It's still the corner of the portfolio, the anchor, the cornerstone. It's a big part of your portfolio. The incremental yield is absolutely critical, and we don't see clients or investors giving up on that. And I think that's going to be sort of a really strong theme. Now, as it relates to the amount of money that companies need to issue, it's probably going to drop down to a more kind of what we would call typical year, where you're maybe at $1 trillion or 1.2 trillion for, say, investment grade debt, maybe about 200 billion for high yield. So let's just call it maybe 1.5 trillion, which is materially lower than this year, so may show some degree of a technical squeeze, but is much more in line with what we've seen over the prior 3, 4, 5 years before 2020.
The supply-demand debate. George Bory sticking. We thank you very much indeed, Head of Fixed Income Strategy and Portfolio Specialists at Wells Fargo Asset Management. Great to have some thoughts with you today. Now, coming up, China heads for a recovery, while the country is on pace for strong growth next year, even though, well, it still has a long way to go. Meanwhile, a sharp blade after a huge week of IPOs. We look at the company that's going public via a SPAC. Another one. We speak with the CEO and co-founder, Rob Weisenthal, on what impacted his decision. And keep wishing why online dollar store Wish is losing momentum just as it files for an IPO. All that and so much more coming up. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis. but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising. All right, welcome back to Bloomberg Markets. The close 46 minutes, counting you down to the close. Let's take a look at where stocks stand. Right now, you're looking at the S&P 500 right near the highs of the day. The Russell 2000 small caps outperforming, seventh day in the past 10 sessions. Keep an eye on that cyclical trade, dollar weakness. You flip up the board, you take a look at some of the individual movers. Apple shares on fire today, up 4%. Biggest one-day move that we've seen for 2 months now is that report out of Nikkei Asia about production. Seemed to be relatively bullish on iPhone production. You're seeing the suppliers, Qorvo, Cirrus Logic, Skyworks, all of them, all moving higher. AMD, not an Apple supplier, but moving higher at a record high right now. Larger bullish sentiment out there right now on the chip sector, particularly for companies that make those graphics chips used in video games. Caroline.
So on the heartbeat across the markets, we're keeping an eye also on what Charles Lee is doing as he's leaving office after 10 years as chief executive of Hong Kong Exchanges and Clearing. He spoke with Bloomberg's Sophie Kamarudin about the future of Hong Kong relationship with the mainland. Take a listen.
The Chinese market will never be like the international market in its entirety, never be able to suit into a Chinese market. But there will be enough, middle ground where they do intersect. It is in that intersection that Hong Kong have to find the most relevant role to play, because Shanghai will play in that role. Singapore will play in their role, other people will play in their role, but Hong Kong is the only one who can truly go between and need to find a way, because that role initially is small, becoming bigger and bigger, and then eventually stabilize so that the American will still be here, the Chinese will be here, there will be something in the middle. Then when that middle size is no longer growing, then Hong Kong just need to go deeper.
Now, there was momentum towards embracing Chinese assets. We've seen index compilers, for example, including those equities on their indices. That has stalled somewhat given the U.S. sanctions imposed by the Trump administration. What are the implications of that on China's attempts to integrate into the global markets and its liberalization on the mainland, as well as Hong Kong's role in this?
If you look at that global map, invariably you will walk away with the conclusion that China is the place where yield is going to be, because fundamental economic development is stronger there. The consumer class is growing there. The people are getting more wealthy. The currency is becoming stronger, and their supply chain is as resilient, as strong as ever. While this decoupling will continue to put stress on the respective economies of each other, I think relatively speaking, the Chinese market will become increasingly more important for global investors. So, yeah, government, policy makers, individual political figures can always do whatever they wanted to do that could potentially create short-term temporary impact on a more localized target. But as I said, finance money is like a water. You can't block water. You can block water from one area. You can't block water all the time. Water is going to sip through it. If you block it, it's going to sip through it. It's going to go up to the sky, and then it's going to rain into the other side. They will find a way to get there. You can't really block it. It's not very easy to push water uphill.
And what are your thoughts on banks complying
with
with
Hong
US
Kong
sanctions?
Exchange's outgoing chief executive, Charles Lee. All right, time now for Options Insight with Abigail Doolittle, where, Abigail, you're starting out with credit ETFs.
Indeed we are, Kelly. Thanks so much. And joining us today is Chris Murphy of Susquehanna. And Chris, you're making a very interesting point here that everything basically is going higher, at least today, breaking a bit of a losing streak, in fact, for the S&P 500. But credit, not so much. What do you see happening here?
Yeah, so hey, Abigail. So fixed income ETFs have had massive inflows this year. You're talking HYG, LQD, et cetera. However, there are some signs that's reversing this month. Last week, LQD had $2.2 billion in outflows. That's the largest weekly outflow in 27 weeks. HYG saw outflows of $430 million yesterday and hasn't seen a day with inflows since December 3rd, losing $2.7 billion over that time. On top of that, we've seen an increased amount of hedging in LQD, HYG, JNK, et cetera. We highlighted that last week, and then even today, a buyer of 10,000 each of the March 77.84 and 78.83 put spreads in the HYG. Why the put spreads? Well, put skew is really high in these fixed income products, and that's part of the reason we've been recommending these put spreads. We've even also been highlighting put spread collars. They set up attractively due to these same option wings, these out-of-the-money calls and puts being bid up compared to the at-the-money, and a high downside max payout compared to premium spent. Particularly like those put spread collars because they take advantage of the skew but also short the call above all-time highs, and it's just hard to see much upside past all-time highs given how tight spreads are and how low rates currently are. So what's the trade? This morning we looked at the LQD March 135, 128 put spread versus selling the March 141 calls, set up for only 0.5% of spot cost with a max payout of close to 6 times outlay. 141 is well above the all-time highs from earlier this year.
And that is certainly some trend week after week of outflows for HYG, something to keep in mind. And IPOs, all of these hot mega IPOs, DoorDash and Airbnb last week. DoorDash options started trading today, Airbnb options tomorrow. What are you seeing there?
First off, where did they set the volatility? It's around 80% 2 or 3 months out. That's similar to Tesla, in fact, even a little bit higher. That's going to give you implied one standard deviation move of 5%, so move at least 5% one every 3 days, and move at least 10% one time a month. Early on, we're seeing more puts trading than the calls. This might be due to investors who are long the IPO looking to hedge significant gains that they've had so far. It could also be out-of-the-money put sellers who didn't get in on the IPO looking to sell puts to get in position to buy a dip.
So we'll have to wait for some more data, some more trading action over the next several weeks to see whether or not that options trading cools down a little bit. But right now, it certainly looks like there could be lots of volatility ahead for DoorDash and Airbnb, similar to Tesla. Chris Murphy of Susquehanna, thanks so much for joining us for Options Insight. And from New York, this is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
There's a need and a clear need for me to spend money. I need to spend money to boost the economy, the necessary push. And therefore today, as of now, and for this fiscal, I shall not worry about the deficit number.
Bank of America's fund manager survey for December came out this morning, and it showed investors have the highest allocation toward EM equities since all the way back in November of 2010. But not all emerging markets have benefited from this trend. Actually, Middle Eastern stocks have lagged far behind. Saudi stocks, as we can see, they're only up 3% on the year. In Dubai, in Bahrain, and the Emirates, they have all lagged the gains we've seen in the broader emerging markets index, which is up about 12% over the past 12 months or so. The question is, does the recovery in oil prices, does the rollout of the vaccine fundamentally change the narrative for Middle Eastern stocks? Well, for more of the latest on all of the emerging action, joining us now is Daybreak Asia anchor Sherry An. Sherry, what are analysts saying about the prospects for Middle Eastern equities?
Things may be looking up, especially as you mentioned, we had a vaccine rollout. Many of these countries have already secured vaccines, either from Pfizer or BioNTech or China's backed Sinopharm. So United Securities now seeing momentum in the UAE, Qatar, as well as Saudi Arabia, saying that there's more active foreign money invested in those markets. When it comes to the UAE, it offers attractive valuations as well. Although Telemer is saying that perhaps Gulf countries could be missing out in the rebound in tourism, given that they're not that geared towards tourists. Still, markets like Dubai and Egypt could be favored. MUFG Bank saying that they're very, very bullish on oil, so they remain very positive on the sectors in emerging markets in the Middle East going into 2021, especially in those cyclically sensitive markets like the UAE.
Let's move more global. What about India? I'm hearing some strong recommendations there.
Yeah, India is already a market that has rallied substantially this year, right? We're talking about an 11% gain year to date for the Sensex. We have seen foreign investors pouring money into the Indian markets, about $20 billion. That would be the biggest amount since any year since 2012. BNP Paribas, very bullish on Indian stocks. It puts a target for the Sensex for next year, 50,500, which would be a gain of about 10% from current levels. And they're saying that Indian stocks are getting bigger. That's a good thing. And also they're seeing more availability of quality stocks. So they like those consumer stocks, private banks, and insurance companies as well.
All right, you're going to talk about that data out of Asia or not, Sherry?
Yeah, because that's really what's supporting sentiment across the region, right? Chinese eco data look pretty good. November activity data, retail sales, industrial production, fixed asset investment, all coming great, as you can see on this GTV chart on the Bloomberg. And of course, this having to do with export growth, consumer spending during Singles Day last month, accounting for e-commerce taking up about 25% of those retail sales. Goldman Sachs now upgrading the Chinese economy and growth to 2.4% from 2%. And tonight, do watch out for those eco numbers coming out of Japan, trade balance, also the jobless rate out of South Korea.
All right, Sherry An, we'll definitely be tuning in for that. Sherry An, of course, the host of Bloomberg Daybreak Australia and Daybreak Asia. All right, let's turn that back now to the U.S. Take a look. S&P 500 right now up near that 3,700 level. You take a look at the Russell 2000 outperforming the S&P here. Seventh time we've seen this in 10 sessions here. The NASDAQ composite also is higher on the day. You're seeing persistent dollar weakness here, heavy dollar weakness here, of course. The Fed, of course, assembling the FOMC down at the Eccles building in Washington, D.C. We'll get that announcement tomorrow. Commodities continue their rally. We'll be back in a moment from New York and London. This is Bloomberg.
once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonises it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
I'm Mark Crumpton with First Word News. Hundreds of hospitals in the United States are gearing up to vaccinate their workers against COVID-19. Packed in dry ice to stay ultra-frozen temperatures, shipments of Pfizer's vaccine began arriving at 400 additional hospitals and distribution sites a day after the nation's death toll surpassed 300,000. The first 3 million shots are being earmarked for frontline health workers and elder care patients. Federal regulators today issued a positive review of a second coronavirus vaccine. Senate Majority Leader Mitch McConnell congratulated Democrat Joe Biden as president-elect today. The Republican leader's statement, delivered in a speech on the Senate floor, ends weeks of silence over President Trump's defeat. It came a day after electors met and officially affirmed Mr. Biden's election win. As he departed Wilmington, Delaware to campaign for Democrats in the Georgia runoffs for U.S. Senate, Mr. Biden told reporters that he called Leader McConnell to thank him for those remarks.
I had a good conversation with Mitch McConnell today. I called him to thank him for the congratulations. Told him, although we disagree on a lot of things, there's things we can work together on. We've always been straight with one another, and we agreed we'd get together sooner than later. And I'm looking forward to working with him.
In his remarks, Leader McConnell said, quote, "Many of us had hoped the presidential election would yield a different result, but our system of government has the processes to determine who will be sworn in on January 20th. The Electoral College has spoken," end quote. President-elect Biden is asking a former rival to join his administration. Bloomberg has learned that Mr. Biden has chosen former South Bend, Indiana Mayor Pete Buttigieg to be his transportation secretary. Mayor Buttigieg was one of the most high-profile rivals to Biden during the Democratic primaries, narrowly winning the Iowa caucuses. He later endorsed Biden after dropping out of the race. If approved by the U.S. Senate, Buttigieg will become the first openly gay person to lead the Transportation Department. The transition to a Biden White House continues despite President Trump's refusal to concede. Multiple sources say Secretary of State Mike Pompeo will meet this week with his designated successor, Antony Blinken. It would be the first face-to-face cabinet-level transition contact between the outgoing and incoming administrations. Secretary Pompeo has been one of President Trump's strongest defenders. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Just about half an hour left in the trading day. This is Countdown to the Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Kaylee Lyons in for Taylor Riggs. Well, it is a risk-on day. There is a lot of green on my screen right here. Every single sector in the S&P 500 is higher on the day, Romaine, and it's the reflation trade really leading the charge. Financial stocks, some of the biggest point contributors to the S&P 500, stocks like JP Morgan, Bank of America. You also have materials and energy higher. Topping the pack, though, utilities on pace for its best day since November. We could get 12 to 18 inches of snow here in New York tomorrow. Romaine, not sure if you've heard that yet, but maybe we're going to need to crank up the heat.
Yeah, really preparing for that snow. Let's take a look at some of the individual movers. Fannie Mae and Freddie Mac taking a leg down. This after that Wall Street Journal story basically said that Steve Mnuchin said he's not going to do anything to release these companies from government control during the final weeks here of the Trump administration. This is going to be up to Biden. The market betting that's not going to happen anytime soon. AGCO getting a leg up. The analysts there out raising this stock, basically saying that if you're looking for a good rebound play, a recovery play, an economic recovery play, machinery stocks are it, and specifically singled out AGCO. Had a similar thesis here from another analyst on the Real, also saying this could be an interesting rebound play. Of course, the consignment clothes company and Camping World. Keep an eye on this company. Of course, the retailer of RVs and motor homes. The CEO said he's going to have a press conference at 4 p.m. today with the CEO of Lordstown Motors, the developer, of course, of those EV vehicles. They didn't say specifically what it's about, but you put two and two together, you can figure it out. Investors like what they see. Those shares, Caroline, up 11%.
And Romaine, it's interesting, Kaylee, talking about the risk-on mood today. Well, interestingly, the latest high-flying IPOs, Airbnb, DoorDash, they're on the downside today. So too are some of the IPO indices that we track, the Renaissance one, for example, and indeed the SPAC index that we look at. But despite this, just look at how far we have come in these particular areas of the market that have so outperformed amid the pandemic. I look at what these special purpose acquisition company indices have been telling us. I mean, it's phenomenal, run up some 40% over the course of this year. We see the IPO index doing even better than that, far surpassing where the S&P 500 has come. And that's when the S&P 500 has done pretty well too. So it's notable, all of this, but the individual IPOs and SPACs are still coming through, and we're going to speak to one of them now. Air charter company Blade will go public via a reverse merger with a KSL Capital-sponsored blank check company. For more on the decision to go public via the all-so-hot SPAC route, we're joined by Rob Weisenthal, CEO and co-founder of Blade Urban Air Mobility. We know your choppers, we know your helicopters, charter flights. Rob, did you always plan to go public? Is this opportunistic, or is this something that was always in the ground plan?
I mean, ground mobility has totally been transformed by battery technology and software. And you can see it by the SPACs that you're talking about in terms of everything from ground charging stations across networks and actually electric vehicles themselves. They've transformed ground mobility, and the next battle is clearly in the air. And there's never been an opportunity to invest in something specifically geared towards this. We've been building infrastructure and technology from consumer to cockpit over the past 6 years, a customer experience, a trusted brand, 200,000 flyers. We've done it under an asset-light model, using conventional helicopters so that at some point, some people say 2022 or 2023, our model's 2025, we'll be able to use this entire stack to swap out helicopters for what we call eVTOL, electric vertical takeoff or landing aircraft that are both, emit no carbons, are quiet, and more cost effective.
All right, so talk a little bit more about that asset model. Of course, Caroline and I, we get the company official Sikorsky into work every morning, so our eco blueprint is a little bit worse than that. I am curious as to whether the structure of this business is dependent on keeping, I guess, the asset light model, or whether maybe you do get to a point where you feel it might be more beneficial to have a little bit more asset control.
I don't think that's necessary. And in fact, one of the best ways of looking at Blade is that, we are in a way, an index play on eVTOL. So you have manufacturers pouring billions of dollars into individual aircraft. we don't know who the winner is going to be. This allows us to pick the right equipment for the mission, whether it be a short mission. We do a lot of organ movements. We're the largest mover of organs in the Northeast with Blade Metamobility. We have long distance missions. So even right now, we use a variety of different types of helicopters depending on what the proper mission is. And with respect to eVTOL, we'll be able to help pick and choose what makes sense for us and be able to, once winners have been identified, use them and not be stuck with one particular type of aircraft. If we went asset heavy, not only would reduce our return on assets, but it would reduce our overall flexibility.
So with all this in mind, Rob, what are you expecting for your business going forward into 2021 with a vaccine rolling out? And how have you seen it change over the course of the pandemic, especially in regard to your clientele?
Well, not unlike many other businesses, the pandemic's impacted us in ways that we really did not expect. And in fact, in October, our revenues and number of flights are up versus October last year before the pandemic. People have actually created, and Bloomberg actually wrote this in online, synthetic suburbs. They're taking homes that may have been secondary homes that are now co-primary homes that could be up to 90 miles away. And they're commuting maybe once a week for 2 nights, every other week, as opposed to every single day. But it's really enabling them to live outside the normal sphere of where they used to live in the city. And what's been interesting about that is that it has improved our economics because they're no longer kind of flying out on a weekend where the actual helicopters to go empty or flying back on a Sunday. We're filled in both directions and we're flying 7 days a week, albeit probably not at the volume we had before. Additionally, our forecast did not assume any type of vaccine, which clearly is not only coming, but we believe there's a lot of pent-up demand for travel, and there are a lot of people who want to get back to work.
Rob, we've got 1 minute. The exact first use case of the funds you're currently raising?
The terms of the funds that we're raising, the SPAC that we're merging into is $275 million in terms of cash and trust, and we raised a PIPE of committed common capital of $125 million from terrific investors like H.G. Vora and Hedosvia, David Geffen, Barry Diller, and David Zaslav, certain original investors, which is committed capital. This will go to purchase infrastructure such as heliports, landing zones that can not only be used today, where we can enjoy better economics, but also can be used for eVTOL in the future and using legacy aviation metrics. So it's a great way for us to bulk up, improve our business today, but also prepare for eVTOL tomorrow.
Rob, we really appreciate you coming on, talking about this. Of course, at least those of us in New York, very familiar with the Blade copters out there, over there on the west side. Rob Weisenthal, he's a co-founder and CEO of Blade. Blade looking to come public to the markets. We'll be back in a moment. From New York and London, this is Bloomberg.
For retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
All right, welcome back to Bloomberg Markets. The close about 15 minutes ago until the close. Keeping an eye right now on snow. Abigail Doolittle here with the weather report.
I don't know about a weather report, Romaine, but I love your enthusiasm for snow, and I have to say I'm looking forward to myself. As for our stock of the hour, that is Snowflake, because shares are now down for a third day in a row. The worst 3 days since this stock IPO'd back on September 15th, down about 13%. Today, coming off the lows, at the lows, down about 8%. This, of course, as shares have come up off of expiration around that IPO. So you have a flood of supply. Initially, it hit the stock, now coming off a little bit. But since that IPO, my gosh, let's take a look at the gains since the IPO, because this stock is up nearly 200%. At the highs before the recent selling, this stock had actually been up closer to 3 times from its IPO price. So investors want in on these big software, these big tech IPOs this year. Everybody wondering whether or not the frenzy is sustainable. So it makes sense that we do have a short interest, a pretty significant short interest for a lot of these names, Snowflake included. But Snowflake doesn't have the worst short interest. Take a look at Rocket, the 27% bearish short interest. That means that there's lots of bears out there who think that these stocks will not hold their gains. GoodRx, and then Snowflake's right there in the middle, 21%. Unity, 14%. Anything above 5% is suspect. So many traders out there seem to think that these stocks, that these big gains may not last. And then finally, it's going to be interesting to see whether analysts follow through, because relative to a number of the big IPOs recently, we are looking at 9 buys, 12 holds. So most analysts, most experts on these stocks are on the sidelines. Sell, 1 sell.
All right, Abigail, thanks very much. It begs the question, what's going to happen with Wish, another possible $1 billion plus IPO that prices tonight? Stay with us. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
I feel really lucky having stared into what felt like an abyss for travel, and then to kind of rally together with thousands of people and rebuild the company from the ground up, something that I think is stronger than it ever was before the pandemic.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Countdown to the Close. I'm Caroline Hine. I'm Kaylee Lyons.
I'm Romaine Bostick.
And the hopes, the prayers on stimulus sends us higher across the board. Check out the benchmark indices today. Your star performer, the outperformer in the blue, of course, is your small caps. Once again, overcoming and overwhelming where we see the performance in the S&P 500. But really, all the indices pretty much on fire today. The risk on mood taking us up by more than a percentage point on the S&P, currently up 1.2%, so about 43 points higher. But we're pretty much rising across the board. Every industry group has been in the green today, Romaine.
Yeah, although you're seeing a little bit of a lag here in tech, and you're seeing a little bit of lag in discretionary. What's not lagging, energy stocks, pretty much on fire. That trade, remember, gained a lot of traction last week, lost some ground yesterday, gaining it back today. Halliburton up almost 6% on the day. Hess up almost 4%. The paper and packaging stocks also moving higher here on some relatively encouraging data with regards to container boards, all that stuff people are buying there online. So you're seeing WestRock get a bit higher, up about 3%. International Paper, Sealed Air also moving higher as well. The Philadelphia Semiconductor Index also regaining some ground here. Biotechs, which of course had been on fire, taking a little bit of a breather today, down fractionally, Kaylee.
All right, well, let's get some more market analysis now. We're joined by Angela Mwanza. She is a private wealth advisor and senior portfolio manager over at UBS. Angela, I want to ask you about the level of bullishness out there right now. Bank of America put out its fund manager survey earlier this morning for December, showed investors are most optimistic on risk since back in 2011, and cash allocation is down to 4%. They say that level of cash allocation, which is the first time it's been underweight in over a decade, means it's a sell signal. Does that concern you?
It's interesting. We're not seeing. We're actually talking to people about, not sitting on the sidelines with cash. So a little bit of the opposite. And the concern there is that, we have negative yields. You're not earning anything on that cash. It's hard to time when you're going to get that cash back into the market. And generally, equities outperform most of the time. And as long-term investors, and if you look at a 20-year time horizon, 100% of the time your equities will outperform. We too are risk on. And we too think that there's good upside and good reason to be upside in the market, but we are mindful of certain risks out there.
Certain risks, such as whether or not we get a fiscal deal, what the Fed says later this week. Focus on the first one for us, Angela, the here and the now. How much is already priced in terms of the size, the scope of a fiscal stimulus coming from the US?
I think the reason why you're seeing markets rally again is because there is a lot of optimism around a fiscal stimulus, which I think is good news. That should be our bridge over until there's more widespread access to the vaccine. And I don't think we necessarily have to, when you have the balance sheet ballooning a little bit more, government deficits already at an all-time high. We already saw the Fed doing asset purchases of $3 trillion. So there could be concern that there might be inflation on the horizon, which generally would mean we'd start seeing interest rates rise, which I think is probably the biggest trigger of recessions historically. We don't think that's necessarily the case because that stimulus is something that's necessary to make up for slack in the economy, particularly around labor and commodities. And so in a case like that, high inflation would be really, really difficult to achieve. And so we are also pro-cyclical. We think we definitely do have a reopening trade in the intermediate and long term, and it's just in the short term where we'll see things a little bit more bumpy.
The inflation argument, Angela, for those that believe it is around the corner, always seemed tenuous to me. And I am curious as to when you hear certain members of the Fed sort of raise concerns about it, and obviously they're talking much more longer term. I mean, what would sort of be, I guess, the lead on that? Because through all of what we've seen through the bull market of the previous bull market we've been through, and even through the relative boom that we've had, at least in some areas of the economy this year, you just haven't seen that reflected dramatically in consumer prices or in producer prices.
That's very true. That's very true, Ahmed. And I think, when it comes to looking at this reflation, the economic growth that's pointing towards higher inflation, I don't know that there's necessarily those signals. That specifically the Fed, just in summer, we went from looking towards a 2% target, looking at current rates, to a 2% inflation rate target over a period of time with deliberate vagueness around what over a period of time means, because they are looking at the fact that if inflation starts peaking, they don't want to have their hand forced into raising rates when they don't think that the economy is standing on its own 2 feet yet. That being said, for portfolios, we do like Treasury inflation protected securities, TIPS. We think they make sense. If you look over a 10-year time horizon, if you think inflation is going to be higher than the break-even rate where it is now, it makes sense to hold TIPS. So a nice inflation hedge as part of the portfolio, and we could consider throwing in a little gold while we're at it.
Yeah, 10-year break-even right now that sits at about 1.92. Of course, we were down at about 55 basis points back in March. We're speaking here with Angela Mwanza of UBS. We're going to get back to her in a moment. Counting you down to the close 5 minutes ago. Abigail Doolittle, where do we stand in the markets?
Well, Romaine, we certainly have a rally on our hands. In fact, the S&P 500 up for the first time in 5 days, up 1.2%, the best day in about 3 weeks. And you were mentioning earlier the breadth from sector perspective. Take a look at this. Energy up 1.7%. We also have the financials up 1.5%. So those reflation sectors, the reopening rotation, that part of the trade is on. But so too is tech. Take a look at Apple, up 4.9% on that report from Nikkei that they may be planning to up their production by 30% for iPhones. That's bringing the entire complex higher. Take a look at Skyworks, up 3.7%. However, it's not all rosy, because if we take a look at the VIX in a range, we've looked at this chart before in the Bloomberg terminal, we see the VIX has been trading between about 20 and 40 over the last 6 months or so. Right now, rounding off the bottom, the RSI is rising. It may just suggest that you could see that VIX go back to 40. Leading the way, possibly, Romaine, very interesting. We have both Moderna and Pfizer, the vaccine-related stocks, down on the day. Some sell the news action here. Will this lead the markets lower in the days, weeks ahead? It's hard to know, Romaine, but right now we certainly have some bearish action, and it may suggest that there could be a little bit of cooling off at some point for the broader markets, Romaine.
All right, Caroline?
It's interesting. I'll pick it up from here, Abigail, that perhaps an awful lot of this is priced in when we look at the vaccine companies and how far they've traveled so far, the phenomenal rally that we've seen in the likes of Moderna over the course of the year. I'm going to take it back, of course, to Angela, because Mwanza, who's with us. Angela, your perspective, I'm seeing record highs again being reached for the Russell 2000. I'm seeing a record high for global stocks on the MSCI All Country World Index. I'm seeing a record high on the NASDAQ as well. Are you questioning, at the moment, valuations?
That's a great question, and it's a question that we're answering clients on quite often. But if you look back to March, where we were and where we are today, we're sort of a year into a new business cycle. And business cycles historically, if you go way back in time to sort of the 50s, business cycles are probably around 6 years, post 80s closer to 8 years. So we feel that we're the beginning of a cycle, and we're in a period of growth where more companies are asset light, more companies are nimble, and more companies, even within the S&P 500, tend to carry those higher valuations. So I feel that, yes, we have run up a long way, but given all of the tailwinds, whether it's the stimulus, whether it's the vaccine, whether it's a new administration coming in, I think that it's still supportive of the markets, still supportive of the levels that we see today.
Speaking of valuations or the value trade, are there any areas within value that you still would avoid here? What about energy, for example?
Energy. I mean, energy's had a nice little run up over here. The challenge with energy, I think there's two areas. One on the short term is looking at demand. If we keep seeing economies get shut down, various cities, New York is about to be on lockdown, Germany's kicking into lockdown tomorrow, especially with these longer term lockdowns, I think that doesn't bode well for energy. And then I think structurally over the long term, this move into renewables, just this week is basically the week where we have the 5th year anniversary of the Paris Climate Agreement, and there was just a meeting of 70 national leaders having a crisis meeting, or you could call it, kind of the climate ambition, saying we are not reaching the targets that we made of 1.5 to 2 degrees Celsius of average global warming, maintaining that level. We're not going to get there with all of those commitments we made, so we really need to ratchet up, which speaks for renewable, for battery, and that means governments are going to be spending, providing subsidies, and also regulation behind it. And we're hearing that from President-elect Biden too, which I think is going to be a bit challenging for energy stocks.
All right, we're speaking here with Angela Mwanza, private wealth advisor, senior portfolio manager at UBS. She's sticking with us. You're getting the closing bells here in the U.S. The Dow Jones Industrial Average, the S&P 500, and the NASDAQ each up about 1%. We should point out, again, we don't have it on the board. We should start putting it on the board because it really has been the star of the show. The Russell 2000, 2.4%, not only outperforming the broader market here, but that's a record high, another record high, Kaylee, and Caroline, for the Russell 2000.
Another record high for the NASDAQ, another record high for global stocks. And I take you cross-asset now, Romain, to see this risk-on flavor flow through various asset classes. Look at your GMM function on the Bloomberg, if you're lucky enough to have it. Global macro movers. I'm seeing the dollar down significantly, once again off by 0.4%. We're at basically a 2-year low as we look towards fiscal stimulus, as we look towards the Federal Reserve and its meeting already upon us. And therefore, the outperformance of the Great British Pound, of course, hopes, prayers still on a Brexit deal. But we're seeing some of the commodity-sensitive currencies doing well, the Canadian dollar doing well, Norwegian kroner as well, even in Japanese yen, usually a risk-off kind of trade, doing well. I'm also looking across the commodity spectrum, steel up 1.7%. Remember, this isn't just about US stimulus. We saw very good Chinese data once again, just showing that recovery, it's solid, Kaylee.
Yeah, risk on, Caroline. But of course, that doesn't bode particularly well for the safe haven that is Treasuries. The moves, though, today, not very large. The U.S. 10-year yield up just around a basis point, 90 basis points where we sit. A little bit more movement toward the longer end of the curve. The 30-year yield now sitting at 165.15. But still, 10-year yield below that 1% threshold. The question now is, does the Fed change anything about that, depending on what it gives us tomorrow? Still with us, of course, is Angela Mwanza from over at UBS. Angela, there's some talk that if the Fed doesn't give the market what it's expecting tomorrow, that yields could move pretty materially above 1%. What would a move like that do to your view on equities?
I don't know that it'll specifically change our view on equities. That's still a historically low level for the 10-year Treasury, but we do watch it closely. Where it is a big challenge is specifically around our bond portfolios, because in a diversified portfolio, historically, we would look to our bonds for our safety and for some added yield and for some diversification. And in a low interest rate environment like we are here, it's challenging all of that. So for us, we're looking to see where can we pick up some yield, where can we add to our portfolios, whether it's looking in private debt or looking at areas that are taking on a little bit more credit risk, but not as much risk as going to equities, because it's so tempting to jump into the equity jump on this equity bandwagon with all of your portfolio, because that seems to be the one thing that has worked. But we like private debt, we like emerging market US dollar denominated sovereign debt, we like some corporates as well.
And when you're talking about an alternative specifically, Angela, to sovereign bonds, to those sovereign yields, which of course are hovering near zero or below zero, and by some expectations are going to go higher, is there a sense here that the balance between the rise in yields that we may get and the returns that you're getting on some of those alternative investments, that may sort of equal out at some point in the future?
It's yet to see. I mean, I think it's easy within the private markets to be a lot more opportunistic, to be a little bit more creative, whether it's looking at royalty streams, whether it's looking at bridge financing. So I don't know that it necessarily will impact each other, but if yields go up to a decent level, then why would I deal with the illiquidity that you get within private equity? We're also seeing a lot of evolution within that space, where it's providing closer, not such large lockups, more liquidity, and yet still higher yield. So it is a space that I think still has a lot of potential for our portfolios.
Angela, what are your clients asking you that we haven't asked you yet? What are we missing? What's the market not talking about that you're getting questions on?
And maybe this is because it's one of my favorite areas. We tend to speak a lot about sustainable investing, about those companies that are looking at environmental, social, governance investments, whether it's looking at mitigation, whether it's looking at integration, divesting of fossil fuels, all of these kinds of investments that are reflective of our clients' values. That's what we spend a lot of time talking about, because when we're thinking about generational wealth, it's not just how is my portfolio going to do in this generation, but how will it do in the coming generations? And not only do I want to ensure that I'm getting a financial return, I want to make sure that my actions today have a positive impact on the future. So that's a really big topic that we spend a lot of time with our families talking about. And there are lots of opportunities, knowing that we've got all of these governments and corporations committing to net neutrality by 2050. Sometimes earlier in some cases, which provides that tailwind for a lot of these investments, whether it's in green tech, whether it's in sustainable agriculture, whether it's in renewable energy, smart mobility. I think that's a great investment to think about if you consider family values, and it's a great investment to think about if you're just looking at the financial return of your portfolio.
ESG still hot. Angela Mwanza, we thank you, private wealth advisor and senior portfolio manager at UBS. We love you riding the close with us. Now, more markets coverage coming right up for you on Bloomberg Markets to Close. We're going to be digging into, of course, the all-important FOMC rate decision that comes tomorrow. What to expect. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Let's get you up to speed with where we closed. Higher across the board. Nearly every index, basically all the major indices, above more than a percentage point growth we saw on the day. And record highs once again being hit by the NASDAQ, but also by small caps. It really speaks to the fact that people are still ploughing into tech, but they're still ploughing, of course, into the more cyclical trades. Kaylee.
All right, Caroline, I just want to bring you some breaking news from Microsoft, of course, following on that big story from yesterday in regard to the cyber hack. A lot of fingers pointed at Russia using a backdoor in SolarWinds technology update to affect many government agencies across the board, including the Department of Homeland Security, the Treasury, the Commerce Department. Now Microsoft saying that it is ensuring customers are protected. They have a tool to block the known malicious SolarWinds binaries, and that they have been in communication with SolarWinds, which I should mention ended the day another almost 8% lower today, Romain.
All right, let's turn now to the Treasury markets. Of course, we've been talking a lot this year about that steepener trade. Of course, a lot of investors have really piled into that trade, and it paid off pretty well. You look at the trajectory of where 10-year rates went. I think we have a chart that we can show you. It gives you an idea here of where 10-year rates went, and then you sort of pair that up with the positioning that we've seen, at least look through the lens of that commodities future trading data, and it gives you a sense of just how much conviction some traders had. But that conviction has really been dialed back a little bit over the past few weeks. A lot of concerns here about what the next move is by the Fed. The idea here that the Fed, while they would certainly encourage some degree of rate rise here, that they would actually want to cap that to a certain extent, at least here in the short term. So the Fed right now looming large over this trade, a trade that's paid off so far. The big question, I guess, is what do we hear from the Fed tomorrow? And will they really give any sort of signal here as to what's going on? For more, let's bring in Ira Jersey of Bloomberg Intelligence, of course, knows way more about this than me, you, and anyone else. Ira, what are your general expectations for tomorrow?
Yeah, so the market's pretty split on whether or not the Federal Reserve is going to do that maturity extension that you mentioned, Romain. I think the Fed will actually hold off a month. I think that they'll wait to see just a little bit more data, get another payroll print, a couple of retail sales prints in there, to be able to see, how bad the winter might get, even though we're getting the vaccine. But at the same time, there is the possibility that if they don't do that, that bond yields might rise a little bit. So, there's different ways to analyze this. And I think on the 10-year yield, I think we go back and test the highs of about 98 basis points where we were a couple of weeks ago. I don't think that even if the Fed doesn't do that, that they'll break 1%. The reason being that even though the statement might disappoint those people who want to see them buy more longer-term bonds, I think that Jay Powell during the press conference will say it remains an option, we're still looking at it, and we'll do it if we think we have to, and that'll move things back down toward 95 and maybe even close the day pretty much where we are now.
So, Ira, do you think for here on out there is basically a cap on 10-year yields at 1%?
I don't think so. I think, though, what you do need to happen is have the global economy look like it's going to pick up steam. You see the efficacy of the vaccines in the first and second quarter, and then you wind up seeing bond yields do get above 1%. We think sometime in the mid to second half of 2021. So something that's going to persist forever that we don't break 1%. But I think in the near term, so tactically in the next 3-4 weeks, that we probably will hover kind of just below 1%. One thing to remember, when bond yields move, they tend to move in fits and starts and then find new ranges. So what we look at, we do look at the technical levels of bond yields, and the 10-year bond yield, if it breaks 98 basis points, 1% is a meaningless number on the charts, by the way. 98 basis points is important. Above that, 1.17% is the next level for the 10-year yield. And then I think we reach kind of there, and we'll make a new range, maybe 105 to 117, and then the market will reassess for a long time what the next move for the economy is going to be, and that will ultimately drive where bond yields are going.
Ira, we just have about 30 seconds, but quickly, tomorrow, is there anything that the market's going to care about other than details on this bond buying program and potential tweaks?
Probably not from the Fed. I think that if we do get some new news on what a fiscal stimulus package might be like, that could potentially move bond yields and markets, and particularly the TIPS market might care a lot about that. So you notice inflation expectations have been rising up toward 2%, and if they break 2%, then they're going to be making new multi-year highs in the market's expectation for inflation, and I think that could be very important and very signaling for what might be next for bond yields in general.
Ira Jersey, we thank you so much for Bloomberg Intelligence. He'll be a busy man tomorrow, of course. Meanwhile, let's get to our other busy man. Mark Crumpton's here with the First Word News.
Caroline, thank you very much. Senate Majority Leader Mitch McConnell congratulated Democrat Joe Biden as president-elect today. The Republican leader's statement, delivered in a speech on the Senate floor, ends weeks of silence over President Trump's defeat. It came a day after electors met and officially affirmed Mr. Biden's election win. As he departed Wilmington, Delaware to campaign for Democrats in the Georgia runoffs for U.S. Senate, Mr. Biden told reporters that he called Leader McConnell to thank him for the remarks.
I had a good conversation with Mitch McConnell today. I called him to thank him for the congratulations. Told him, although we disagree on a lot of things, there's things we can work together on. We've always been straight with one another, and we agreed we'd get together sooner than later, and I'm looking forward to working with him.
In his remarks, Leader McConnell said, quote, "Many of us had hoped the presidential election would yield a different result, but our system of government has the processes to determine who will be sworn in on January 20th. The Electoral College has spoken," end quote. America's top infectious disease expert expects to be vaccinated against COVID-19 as early as this week. It's not just because Dr. Anthony Fauci is still seeing patients. He tells the Washington Post he believes getting inoculated on camera could help boost Americans' confidence that the vaccine is safe to take. Dr. Fauci says between 75% to 85% of the U.S. population must be vaccinated to achieve herd immunity. New Yorkers can expect a shutdown of all but essential businesses soon after Christmas. That is according to Mayor Bill de Blasio today. Although Governor Andrew Cuomo will make the final decisions, Mayor de Blasio says closures will be similar to what the city experienced last spring, with the exception that schools will remain open. New York City has seen its COVID-19 infections and hospitalizations rise in recent weeks. The New York area is bracing for what could be the worst December snowstorm in a decade. The National Weather Service says a foot or more of snow could blanket the Mid-Atlantic and Northeast starting Wednesday. The storm threatens to snarl road, rail, and air traffic throughout the eastern United States, just as trucks carrying Pfizer's COVID-19 vaccine from Michigan fan out nationwide and carriers are busy with holiday packages. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Romaine?
I'll pick it up from here, Mark. We do have some breaking news. Trump's national security advisor, of course, the acting security advisor being Charles Kupperman, has cut a trip short for talks on the hack. Of course, this hack is the one we just mentioned ago that was revealed by FireEye involving SolarWinds software, has affected a number of government agencies, Romaine. But a breaking news just crossing the terminal that the national security advisor is returning early from the Middle East and Europe for talks on that hack, Romaine.
All right, a very important story. We're actually going to have a lot more of that on our next program, What'd You Miss? I want to take you back now to what's going on here with the pandemic. Of course, arts organizations, they've been hit especially hard. Of course, venues around the world have gone dark. Bloomberg's Janet Wu, she takes a look at how two symphonies out there are finding a way back into the spotlight, bringing new concerts and music to an even bigger audience.
The orchestra is an art form with no personal space. Musicians perform shoulder to shoulder to synchronize as one. When the pandemic struck, the Boston Symphony Orchestra immediately canceled its season.
We have, candidly, in Boston, maybe the largest
audience along with Los Angeles. So in the course of a year, we've lost about $50 million in ticket sales and other earned income.
How does an orchestra perform when there's no room for social distancing? You make room. Here at Boston Symphony Hall, they more than doubled the size of the stage.
We've taken a 2,400 square foot stage and made it close to a 6,000 square foot stage. And all the string players are 6 feet apart. The brass section is basically in a different zip code than the strings, but somehow we've learned our physics. Sound and light travel at different speeds, so everyone's had to make the appropriate adjustments, and we're making music again.
All this is possible because 120 years ago, BSO founder Henry Higginson had the uncanny foresight to build a concert hall with removable seats. The seats are taken out for Pop's dinner concerts and even for an elite squash tournament.
But no one ever dreamed these century-old seats would help the BSO face the pandemic.
And one of the great ironies is we're reaching more people than we've ever reached.
Nearly 20 million unique viewers since performances went online.
We're touching more lives with music than we ever have before, 6 continents, 88 countries. And so we're able to fulfill our mission.
The Dallas Symphony Orchestra also got creative.
We did, believe it or not, 90 concerts outside, chamber musicians all around Dallas on streets, driveways, cul-de-sacs, parks.
And indoor concerts with just 42 musicians. The audience is capped at 150 in a hall built for 1,800.
People would shout thank you from the audience to the orchestra as they were getting off the stage, which was just so poignant.
The silver lining is that someone with tickets all the way up here can now get this close to the musicians.
You get angles, you get perspectives that you can't have in a normal concert.
Facing incredible challenges, the BSO and DSO are determined to come back, knowing music is more important than ever. In Boston, Janet Wu, Bloomberg News.
You can catch a holly jolly celebration with the Dallas Symphony Orchestra in partnership with Bloomberg Television on Friday at 7 p.m. Eastern Time. You don't want to miss it. Romain Bostic even sings a little ditty.
Do
I? Bloomberg.
It's gonna be big.
건강 등급이 좋으면 보험료를 더 할인받는 새로운 상식 ABL생명.
Hiyo mkokoteni ya stima ningeipata naweza sikia vizuri sana kwa sababu inatumia nguvu sana.
The advantage of the electric handcut over the manual conventional handcut is that 1, it increases the productivity level of the users. 2, it is eco-friendly in that it does not pollute the environment. 3, it increases the income level for their users in terms of loading capacity and also in terms of productivity.
SAS and Microsoft are joining forces to further shape the future of AI. Now you can run workloads that work for you. It's time to reimagine analytics in the cloud.
Welcome back. Now, Senate Majority Leader Mitch McConnell said his chamber will stay in Washington until a coronavirus aid package is complete, reiterating his call to move forward with items that have broad agreement, but also leave aside contentious issues like liability protections and, of course, all important aid for state and local governments. For more on the state of talks, I'm pleased to say we're joined by Congressman Brendan Boyle, Democrat of Pennsylvania. Wonderful to have you with us, Congressman. And these contentious issues, should they be set aside? Should a smaller package be put through right now?
Look, the American people need help, and they needed it yesterday. I've already voted for two packages, one in May, the other in October, both called the HEROES Act or HEROES Act and HEROES Act 2.0. Unfortunately, in that time, absolutely nothing has passed the Senate over the last 8 months. I'm certainly open to the idea of pushing forward with what we can agree to, and then returning to those items that are left to be agreed upon. But let's be clear, there's no reason why we should be here 8 months later still attempting to reach an agreement on another round of direct stimulus payments, another round of PPP, desperately needed aid to state and local governments. No, Senator McConnell, it's not a blue state bailout. It's attempting to backfill the budgets of all of our states and municipalities that have had such a sudden drop in revenue because of COVID-19. We cannot be laying off our first responders and our teachers, et cetera, in the middle of a pandemic.
We are, as you mentioned here, Congressman, it has been months since the provisions in the CARES Act began to expire, months of inaction by Congress. I am curious as to whether you think that the tone would change once the new Congress is sworn in next year, and obviously President-elect Biden takes over. It's still going to be a very narrow margin in the Senate, and you still have a leader in Mitch McConnell who is opposed to some very fundamental ideas about what the Democrats have proposed.
It's not just opposed to certain ideas. Back in the night before Inauguration Day in 2009, in a famous anecdote now that has been verified, House Republican leadership got together and decided they wouldn't agree on anything with President Obama. They decided to pursue a path of obstruction. Mitch McConnell obviously followed through on that when he became Senate Majority Leader a few years later.
You think he's going to do the same thing with Biden?
Excuse me?
You think he's going to take the same approach with Biden?
Yeah, so what I was trying to say is the question then for Senator McConnell is, will he pursue this obstructionist path before it was done to attempt to get them back into the majority? Now that they are in the majority, the question is, will they be willing to do something with it? My hope is that they will realize that what they are doing is only eating their own, that they are enabling more extreme voices and candidates on the Republican side to actually take them out in primaries, that it's actually in their political interest to work with us and work with the President Biden.
Congressman, the clock is ticking. The stopgap funding bill runs out on Friday. Is there a risk that we don't get something done in the next 3 days?
Yeah, you're raising a separate but also vital issue. That is, regardless of what people think should be done on COVID, whether you call it stimulus or, as I call it, relief, the reality is, separate of that, government funding runs out December 18th. So if we don't pass legislation, we would be in the middle of the pandemic, in the middle of attempting to roll out vaccines. We would be facing a government shutdown. Now, the good news on this is I am actually pretty optimistic that we will see the government funded, that we will push forward on a bill that will get this through, not just a week bill or a 2-week bill, but actually will get us through to the end of the fiscal year, September 30th. On that point, I am optimistic.
All right, we will see what happens in the next couple days. Our many thanks to Congressman Brendan Boyle. He, of course, is a Democrat joining us from Pennsylvania. And guys, it does raise a question for me. The original package we were talking about with Nancy Pelosi was $2.2 trillion. Even if this $908 billion compromise package goes through, both parts of it, it's still half the size of what was originally proposed. My question is, will it do enough?
Yeah, I mean, go ahead, Caroline.
That's the key question, guys. Is it enough? The market seem to think it is enough. I almost feel like any sort of deal will keep the market supported here, and they want to move forward, and they want to start seeing them. They're looking past this, past the vaccine rollout, and at the moment we're at record highs. It's quite amazing.
Yeah, record highs here. And of course, a lot of news here that came out through the day. I mean, we kind of touched briefly, Caroline and Kaylee, on that Russian hack, of course, that has really seemed to just involve not only a lot of companies, but now, of course, we're starting to get the Trump administration response to it. We're going to talk a lot more about that on the next show. Kaylee, you're going to be here for that?
I won't. This is it for me, Romaine. I think you knew that, though. Bloomberg Markets The Close. That wraps it up for our coverage. What'd you miss is coming up next. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Not only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
From Bloomberg's World Headquarters in New York and from right here in London, I'm Caroline Hyde.
I'm Joe Weisenthal.
I'm Romaine Bostic. Let's get you caught up on where markets stand right now. The S&P 500 rebounding from its longest losing streak since September. The Russell 2000 closing at a record high.
But the question is, what do you miss?
Well, I mean, as we wait for the Fed decision tomorrow and as we have US stimulus talks ultimately still being waited to see how it plays out, you might have missed a pretty massive global cyber attack. US government agencies were included in the attack as part of a pretty global campaign. Hackers who are suspected to be tied to the Russian government went after SolarWinds. Now, it's the company behind a widely used software used in such major places like, well, the US State Department, the CDC, the FBI, all 5 branches of the United States military, and, well, 425 corporations out of the Fortune 500. So, Joe, this attack might have started as early as this past spring, and it shines a light again on the importance of technology in our lives.
Yeah, and we see the risk of when a key provider of infrastructure is undermined or is a vector of attack, and you see it in the markets. This is shares of SolarWinds. Over the last 3 days, the Austin, Texas security software company plunging 23%, had been a star performer. But on this news of its software being connected to the attack, obviously major concerns about the company. Right?
Yeah, and there's been a lot of focus here, of course, on the company, SolarWinds, FireEye, a couple others. At some point, though, the attention has to turn back to the U.S. government and sort of whether they were prepared for this, whether they knew about it, and what the response is right now.
All right, so joining us with more insight, Bloomberg News cybersecurity reporter Will Turton. Will, what is the latest sort of key development that you're paying attention to in this story?
So the latest key development is figuring out exactly how many U.S. government agencies have been hacked. You know, there's more reporting coming out about, you know, exactly which agencies have been hacked. You know, there has been reporting in other outlets that the National Institute of Health may have been hit. You know, the NIH just put out a statement saying that they were SolarWinds customer, but they don't have any more details. So, you know, we still have a lot more to learn about, you know, who is actually affected.
And it's sort of, ironically, I mean, it was embarrassing for FireEye as a cybersecurity company to be hacked, but almost they're the linchpin to all of this. If they hadn't been hacked, perhaps we wouldn't have known about this for even more months. How long has it been going on, do we think?
You know, we think this might have been going on since March, but it definitely could have been earlier than that. You know, Russian intelligence agencies plan these attacks methodically and do it, you know, with a lot of planning. Something that's so fascinating that you just mentioned is the fact that, you know, a cybersecurity company, FireEye, was hit. And, you know, the company says that them themselves being hacked is kind of what unraveled this entire secret operation, and that they were able to figure out who was behind it and discover that, you know, the attack was much bigger than just the cybersecurity company.
And so, I mean, we had some news here, of course, the National Security Advisor on his way back to Washington, I guess, to deal with this. This also comes sort of at a time, Will, where we're, you know, supposed to be in the middle of a transition to a new administration. I'm wondering how much that complicates both the investigation and the remedy.
I mean, that absolutely complicates it, right? If you wanted to pick a better time to carry out this attack, I think it would be impossible to find one. You know, the head of the Cybersecurity and Infrastructure Security Agency, Chris Krebs, you know, was fired by Donald Trump not too long ago for, you know, correctly stating the results of the election. So, you know, I think the federal government is in disarray right now in terms of responding to this attack. And another, you know, kind of interesting development that we reported yesterday is that it was a private company that found this major vulnerability. It wasn't the National Security Agency or the U.S. government, as far as we know right now, that actually discovered it. So, you know, the U.S. government is definitely on the back foot here.
We were just putting up a board. SolarWinds is software. It's not just for U.S. government. Is there another shoe to drop as more private corporations? Are they exposed here potentially too? And could we see more potential leaks of important private data?
Right. So, you know, Caroline was talking about the customer list. It's incredible, right? They have a slogan on their LinkedIn page, SolarWinds does, that they're everybody's IT. So, you know, as far as we know, we expect the number of victims to be, you know, in the category of dozens, not necessarily thousands. But all of those victims are supposedly high-value victims. So, you know, important government agencies like the Treasury, like the DHS, but also, you know, there are reports that private sector companies have been hit, though we don't actually know which ones have been successfully hacked yet, and whether that information would ever come out.
Yeah, interesting. And we should point out, too, I mean, some of the past major hacks we've had have also involved third-party vendors. So interesting potential vulnerability there. Will Turton, all over, our Bloomberg cybersecurity reporter. A lot more to talk about here on this show. We're going to pivot from that to Google. You may have heard of our next guest. He's a software engineer who's been researching the extent of Google's web crawling monopoly. He says he has the goods. Knuckleheads Club founder. Don't let the name fool you. Zach Merrill has got some important thoughts. Coming up next, this is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
So today we are focused on all things tech. We just discussed the massive cyber attack that hit SolarWinds. And Joe, another headline with tech today is, in fact, the EU's latest effort to, well, reel in big tech's reach.
Yeah, this is a really sort of multinational effort. More and more regulators everywhere attempting to rein in big tech. EU unveiling what it calls Digital Markets Act and Digital Services Act, affecting companies like Alphabet, Amazon, and Apple. Potentially could be forced to sell off businesses and pay fines. Everywhere you look, U.S., Europe, elsewhere, we see this crackdown continuing to emerge.
And of course, yeah, we saw the EU publish those rules out there that it seeks for tech companies. And of course, the person spearheading all this, European Competition Commissioner Margrethe Vestager, she had a little bit more to say about this. Take a listen.
It's actually what you would expect if you're an investor, that the business that you invest in actually is by the book. If they're not, then it is fines and other fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company. I would not expect that we should go there, but as a last resort, I find that it is justifiable.
All right, so as mentioned, it's really everywhere. New York Times, meanwhile, reporting that Google could be targeted in a search monopoly case by state attorneys generals earlier this week. I want to bring in the founder of an organization, an entity called the Knuckleheads Club. Zach Merrill spent years researching Google's search engine. Zach, what's the Knuckleheads Club? Why is it called the Knuckleheads Club? What are you pursuing?
So the reason why it's called the Knuckleheads Club is because you kind of have to be a knucklehead to try to go after Google, right? Like they're this huge entity controlling such a big part of our life. And I think that's the reason why we founded it, right? Like I want to, oh, go ahead. I want to.
You want to continue to, reining in Google in some way?
Right, right. I think the thing to know here is that Google is this just terribly complicated entity. And what we've done here is we've looked at the heart of Google and we've found something called the natural monopoly. What Google has to do is a process called web crawling, where they go out and collect all this information on the internet. And all the search engines have to do this. But when Google goes out and does it, websites all across the internet, all across the web, give Google extra special access and more information, allow it to crawl a lot faster and to collect information more faster. And what we've done so far is we've provided a lot of evidence about why Google gets this advantage and how much of this advantage they have, right? And this has particular implications for antitrust and how to regulate Google.
So is the general idea here, Zach, I mean, when you're focusing on this web crawler issue, and for the folks that maybe don't understand it here, how do you get to, I guess, your general technical knowledge of how this web crawler operates and square that circle with, I guess, the legal bar, a relatively high bar to prove monopolistic behavior?
Right, right. So I've worked in the industry for about 10 years now, and I've spent 2 years researching this topic alone, right? So it's a fairly technical topic. But I think one of the best things that you can do today, if you're really interested in this, is if you go to knuckleheads.club, you can read all the research, right? Recently, this research was cited in the big tech antitrust report that got published by the subcommittee on antitrust. And what you're reading there is what I sent to them, right?
So Zach, suppose that me, Romaine, and Caroline, we wanted to start our own search engine, the three of us, to compete with Google. Your essential assertion is that we would have to crawl the web, do our own sort of create our own index of the entire internet, but that because websites, they all want to be featured high on Google, Google gets special priority to all of their internal data. There's costs associated with having these sites crawled. And so just the cost of doing that would inherently be prohibitive, meaning that map of the web, essentially, that Google has cannot really easily be replicated by any competitor.
Yeah, exactly. So it's going to be very difficult for you, if not impossible, for you to go out and crawl the same way that Google does. Because if you try, right, you might get, a couple web pages here and there, but, there's software engineers out there who are watching what you're doing if you're crawling their websites, right? Because it is expensive and you are incurring costs for these companies. And so if you're crawling too much or you're crawling too fast and you're not Google, you're going to get blocked. There's going to be a firewall, right? It's something. Oh,
Zach,
go ahead.
why does it matter for me? Why does it matter for me? Why should it matter that there's one player that's so efficient at search?
Right. I think it matters for you because what Google has is this moat, right, around its core thing, like the Google search, right? And because of this moat, which is this natural monopoly on web crawling, it's allowed to just create all these, just reap all these profits, right, from the ads that it sells on search results. And with those profits, it's able to go out and just like expand out into other markets and kind of be not so great, right? An example I'll give is Google's the Stadia project, right? The video game thing that they tried and are just continue to fail at, right? I don't think another company could get away with that, right? But when they came into that market, it kind of took the air out of the room, right? So if you were interested in video games like I am, I'm, shameful to admit.
No shame.
It was a little disappointing to see them come in and be, really helpful. Google's got all this resources; they can do all this cool stuff. But no, it wasn't. It was really pretty disappointing, and me and my friends were not all that happy with it. So, and I think it did set back that market a little bit. So I think the point I'm trying to get across for you is, and for all your listeners here, is that Google has all this power, and it's squandering it. And I think we as a society we're giving them that power by not regulating web crawling. And choosing not to do so.
So what's the remedy then, Zach, that you would propose that you think would rectify this?
I think the remedy here is regulations passed at the national and international level that give competitors access to that cache, right? Once you say crawling the web is a natural monopoly, you can kind of put that sentence into the regulation machine, right? We know how to regulate natural monopolies. There's a lot of case law and a lot of precedents here. But what I think the thing that we don't know or that we didn't know prior to this research getting published, was that crawling the web was a natural monopoly, right? And that it is something that should be considered as such and regulated as such, right?
All right, Zach, very interesting perspective here. I really do urge our viewers to check out your research. Zach Merrill, head of the Knuckleheads Club, basically is a former software engineer here looking into monopolistic practices by Google. All right, we want to turn from that to some breaking news crossing the wire. This on marijuana stocks. Tilray and Afira in advanced merger talks. This according to BNN, Bloomberg. Of course, these are the two mega Canadian companies out there that had really just been two of the hottest stocks out there. Right now, we don't really have terms of what they're looking at right now, but the headline is that the two companies right now in advanced merger talks. Joe.
Gotta wonder if there's going to be a lot of consolidation in this space. All right, coming up, the final Fed decision of 2020. With the economy starting to soften, is there more that the Fed will do now? We'll discuss with Julia Coronado of Macro Policy Perspectives. That's next. This is Bloomberg.
retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
With a new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
All right, we're going to switch gears now from the tech to the Fed. The central bank ready to give its latest rate decision and guidance tomorrow afternoon. And Joe, this is a funny story. Do you remember 5 or 6 months ago when everyone said the Fed's going negative?
Yeah, that was fun times.
Hilarious.
Of course, years ago, the ECB was a real innovator with negative rates. Some others have tried it. Some people thought the Fed was going to go there, too. But really not so much anymore. We saw bets on negative rates actually peak back in July. But since then, have really come down. It feels like traders, investors think that other tools, not negative rates, will be in the future. But what are they going to do? Joining us now from Austin, Texas, Julia Coronado, president and founder of Macro Policy Perspectives. Julia, last Fed decision of the year tomorrow. The one thing that they might do, perhaps, is extend the weighted average maturity of asset purchases. Most people don't think that's going to happen, but what's your outlook for tomorrow?
So we do expect them to go ahead and extend the maturity of their Treasury purchases. We also expect them to issue new guidance on their asset purchases more generally that ties those purchases to their economic objectives. So that's something they've signaled very clearly. They've been less clear about signaling whether they're going to add a dose of accommodation through the weighted average maturity extension. We do expect them to do so to address what is the reality of the near term, which is a raging pandemic, wave of shutdowns and restrictions on activities, a lot of pain and suffering in the near term. No, their tools aren't the perfect tools to address it. But if you have a tool that has a positive delta, I don't know why you're holding back. So I think we take our cue from the tone that Chair Powell struck in front of Congress and in his other appearances. Again, the risk is doing too little, not too much. Right. So if you've got something that does something good, you go ahead and use it now.
And Julia, meanwhile, we still wait on fiscal stimulus, something that we know Fed Chair Powell has asked for time and time again. Exactly. Really, what sort of effect do you think looking at this asset purchase would have in terms of actually helping stimulate the economy and support it while we remain without that sort of support?
I think that the benefit of doing the extension now is taking out an insurance policy on market conditions. Market conditions are pretty buoyant right now, but partly they're buoyant because the Fed has backed them up with a very dovish reaction function. If they start looking hesitant or like they're trying to fine-tune policy now, then markets may be less sanguine in the face of what are some very real risks in the near term. So I think there's a lot of stars aligning somewhere out in the middle of 2021 when the vaccine is more widely available and we're starting to develop herd immunity. But it's a long road there. And as you know, the fiscal support is still very much in the air. It looks like they're closing in on a package. It may be substantial. It may be less substantial. And, you know, we've been going at this and on the same merry-go-round for months and months and months. And again, the Fed won't have that certainty, the luxury of certainty when they make their announcement on Wednesday, most likely.
Yeah, well, let's hope. Let's hope. We'll cross our fingers on that. I am curious, though, about, the previous forecasts that they've given have been pretty much centered around the idea of we just don't know. Until we get a handle on the health crisis, it's just hard to really forecast economic conditions. Do you at least think that now that with the vaccine out there, at least 2 vaccines out there in some capacity, that they can maybe be a little bit more definitive in their forecasts?
Definitive is not the word I would use.
Well,
I
not
do
for the
think,
Fed,
you know,
right.
the Fed are, like all of us forecasters, they've learned humility the hard way. They're going to be giving us new charts showing their assessments of risk and uncertainty around their forecasts. And I think what they will show is less downside risk, less uncertainty than they had in September. So there's been some improvement, some clarity, some positive developments, but still they're going to be net downside risks and elevated uncertainty. And in the face of that message, it would be hard to say, yeah, we've got these tools, but we're going to hold off on using them, even if they're, again, not the perfect tools. If they're good tools, why don't you use them in light of these downside risks and near-term drags on the economy?
Julia, let me skip ahead for a second. One story that potentially is brewing perhaps next summer is as the vaccine, as we get herd immunity, perhaps as the reopening happens, that we actually get a sort of bout of inflation as everyone books to buy airlines and hotels and we go on a splurge when the reopening. Are you worried at all? Are you concerned that not all the members of the FOMC will be on the same page about looking through that, and we'll start to see some voices get skittish about wanting to, bring those first rate hikes into view, perhaps earlier than the market is expecting?
I am not worried about Fed skittishness. I think the Fed understands inflation dynamics. They know the difference between inflation and one-off changes or resets in price levels. I think that they showed a great deal of unanimity around the new reaction function, the new guidance on interest rates. So I'm not worried that they're going to, back off their support because of a head fake on inflation. Inflation is going to be really volatile next year, up and down on the back of these base effects from 2020. Then layer on top of that another bout of volatility as the economy reopens and maybe you get some downward pressure on goods prices and upward pressure on service prices. Again, the Fed sorts through the wheat from the chaff. They're going to look for the trends. And ultimately, remember, the first building block of pulling back support is nearing full employment.
Yeah.
So that's going to be the first metric that we're watching is the labor market recovering? Yeah. Are wages rising? Is there broad-based recovery, prosperity in the labor market? That's the underpinning of the inflation that would lead them to recalibrate policy. And I don't see us getting anywhere close to that by the middle of next year, even if airfares are resetting higher.
Yeah, Julia, always great to get your thoughts. Julia Coronado, Macro Policy Perspectives, President and Founder. Going to have to leave it there, of course. You can catch all our coverage here of The Fed Decides tomorrow, 2 p.m. Eastern Time. Joe.
What are you guys watching tonight? Oh, that's all. No time for chat. That's all for What You Missed. Bloomberg Technology is up next.
Okay.
Have a great evening. This is Bloomberg.
think we have a lot to be optimistic about in this country, but in the near term, even with these vaccines, Moderna and Pfizer, we just got to allow them to be given to the people who need them the most, but that's going to take more than 6 months.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the FDA nears approval for a second COVID-19 vaccine, officially saying that Moderna's shot is safe and effective. This as the first healthcare workers are receiving Pfizer's shot, and as the U.S. surges past 200,000 cases a day. Plus, the parent of online retailer Wish prepares to go public as Airbnb and DoorDash pull back yet again after their exuberant receptions on Wall Street. And former Twitter CEO Dick Costolo joins us for his take on lofty tech valuations and to talk about a new investment in health tech. All of those stories in a moment, but first, U.S. stocks climbing today on stimulus bets as Senate Majority Leader Mitch McConnell congratulated President-elect Biden for the very first time publicly and is meeting with House Speaker Nancy Pelosi on a stimulus package as we speak. Bloomberg's Abigail Doolittle has more on the market day from New York. Abigail, how did the markets respond to optimism around a new package?
You know, a new package and also Moderna's vaccine. The fact that we early today, before the open, had the positive news that the FDA has found their COVID-19 vaccine to be safe and effective, that really set the bullish tone. And all day stocks traded higher. The S&P 500 closing up 1.3%. Its best day in 3 weeks, and a really nice broad-based rally among the various sectors. The NASDAQ 100 finishing up almost as much, up 1%. You know, a real standout sector, star sector, technology today. Apple up 5%, the best day in 2 weeks, or 2 months, excuse me, Emily. And on an unusual report, Nikkei, which tends to be a little bit bearish on Apple, bullish today, saying that they see the company potentially raising their iPhone production by 30%. That's a huge amount. So you saw the whole iPhone, the Apple complex trading higher. Those chip suppliers such as Skyworks up 3.9%. So chips strong, tech strong, but financials, energy strong as well. And after hours, we have some exciting news, Emily. Advanced merger talks apparently between Tilray and Afria, so possibly some M&A in the cannabis space, and you can see both of these stocks soaring. On the year, though, Tilray is actually down pretty sharply, down 54%. So this probably comes as some relief to investors in this potentially hot space, at one point hot space, but this year having a difficult time. And then very interesting, Emily, we had stocks broadly climbing higher, but on the day, we had something similar to yesterday where the shares of Moderna and Pfizer both traded lower on the news, possibly some sell the news action here. Yesterday, of course, Pfizer's vaccine starting distribution here in the U.S. That stock yesterday down more than 4%, down 1.3% today. Moderna down more than 5% today. On that positive news, the expectation that the emergency authorization will be given on Thursday and hopefully distribution within, not the so far distant future. You have to make the point, though, Emily, Moderna up an incredible more than 600% on the year, so down 5%. The stock is still absolutely soaring on the year on vaccine optimism, Emily.
It has been an incredible rise. All right, Bloomberg's Abigail Doolittle, thank you so much for that roundup. Continuing on the vaccine front now, the FDA, as Abigail said, says Moderna's COVID-19 vaccine is safe and effective. Next up, for that vaccine, an FDA advisory panel will be looking at data later this week, and a recommendation could lead to the vaccine being officially approved for use in the United States. To discuss, we're joined now by Noubar Afeyan, co-founder and chair of Moderna. Noubar, it's been so wonderful to hear your updates from you personally over the last few weeks. Tell us what is the very latest. Where do things stand now between Moderna and the FDA?
Well, thanks, Emily. Thanks for having me. So today was another important step along the way to the upcoming Thursday meeting of the Advisory Committee of the FDA, which will discuss the possibility of an emergency use authorization of the vaccine, which, following the precedent that was set last week of the further discussions and review, should hopefully produce an answer very soon after the meeting. And then after that, the Operation Warp Speed colleagues that we've worked with for many months are poised and ready to get the vaccine, first doses of the vaccine out for healthcare workers and more broadly immediately. So we're very much awaiting that moment.
So if this is approved by Friday, how many doses do you believe will be shipped in that very first week to the United States?
I don't have the very specifics because that's a bit changing as well, depending on what day it is, because we're producing the vaccine as well. But what we said publicly, Emily, is that there will be some 20 million doses prepared by Moderna for shipment in December if we can get the emergency use authorization. So that's the number that we've been working towards. Of course, a subset of those will go out first, several million doses, followed by shipments, repeat shipments thereafter to fulfill that goal.
Now, Moderna has said you could potentially make up to 1 billion doses by the end of next year. How many of that billion doses do you think, based on what you're seeing in the supply chain, you will actually be able to make?
We've said that we are poised to make 500 million to 1 billion doses. Under different circumstances, we may be on the high end of that. We'll also be watching for demand. One of the things, Emily, that none of us knew as recently as a month ago, and we still don't know over the next few weeks and months, is just how many of the vaccines will actually get over the finish line, show not only safety, but efficacy sufficient for broad adoption. And that in turn will have a role to play in dictating how much volume each of the vaccine manufacturers needs to make and can make. So the capacity is one thing, the utilization will be another. So we've been thinking in the 500 million to billion range, maybe in the middle of that, but it's still early for us to determine exactly where that'll be. We've certainly made a lot of upfront investments to be in a position to reach those goals should we need to.
Okay, so if you can share any more details about capacity, then are there any particular ingredients that are in, let's say, short supply, or do you have everything you need to get to that, 750, maybe a billion doses based on what you're seeing right now?
Based on what we're seeing right now and the volumes that we've already committed to with our partners, the governments that have already pre-ordered vaccine and that we foresee ordering in the near future, we have certainly the supply chain in place. Again, let me commend the close collaboration with our OWS colleagues who played an important role in securing some of the key items that we needed help with, making sure we get in a timely way. And so I think the system is in place. Of course, there may be disruptions, there may be surprises, but right now I think certainly the 200 million doses that have so far been secured by the US government and whatever we foresee for the rest of the world, we're in a pretty good position to make. And the key supplies are being secured, have been secured. And as we go along, we may increase those.
Your production, which has been an incredible feat, has been watched with great fascination. How has Moderna been able to get such a leg up on Pfizer in producing more doses of a similar vaccine in initial weeks? What's been the secret sauce?
Well, Emily, I can't speak to the specifics of what Pfizer's been doing, but I hold the company in the highest regard, being quite an old established company with vast resources and vast expertise. This vaccine, the messenger RNA vaccine, is something that Moderna has been working on for almost 7-8 years, and the whole technology we've worked on for 10 years. And as the pioneers in this space, as you may know, we spoke earlier about this, we have experience across 10 different human vaccines that we've tried in trials and are currently being pursued for other diseases. All of that, all of the 10 years of expertise, the hundreds of millions we'd invested in production, in optimization, all have supported us in what we've been trying to do in a very short time frame, which is to scale what is an unprecedented vaccine. But it comes on the heels of significant technology, process development, analytical investments we've made, among them being how to make sure that we can store our vaccine at conditions minus 20 degrees centigrade that are more compatible with vast distribution than would have otherwise been the case. 5 years ago, we had processes that also needed to be kept at ultra frozen conditions down in the minus 70, minus 80 degree range. I'd say that's an important part. The other important part is the people. We're fortunate to have attracted some of the most experienced people in this industry under the leadership of Juan Andres, who came to us from many, many years, if not decades of experience at Novartis. And the leadership he and his broad team provided was, in fact, absolutely essential for a small company. Usually small companies have less experienced leadership, and when put to this kind of test, everything is being done for the first time. Well, here, they had done this before in prior pandemics even,
right,
but simply not at Moderna.
Did your work with the NIH and Operation Warp Speed help potentially smooth out the process at all, like the onboarding of manufacturing facilities, perhaps?
Our work with the NIH was primarily in the vaccine development itself, the science underlying the spike protein that's been well covered, and of course the years of work we've done together on evaluating mRNA as a rapid response technology, and that has been well described and much appreciated by us and every single person who will receive our vaccine. OWS, on the other hand, has been deeply involved in supporting and advising the work that Moderna has done in preparing itself to produce at these scales and to distribute, and that has been essential. I cannot overstate the central role it played. General Perna, Moncef Slaoui, and their whole organization, I think, played an important role. It's unfortunate that we've been in a rather politicized environment where every single action ends up being interpreted multiple ways. But when you strip all that away, hopefully we'll come out of a political environment relatively soon. What they have done is an essential part of where we are today.
Now, what are your plans for unblinding the study and given, for example, the folks who were given the placebo, the actual vaccine? Is that something that would happen immediately?
Emily, that's a topic that is being actively discussed, as you may have seen last week in the previous VRBPAC meeting. I'm sure it'll be discussed in the upcoming VRBPAC meeting, and that's something that we will determine jointly with the FDA in concert, because what we want to do is make sure, on the one hand, we get the emergency supplies of the vaccine out. On the other hand, we ensure that the proper licensure eventually is granted so that we can broadly distribute the vaccine. And yet we need to take care of considerations that balance what is fair and ethical for the participants of our trial and other considerations. So it's something that will yet be discussed and finalized. And as soon as that's determined, it'll obviously be made publicly available.
Now, there are some lingering concerns about side effects and reactions. The FDA says it can't rule out a relationship between the vaccine and Bell's palsy. Obviously, this would be in an incredibly rare instance. But what do you have to say to people out there who might have these concerns in the back of their mind?
I think the key is to follow medical advice, collect as much information as possible, and keep in mind that any treatment, any vaccine, in fact, much of what we do in life is a trade-off between known risks and unknown risks. In this case, we have two known risks: exposure to a virus that has significant and in some cases severe consequences on health, or some conditions, some rare side effects that may be seen and have been studied and compared between various trials and the placebo groups. And so all of that information goes into the FDA's determination, the advisors' recommendations, and then the medical profession looking at all that and making suggestions across the board to their patients, their colleagues, and all of that has to be taken together. I think it's fair for people to be very thoughtful about this, but in the end, it's not as though we can wish this virus away. We're going to have to protect ourselves broadly. We think that a vaccine is an effective molecular mask of sorts. We talk about the mask being the best vaccine. I think pretty soon we're going to be talking about a vaccine being the best mask in the sense that it's onboarded and it protects us through our immune system. So long way of saying, Emily, I think these are fair questions, but they have answers, and they're all in trading the risks of infection and its consequences with the risks inherent in any vaccine, including these ones.
All right, Noubar Afeyan, co-founder and chair of Moderna, thank you so much for joining us. We'll all be anxiously following that meeting that the FDA will have on Thursday about Moderna. All right, coming up, the EU cracking down on U.S. technology, unveiling new rules in an attempt to halt the spread of harmful content and improve competition. Our conversation with Margrethe Vestager of the European Commission next. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
All right, we've been getting some developments out of the stimulus meeting that has been happening between House Speaker Nancy Pelosi and Senate Majority Leader Mitch McConnell. Kevin McCarthy, House Minority Leader, saying he thinks there's been progress after the meeting. They've been taking a quick break and we'll be going back at it. But again, we're following stimulus talks happening between both sides of Congress, and we'll bring you more developments as we have them. Meantime, the European Union is unveiling sweeping new rules for U.S. tech giants with threats of billion-dollar fines and even potential breakups. Margrethe Vestager, European Commission Executive Vice President, says the harsh consequences are, quote, justifiable. She spoke earlier with Bloomberg's Maria Tadeo in Brussels.
Well, what we worry about is competition and a fair marketplace. And we have been consulting extensively. We've been talking with, everyone. We've had experts, member states, parliaments, businesses, organizations. What they worry about is being able to do fair business. And what they worry about is too much illegal content, both product and services. So this is our worry. And of course, we are balancing things, which is why we think that this is, well, quite a proportionate proposal.
And when you were explaining some of the measures, you said that this is not targeting anyone in particular and that you hope you don't have to fine anyone, but nonetheless, you could see 10% fine over your revenue here. Is that something that you're looking to do as a measure if needed, however?
Well, I think that anyone would want to comply with legislation that has been passed by our legislature here, the Parliament, the Council. Why wouldn't you want to do that? But it's also good to have an incentive. And the incentive of a fine of 10% of your turnover, I think that's a good incentive.
And can we read that perhaps as a warning too?
Well, the strange thing is that in my work as competition law enforcer, I've seen a lot. I've seen a lot of practices that has been really damaging for other businesses. Now we say sort of in general, well, these are the things that you must do. These are the things that you should not do. And I think it will bring a better balance into the marketplace. And that is what we need. Because this is actually a bit more than just competition law enforcement and making that general. This is also beyond addressing unfair trading practices. And we have seen that no matter how vigilant we are in competition law enforcement, we need to work hand in hand with regulation in order to have an open and contestable market.
And one of the things you said is that in terms of the gatekeepers or companies that may have too big a position in the market, if that was needed, you could look into potentially breaking up or asking a company to disinvest and split up their business. That is something that investors really worry about and look at that as almost a nuclear option. Is that the nuclear option for you, or are you willing to use that too if needed?
Well, I think that we will have compliance because I think it's proportional, it's reasonable. It's actually what you would expect if you're an investor, that the business that you invest in actually is by the book. If they're not, then it is fines, another fines, repeated fines, behavioral commitments. But there is the option eventually to ask for a divestiture, splitting up a company. I would not expect that we should go there, but as a last resort, I find that it is justifiable.
Okay, so it's justifiable, but it's not something that you're looking to do anytime soon.
No, of course not. What we want is an open, contestable marketplace where businesses can find their customers. This is what we want to achieve.
You also say moving away from competition, that internet that really controls some of the information that goes on, and especially the fake news and really some stuff that is clearly not factual and could confuse the public is equally important for the Europeans. I wonder specifically with Facebook, we've seen a lot of fake news when it comes to COVID, the vaccine, and so on. What are they telling you in terms of A, how quickly they're going to take it down, and are they going to be held liable at one point for that content?
Well, actually, I think that we have had quite a good cooperation with a number of the platforms to make sure that when people are looking for information about COVID and the pandemic and vaccines, that they get sort of official vetted information. So this will not regulate content. But if a member state, for instance, say, well, this is illegal, well, then if you are flagged, this is illegal, you have to take it down. But the other thing is they also have to tell the people who were behind it, we have taken down your content. Do you want to complain about it? Because just as well as it's important for us that what is illegal offline is also taken down as illegal online, freedom of expression is obviously also key.
Margaret Vestager there, European Commission Executive Vice President. All right, still ahead, we're going to bring you some of the top tech trends and stories to watch of 2020 in our new segment, Power Up. This is Bloomberg. It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
I'm Mark Gurman with Bloomberg Technology, and on this week's Power Up, I'm looking at products that stood the test of 2020. While 2020 was a horrific year for so many people, it did push technology even further into the forefront of many of our lives by being key for people working, studying, communicating, and even working out from home. No tech company exemplified COVID-19 related demand, though, more than Peloton this past year. Last quarter, the company's sales grew over 230% from the period in the year before, showing just how much demand there is for the company's bikes and treadmills. Several weeks ago, the company announced a cheaper bike that comes in at under $1,900. That's a couple $100 shy of the new higher-end Bike Plus. Peloton also announced a cheaper treadmill, coming in at about $2,000 less than the higher-end Tread Plus. But that new model doesn't launch in the US until the end of March. But Peloton wasn't the only one to find success in this very challenging year. Apple made record revenue from several products and services, and it transformed nearly its entire product lineup. It added 5 new iPhone models, a bunch of new iPads, new Macs with its own processors, the new HomePod Mini, and new accessories like the MagSafe Duo Charger and AirPods Max headphones. Of course, Apple's competitors didn't let the iPhone maker have all the fun. Amazon launched a new home security camera that flies around like a drone, new car and home security kits, multiple new Echo speakers, and it released its Alexa-controlled eyeglasses to all interested buyers. Google launched a new $100 Nest Audio speaker, the Pixel 5 phone line with 5G, and a new Chromecast TV dongle. Facebook launched the Quest 2 VR headset, while Xbox and Sony PlayStation also debuted their next-generation consoles, which are surely to dominate for years to come. With 2021 looking like another year of mostly remote learning and working, these technologies will continue to play critical roles in many of our lives. I'm Mark Gurman.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Bloomberg Technology. I'm Emily Chang in San Francisco. The mental health industry is receiving a lot of venture attention as companies recognize their remote workforces need more support now than ever. One company seeing a spike in demand in the pandemic is Modern Health, a platform that provides mental health care solutions for employees. The company just raised an additional $51 million in new funding. Joining us now for more, O1 Advisors co-founder and managing partner Dick Costello, one of the investors in Modern Health, and of course also the former CEO of Twitter. Dick, good to have you back on the show. There are a lot of new opportunities out there in health tech, in biotech. Why did you decide to double down on Modern Health?
We just love well, I would say a couple of things. First of all, I'll back up a bit. One of the great things about having run Twitter at scale with over 4,000 employees is you get to see where after you leave, some of your most amazing employees go. And one of Adam Bain's go-to-market leaders and one of the great leaders on the product team at Twitter both ended up at Modern Health. So when that happened, we realized we needed to get to know the company. I would say, secondly, there's just been a massive trend toward adding mental health services as one of the pillars of corporate benefits programs alongside physical health, obviously dental and vision. But like physical health, more and more realization that wellness, overall wellness and stress can be such a hit on employee productivity. And it's not just you're sick or you're fine. There's a whole spectrum of health and wellness. So we just have seen, and we saw at Twitter and we've seen from other companies that we work with, this need to extend employee benefits programs to mental health services, including everything from, full-on one-on-one sessions with therapists to group coaching sessions and other kinds of software modules that services can provide. And Modern Health is a company that provides the entire spectrum of those services. We love the team, as I just mentioned. We had two of our Twitter leaders there. And the combination of the team, their accelerating growth, and the secular trend in the industry made it a no-brainer for us.
The pandemic is one thing, but, we're expecting this work from home period to extend for some people and some companies indefinitely. I mean, Jack Dorsey has told employees that they can work from home forever. I mean, how concerned are you going forward about making sure that employees have the support they need, given, the fact that many of them are going to have been staring at the same four walls and the same screen for at least the last 9 months, if not years to come?
Yeah, look, I think that even you just said it, when we come out of the pandemic, there's certainly been a realization that you can be productive from anywhere for lots of kinds of jobs. And that's not going to go away completely. We're not going to see 100% of people returning to offices. And I think, look, you unless you were on another planet, you can realize the stress that everyone's been under the last 9-10 months. Lack of human connection, not just staring at the same four walls, but homeschooling, the stress of trying to be a parent who's schooling your kids at home while also having a job. It's just added to compounded the usual stress of working really hard at a fast-growing company and dealing with the day-to-day grind of your job. Look at the amount of productivity that's lost in sick days and leaves of absence and all that others and burnout that every company has experienced. So we just think that this is COVID has only accelerated this, the demand for the services, the stress that employees are under, and I don't think that goes away when the pandemic is behind us.
Now, you've been investing for a few years now since leaving Twitter, and I'm curious, going into 2021 in this unprecedented environment, where are you placing your bets at O1?
Remarkably enough, considering that Adam and I, built what I guess many would consider a consumer platform, Twitter, even though the business was really B2B, it's us selling to advertisers and other businesses. We're sort of agnostic to where we invest in technology. We're probably not doing a lot in hardware because we don't understand supply chains that well. And one of the things Adam and I really try to focus on is going into places and investing where we can help mitigate execution risk and help with scaling. But in the software space, we have tended to invest more in enterprise SaaS companies. Those just happen to be the kinds of companies that we've come across and loved. Maybe it's the fact that we have we know more about consumer tech, so we know the right questions to ask and find reasons to say no to more consumer tech companies. But we've ended up investing more in enterprise SaaS without really a preference for it. That'll probably continue. There's so much momentum in the space. I think some people have thought the party is over in enterprise SaaS, but there's so many other problems that need to be solved. Every company in the world is becoming a technology company or needs to become a technology company. So the total addressable market for some of these enterprise SaaS companies is huge. I think if you had looked at companies like Twilio, Okta, et cetera, maybe 5 years ago, you would have said, well, sure, they're a couple $1 billion companies, but they can never be 10 or $20 billion companies. Well, now they're 10 and $20 billion companies and growing and growing and growing. These kinds of companies can grow forever. They're snowballs rolling down a hill, and we love them.
So let's talk about that. Wish is poised to go public tomorrow. The e-commerce retailer, they just priced their IPO $24 a share at the top of the range. I'm sure you've been following Airbnb and DoorDash. Airbnb and DoorDash both pulling back over the last few days after their exuberant receptions on Wall Street. Even Brian Chesky was at a loss for words when we told him that the shares had doubled at the opening. Are these valuations in line with potential, or are they insane?
Yeah, Brian's experience gave me PTSD. I had the same reaction the morning of our IPO. Look, I think that the markets, are private and public, are underpricing risk. Meaning, valuations are high, and I say that because you have the sort of hard Brexit right around the corner. What looks like that's going to be really, really rough for the UK, meaning no deal Brexit. The political strife in the US, the ongoing political strife in the US, this K-shaped recovery with, depending on what the next stimulus package is, lots of benefits running out, lots of evictions from landlords right around the corner in January. So the market seems to be ignoring all that, which I think is weird, but it's been that way for a number of years now. Having said all that, we've been talking about valuations being too high for 10 years now almost. I remember, you can go back, give you just a couple examples. When Figma raised their Series B, the WYSIWYG design platform, for those unfamiliar with it, a couple of years ago, people thought the valuation was crazy based on the annualized run rate. And probably, any external observer who didn't know the business or understand the future of design would have looked at that and said those investors were insane. Well, that now looks cheap. So I think that those kinds of things happen. And then the experience with one or two of them makes people not want to miss out on the next one. And they pile into the fourth, fifth, sixth, and seventh company at big numbers, and they're not all going to work out. So I think overall, the markets, public and private, are underpricing risk, but they've been doing it for a while and no one's gotten hurt by it. So it's going to continue to happen until there's a big 20 to 25% correction.
Okay, so do you see a correction coming? I mean, are you telling your entrepreneurs, raise now while you can?
No, because
is this going to go on for a few years?
Well, I'll tell you precisely what we tell them. Sort of the same thing we told them I would say a couple weeks into March during the shelter in place. So look, make sure you've got an operating plan that you could move to in the immediate future. That's a 25% cut to OpEx on a, what if there's a massive externality that comes alongside this pandemic that tells us everything's shutting down, budgets are shutting down. Make sure you've got that plan in place so that if something like that happens, you're ready to move to it instantly. Obviously, a lot of companies found themselves in the position where they had to move to it instantly, Airbnb being one of them. And of course, as we all know, in hindsight, they came right back and grew faster than ever. So what we've told CEOs and CFOs is put a plan in place, put a what-if plan in place. That's if we need to cut OpEx by 25% going forward, and make sure we've got enough runway for X months, X years. What does that look like? And let's be able to move to it quickly and nimbly if that happens. But, I think it's hard to just say, do it now, everything's great. As I've just mentioned, for 4 years, it seemed like the market is underpriced risk, and here we are higher than ever.
Now, scrutiny is rising on big tech, and the FTC just sued Facebook, suggesting Instagram and WhatsApp that those acquisitions should be unwound. As somebody who competed against Facebook for a very long time, what do you think? Is Facebook too powerful? Is it anti-competitive? Is a breakup in order?
I had the most awesome wavy set of hair before I started competing against Mark at Facebook. I think that all the tech companies, I won't just comment on one of them. I think that all the tech companies are under increasing regulatory scrutiny. I think that's going to be a global reality for all of them. The challenge for these companies is they don't really cooperate. There might be some cooperation between teams, but because they compete so directly and generally and so fiercely, and in many cases for talent, for customers, et cetera, they just don't get together and share information or work together and collaborate like competitors in some other industries do, where there's an industry lobby, what have you. So the challenge for these companies is they're kind of going in one against many on against all these governments and not collaborating, and that's going to result in making it, I think, easier for regulators to come after them. The companies won't know necessarily what each other are saying, what each other are doing. They're probably saying things like, "You shouldn't come after me for anti-competitive practices. Here's a list of the 9 things, Apple or Google or Twitter is doing." So I just think that's going to not serve them well, and going to be a problem for the industry in general, and going to result in many of them being more strictly regulated than we're even talking about today.
Now, President Trump has spent much of his time in office using Twitter, exhausting Twitter employees, I'm sure, accusing the company of anti-conservative bias, arguing for Section 230 to come to an end. What is your outlook for Twitter under a Biden administration? Does the drama die down when he leaves office?
The drama never dies down at Twitter. That's the reality. Look, it'll just be every user of the platform has 10 great ideas that are obvious to that user that Twitter should do to quote unquote fix Twitter. And they usually include silencing voices that think things differently than they do, or engaging in the prohibition of speech that they think should be prohibited. And the company has to balance those hundreds of millions of strong points of view about what those 10 obvious things are that each and every individual user thinks need to be done immediately. So it's probably not gonna make life just a bowl of cherries over there, because there's always gonna be some next issue that the company has to deal with that we don't know about today. And it will be a new kind of issue that the industry hasn't had to think about before and will struggle with. That just happened sort of every couple months when I was running Twitter, and that was before Donald Trump was even running for president. So, probably it's a little easier on them because you won't have someone who's got them directly in their sights, who's shouting at them every day. But the drama won't go away, and there will be some other set of issues that come up that the company will have to deal with, and it will continue on a regular basis, like for the foreseeable future.
I had a feeling you might say something like that. Dick, always appreciate your frank and sharing your prior experiences with us. Dick Costello, co-founder of O1 Advisors, former CEO of Twitter. Thanks for coming back on the show. All right, coming up, SolarWinds, a Texas-based software maker, has suddenly become the epicenter of the most sprawling cyber attack on the U.S. government in recent memory. What is SolarWinds, and why did hackers target them? We're going to find out next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
There's a need and a clear need for me to spend money. I need to spend money to boost the economy, the necessary push. And therefore today, as of now, and for this fiscal, I shall not worry about the deficit number.
Government agencies and major corporations outside the United States are reviewing their computer systems for signs of security breaches. This after the U.S. government was hit by one of the most audacious cyber attack campaigns that inserted malware into software updates from Texas-based company SolarWinds. Joining me now for more, Bloomberg cybersecurity reporter William Turn. So, William, what is SolarWinds, and why did hackers target them?
So SolarWinds, simply put, is an IT company. They make a product called SolarWinds Orion, which allows organizations and companies to kind of monitor this. You know, a lot of people I've spoken to have said it's really useful software. You can see when a server or router goes down. But because of the nature of this software, it peers really directly into a network and has a lot of access. So that means that if you were, say, a Russian intelligence agency trying to sneak a secret piece of malware into all of the U.S. federal government, well, SolarWinds would actually be a really great place to start because, they provide their services to all 5 branches of the U.S. military, countless federal government agencies, more than 400 of the Fortune 500. So, this is kind of an ingenious hack they pulled off and kind of one of the great feats of cyber espionage that we've seen in a long time.
Is this a sort of tried and true methodology, or is this something new, the way that this was executed?
So, this has actually been kind of a problem in cybersecurity for as long as I can remember. If you can hack something that, as part of the update tool, right, you can kind of trick, in a way, your target into accidentally downloading malware, right? You think about updating your iPhone, right? You download the update from the internet, but if someone can get in the middle of that update and inject malicious code into it, you're unknowingly downloading a virus or malware into your system.
So, how many government agencies at this point were the hackers able to infiltrate, and how damaging was the ultimate attack?
Well, that's a great question, Emily, because we don't know. We're still learning. We first learned, Reuters reported on Sunday about the Treasury Department, and every day since we've learned about new agencies that have been targeted. So we've learned about Treasury, we've learned about DHS, State Department, Pentagon, and more almost certainly will come out. And as far as the damage goes, it's impossible to say. We just don't know right now. But, this attack has been going on since at least March. But, it's hard to know exactly when they got to which agency and how, what they took and why.
What has the U.S. government response been so far?
So it's kind of been a mixed bag. The head of the Cybersecurity Infrastructure and Security Agency, Chris Krebs, you might recall, was fired by Donald Trump by tweet for accurately stating the election results. So the head of the agency that would be in charge of, coordinating the response to this got fired by Trump a month ago. So, the National Security Advisor, Robert O'Brien, is cutting short an international trip and coming back for an emergency meeting with the National Security Council. I think they're kind of coordinating an all-of-government response, hopefully. The intelligence community, the Office of the Director of National Intelligence just put out a statement saying that they're working on the response, but it kind of remains to be seen exactly how well that's going.
All right, Bloomberg's William Turton, thank you so much for that update. It's certainly fascinating as we get more details about how this hack was pulled off. All right, coming up, a much anticipated podcast is set to debut on Spotify next year, produced and hosted by a couple that's recently tried to stay out of the public eye. That is next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
What's ahead for entertainment in the new year? Well, a royal welcome, you could say. Spotify is teaming up with Prince Henry and the Duchess of Sussex, Meghan Markle, to Prince Harry, to produce and host a podcast. With me now for more, our Bloomberg News entertainment reporter, Lucas Shaw in LA. So Lucas, tell us everything we know, everything you know. How will this work?
Everything you know so far is just a little bit, but it is still big news for Spotify. The company announced this morning that the Duke and Duchess of Sussex would be hosting and producing shows and had signed their company had signed a multi-year deal with Spotify, and that the first of those shows would arrive sometime next year. They didn't say much beyond that, but I think, I'm starting to look at this sort of like, Harry and Meghan are following the Obama playbook, where first they had the Netflix deal, now they have the Spotify deal. And they're using kind of their fame and their influence to make projects that both mean something to them and potentially entertain viewers and listeners at home.
So how much are Harry and Meghan themselves going to be involved? How much are we going to hear their voices? How much are we going to see of their personality?
Spotify didn't say a ton beyond the fact that they would be involved in hosting. And my hunch is that there will be at least one show that's sort of like the Michelle Obama podcast. The Obamas signed this overall deal with Spotify, and their first show was Michelle talking to some of her friends and other people that interested her. There was journalist Michelle Norris. There was comedian Conan O'Brien. So you could see Meghan do something similar to that, or they may decide to host a show in which they explore some topic that is of interest. The world is sort of their oyster in that regard. I can't imagine that they're going to be full-time podcasting. In addition to the deal that they signed with Netflix, they have a philanthropic fund. They have family to worry about potentially in the long term. And so I think it's just kind of one of many parts of their media arsenal.
And Netflix has clearly had a banner year, even given the production issues caused by the pandemic. New shows keep coming. There just was a new season of The Crown, which sort of made me wonder, is there any awkwardness given that The Crown, which is, a pretty brutal take on the royal family, did that impact this deal at all?
It did not. It didn't seem to stop them from taking Netflix's money, although very few things do these days. The next season of The Crown is the one that I assume will deal with Diana's death, and there will be a season after that, which one assumes would deal with her children. It could get a little sticky then, but again, this is a case where Netflix has written a large check for the two royals to kind of do whatever they want.
Well, as somebody who watches The Crown with great fascination, definitely wondering what their take will be on the modern day royals. Bloomberg's Lucas Shaw, who covers entertainment for us in LA. Lucas, thank you so much for that update. And that does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. Bloomberg Daybreak Asia coming up next. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. This is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements we can actually have the superb measurements that we expect of sea level rise, but also the waves, the significant wave height, which is the top 1/3 of the waves if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
I feel really lucky, having stared into what felt like an abyss for travel. and then to kind of rally together with thousands of people and rebuild the company from the ground up, something that I think is stronger than it ever was before the pandemic.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome to Daybreak Asia. I'm Sharian in New York.
And I'm Heidi Stroud-Watts in Sydney. We are counting down to Asia's major market opens. Our top stories this hour. Asia will look to extend Wall Street's rise as Congress moves towards a new virus relief package. The S&P 500 snapped its longest slide since September. MSCI is ready to delete the Chinese companies denounced by President Trump for links to the military. They include Hong Kong-traded chipmaker SMIC and Hangzhou Hikvision. And taking stock, we hear exclusively from Charles Lee as he prepares to bow out after a decade in charge at the Hong Kong Stock Exchange.
We have breaking news out of South Korea. We are getting the November adjusted jobless rate coming in at 4.1%, which is better than expected, and it's also a fall from the previous month. We have seen, though, job losses across the board, 273,000 jobs removed in November from a year earlier. Of course, we do have South Korea still suffering from that third virus wave and perhaps more pressure on the labor market, especially in the services sector. But for now, it looks like that the jobless rate is down to 4.1% from 4.2% the previous month, and also beating expectations. Right, Australia coming online. Let's get straight to Sophie for a check of the market. Soph.
Sherry, Aussie stocks opening higher by a third of 1%, with tech name Afterpay leading the chart so far. BHP also gaining ground. The Aussie dollar looking steady this morning after a choppy session that saw it test a June 2018 high, while the greenback is near a two-year low. Kiwi shares gaining ground ahead of the mid-year economic outlook. A little change, though, for the Kiwi dollar. The currency looked to, though, for clues on how to react to the upcoming policy decision this Wednesday. Now, flipping the board after the S&P snapped a 5-day drop. Let's take a look at how futures are trading. You have S&P E-minis, a little change, but to the upside, and WTI opening lower this morning after jumping to a 10-month high. Now, CFRA Research's Stuart Glickman warns that folks are forgetting that there's a couple of triggers that have to happen before oil demand can really come back, and the IEA coming through with a dismal outlook on that, trimming its demand forecast for oil for next year. Keeping an eye on the pound as well. Cable holding above 134 amid a Brexit deal chatter. And Nikkei futures, a little change in Chicago. We're keeping an eye on JGBs, of course, after the 10-year yield fell to zero for the first time in 4 as traders assess Japan's debt plan after the cabinet approved the third extra budget. Heidi.
All right, well, the U.S. Congress may be facing a make-or-break moment on the virus relief package. Our global economics and policy editor, Kathleen Hayes, has the latest on these evening talks that will culminate in what is going to be a crucial meeting for congressional leaders. Kathleen, so we're getting incrementally closer that there's the will on both sides of the aisle for this stalemate to be broken.
Well, it certainly seems that way, Heidi. And of course, a lot has changed. Maybe one of the biggest things that has changed over these past few months is the presidential election is over. Joe Biden is winning the White House, has won the White House, the president-elect. And so now Democrats have moved into a somewhat different position to perhaps even pass a very pared down stimulus package that they resisted for months before Biden made that victory his own. And of course, Republicans have been saying they want certain things that they're willing to drop now, too. But let's kind of back up a little bit. The meeting that started at 4 o'clock ended just before 5 o'clock. It included the leadership of the 4 major leaders. When you take a look at the 2 parties, Nancy Pelosi, the House Speaker, and you've got Steve Mnuchin, the Treasury Secretary, who she invited to join her, along with Chuck Schumer, the minority leader in the Senate, Mitch McConnell, the majority leader in the Senate, and then Kevin McCarthy, who is the House minority leader. And what they have done is is start going over the package that the bipartisan group, the Gang of Eight, put together. And what's important about this? Well, a couple of things. It's a slimmed down version of the original package, even of their own original package, because instead of being $908 billion, it is now $748 billion, because they have dropped two things that have been very contentious. One of them is aid to cities and states, and that's something the Democrats have pushed hard for, and the Republicans pushed back. Flip it over, then you look at the liability protections for employers because of virus issues. That also has been dropped. So now we're just waiting to see what they can hammer out. It looks like they're making progress. They've got to have something in place by Friday, because they have to pass something to keep government spending, the budget from sort of closing down at that point. So the pressure's on. But during the break, Washington Post reporting that Nancy Pelosi saying we're still talking to each other. Or excuse me, that's Mitch McConnell. I think there's an agreement. We're not going to leave here without the spending bill and the COVID package.
Mitch McConnell also talking about a different issue, and we know that his silence has meant the world actually said a lot, and that was that Joe Biden actually won the presidential election.
Well, Joe Biden is now being recognized as having won, of course, after the Electoral College tallied all its votes and said, yes, he has won. He is the president. Mitch McConnell and other Republican leaders have held back from making this endorsement, while there were a number of lawsuits put forward by Trump's team saying that the election, some votes have been lost, some votes have been thrown away. You want to broadly call it fraud, but there's so many anecdotal reports on this kind of thing that it's not surprising they have pushed this. At any rate, McConnell is now recognizing Joe Biden, and I think not surprising also that Joe Biden called Mitch McConnell to thank him for the congratulations. He, like a lot of others, is expressing optimism that after having been in the Senate himself for so long, Biden can reach across the aisle, and people he's worked with in the past, like Mitch McConnell, will be willing to reach back. Heidi, it all remains to be seen.
All right, our global economics and policy editor, Kathleen Hayes there. Well, joining us now for more on those market moves, Research Affiliates Head of Equities, Feifei Li, is with us. Feifei, great to have you as always. So we see this kind of incremental progress towards finally pushing through a stimulus deal, and it definitely feels like this is a market that is very much wanting to focus on the good news and heavily discounting the bad news or the setbacks, right? Is this something that is already priced in, the idea that there will be a stimulus package passed?
So you're absolutely right. I think what we have seen in the market over the past few days, including last week and this couple of days, this week, is really reminding us the biggest driver for the 2020 stock market rebound is the policy support. So the physical stimulus talk seems to be stuck. You see the market reacts very negatively to it. And, today there seems to be like there is a good chance the talk actually can go through by the end of this week. Then the market reacts very positively to it. I would say there is still uncertainty down the road, but, it seems like all the leaders from different parties have indicated their commitment to reach some agreements. So likely the market is pricing in a very significant positive probability for this bill to be passed.
So the markets find itself, it seems like in a weird space at the moment, right? There's vaccine optimism, but cases are rising. We're looking down the barrel of potential more lockdowns in the US. So on the balance of things, where do you put your money in your portfolio, knowing that it is probably going to be some months, potentially a year away before we're out the other side of this and the vaccine rollout and the immunity actually takes hold?
Yeah, I think you're right. However, I also think, the market typically goes way ahead of the real economy. So, I've been recommending investors consider value in a small cap for a while, or since earlier this year. So I think in November, finally, value had a pretty awesome month. I think the promising vaccine news is really the strong tailwind, and likely become even a catalyst for the value rebound. Lots of investors just started de-rotating out of the growth-oriented sectors such as tech and healthcare and get into value sectors. I think with a deployable vaccine solution, the infection curve will, likely consistently drop, and economic lockdown, social distancing policies become less necessary, and cyclical stocks value stocks will benefit tremendously from the resumed mobility of the economy when the COVID-19 challenges dissipate.
Talking about extreme positioning, this GTV chart on the Bloomberg showing how we're seeing these record short bets on the U.S. dollar. Where is the dollar headed at a time when we have already seen significant depreciation, not to mention that we do have those risk events in January with the Georgia runoffs?
I would say, the currency in the short run is very dependent on the interest rate differential and the inflation differential. I think both don't really look that great for dollars. I think the low policy rate in the United States just makes it not very attractive to hold dollars, no carry yield. In addition, when people expect the vaccine will really drive global economy grow much faster than 2020, basically the safe haven role played by U.S. dollars is ending. Risk appetite grows. Investors no longer need that much dollar. And also U.S. inflation, I think, goes up much faster than people expected. Even though the Fed has been saying, the inflation likely will stay low, for the next couple of years. But if you look at the supply side and the demand side of the goods, basically all the government is doing is trying to maintain the personal income at high level to stimulate this particular consumption, government stimulus checks and also unemployment insurance payments. So the supply side is actually much, much weaker because U.S. didn't really do a good job to contain the virus spreading. The industrial production, unemployment rate still remain pretty depressed. So it just means that there's a gap between supply and demand, too many dollars chasing after to feel good. So I think inflation in the U.S. will rise. Both of those, I think, just bad news for U.S. dollars.
On the other side, then, good news for the Chinese yuan, especially as you mentioned, the rate differentials that we're seeing on this GTV chart on the Bloomberg with the 10-year Chinese sovereign yields premium at record highs over treasuries.
Yeah, certainly. I think for Chinese yen, actually, we have experienced a pretty rapid appreciation over recent months because I think, like you said, I think the rates are high in China. Policy rate is higher, and also the inflation. I think there was relatively high leverage in their residential sector. So which means not much inflation pressure, and the supply side, production came back really, really quickly from the bottom Q1 this year, right? So likely interest rate will stay there for a while, and the domestic demand may not be very strong. I think right now it looks really good for yen, but going forward in 2021, 2022, I think there is also less room for yen to further appreciate because, overall vaccine will help the global economy to recover.
Fei-Fei,
so
great having you on.
Rates will
Thank you. Fei-Fei Li, Research Affiliates Head of Equities. Still ahead, Stanford University Hoover Institution Senior Fellow and Bloomberg opinion writer Neil Ferguson shares his concerns as nations load up on debt to mitigate the economic impact of the pandemic. But up next, MSCI is the latest to announce it will delete Chinese companies such as SMIC from its indices following moves from S&P, Dow Jones, and the FTSE Russell. More on that. Plus, don't miss our exclusive interview with Hong Kong Exchange's outgoing Chief Executive Charles Lee as he prepares to bow out after a decade in charge. This is Bloomberg.
give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. U.S. drug regulators say Moderna's COVID-19 vaccine is safe and effective, clearing the way for emergency use authorization. The FDA says the shot is 94% effective, confirming Moderna's earlier results. The news comes as reported cases continue to rise. New York City faces a possible stricter lockdown right after Christmas. Denmark is extending its lockdowns to the entire country, and Italy may impose further social curbs. In other news, the Japanese government has approved a third extra budget with more than $200 billion in spending to support the economy through the resurgent coronavirus pandemic. The plan includes money for domestic travel incentives that ministers suspended this week. That creates a problem for Prime Minister Yoshihide Suga, who is halting a stimulus measure he originally championed. The Malaysian Prime Minister has survived another leadership test, with lawmakers approving a budget for 2021. Defeat for Muhyiddin Yassin's spending plan would have been the same as losing a vote of confidence, and the result reinforces the wafer-thin majority the Prime Minister holds in Parliament. Fitch has cut Malaysia's rating, saying that narrow majority implies persistent uncertainty. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
MSCI says it will delete the securities of 10 Chinese companies referenced in an executive order signed by President Trump in November. It marks the latest step to delink companies the U.S. claims have ties to the Chinese military from foreign investor flows. For more, let's bring in Bloomberg Markets co-anchor Tom McKenzie in Beijing. Tom, so what more do we know about this decision by MSCI?
Well, MSCI is saying that they've heard feedback from more than 100 of their clients, US clients and non-US clients as well, market participants, institutional investors, who've said that they are very concerned about having exposure to these companies, to these securities that, as you say, were included in this executive order signed off by Trump in November against companies and banning the investment in these companies by US investors because of what the US administration says is their links to the Chinese military, the Chinese security services. So it's on the back of that concern from the clients of MSCI. That is why they're deleting these 10 securities from the global investable market indexes that they compile. Now, in terms of which names are on the list, the executive order applies to 31 Chinese companies. The ones that are being deleted from the MSCI global investable market indexes include the likes of semiconductor maker SMIC, but also Hikvision as well, the surveillance camera maker, also the likes of China Railway Construction and Dawning Info, amongst the 10 that will be deleted. And again, this decision by MSCI follows weeding out of these companies by other index compilers, including FTSE Russell and S&P Dow Jones, that are all looking at their indexes and working out which companies they're going to have to be taking off because, of course, there are concerns amongst investors that they're going to be exposed to this executive order.
And of course, Tom, this is kind of tying into just a broader push by the Trump administration, even in the last weeks of that administration, to decouple from China.
Yeah, the rationale is they don't want US money and US funds going into companies that could pose a security to risk to the United States, either now or in the future. That is the rationale from the US side. Now, it should be emphasized that China has said that it opposes these measures, and they have warned that they could publish their own blacklist of US companies. Companies like SMIC, by the way, the semiconductor maker, say they only produce semiconductors and equipment for commercial use. They say they don't have any military ties. This company, by the way, SMIC, is one of the best bets and had been one of the best bets for China to build out its own indigenous set of semiconductors to become less reliant on the likes of Qualcomm and Nvidia and Intel, even if that was a few years off. So just for some context, that company, again, saying that it only aims to produce products for commercial use. But yes, you're right. This is part of that further tightening in terms of fund flows into companies that the US sees as a risk.
Marcus Cowan, Tom McKenzie there in Beijing. Well, despite the tensions between Beijing and Washington, Hong Kong Exchange's outgoing boss, Charles Lee, says the city's links to the mainland are irreversible. He's predicting that his successor will need to double down on that strategy after he steps down at the end of the year. Charles Lee spoke exclusively to Sophie Cameron about the role that HKX will play in that future.
The Chinese market will never be like the international market in its entirety. The international market will never be able to suit into a Chinese market, but there will be enough, middle ground where they do intersect. It is in that intersection that Hong Kong have to find the most relevant role to play, because Shanghai will play in that role, Singapore will play in that role, other people will play in that role, but Hong Kong is the only one who can truly go in between and need to find a way, because that role initially is small, becoming bigger and bigger, and then eventually stabilize so that the American will still be here, the Chinese will be here, there will be something in the middle. Then when that middle size is no longer growing, then Hong Kong just need to go deeper.
Now, there was momentum towards embracing Chinese assets. We've seen index compilers, for example, including those equities on their indices. That has stalled somewhat given the U.S. sanctions imposed by the Trump administration. What are the implications of that on China's attempts to integrate into the global markets and its liberalization on the mainland, as well as Hong Kong's role in this?
If you look at that global map, invariably you will walk away with the conclusion that China is the place where yield is going to be, because fundamental economic development is stronger there. The consumer class is growing there. The people are getting more wealthy. The currency is becoming stronger, and their supply chain is as resilient, as strong as ever. While this decoupling will continue to put stress on the respective economies of each other, I think relatively speaking, the Chinese market will become increasingly more important for global investors. So, yeah, government, policy makers, individual political figures can always do whatever they wanted to do that could potentially create short-term, temporary impact on a more localized target. But as I said, finance money is like a water. You can't block water. You can block water from one area. You can't block water all the time. Water is going to sip through it. If you block it, it's going to sip through it. It's going to go up to the sky, and then it's going to rain into the other side. They will find a way to get there. You can't really block it. It's not very easy to push water uphill.
And what are your thoughts on banks complying with U.S. sanctions on Chinese and Hong Kong officials?
Well, I think banks are global businesses. A lot of the government have developed very intrusive, sometimes arguably quite arbitrary tactics when they want to achieve certain policy or political or regulatory goals. So the banks have no choice, and they need to be overly compliant. And sometimes that brings unnecessary and also unfair and unjust consequences to their customers. But as I said before, our societies, our politics today, nothing is free. Every action has cost. It's just sometimes, unfortunately, if you happen to be the one who have to incur the cost, what can you do?
HKX Chief Executive Charles Lee speaking with our markets reporter Sophie Kamarudin. We'll have plenty more to come on Daybreak Asia. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Not only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
A quick check of latest business flash headlines. Apple analysts see strong demand for iPhones, sending shares to their biggest intraday gain in more than a month. A Nikkei Asia report underpins the optimism for the iPhone 12, saying Apple is planning to make 96 million handsets in the first half of next year. That would be a 30% increase year on year. Wedbush analyst Dan Ives says the $96 million figure is well ahead of street expectations. Violent protests at an iPhone plant in southern India are said to have caused no long-term damage, but a bill worth more than $7 million. The Tamil Nadu factory was operated by Taiwan-based Wistron. The protests were driven by anger at wages and working hours. Wistron is evaluating the damage to resume production and is working with police, local authorities and its insurer. Cloud computing company Snowflake extended a 3-day slump after the expiration of a lockup that stopped insiders from selling shares. The stock fell as holders had their first chance to cash out since Snowflake went public in September. It's down about 17% from last week's record, raising about $20 billion in market value. Revenue is forecast to jump 80% next year. And don't miss a big interview coming up later. Dell recently reporting earnings that beat the street. We'll be speaking exclusively to the president for Asia Pacific and Japan, Amit Midha. Well, coming up next, we'll take a look at the debt that's piling up, nations borrowing to get themselves through the pandemic. Stanford University Hoover Institute Senior Fellow and Bloomberg opinion columnist Neil Ferguson is with us next. This is Bloomberg.
With a new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
Before Christmas, about half a dozen central banks will announce rate decisions. The Fed, BOE, BOJ, along with the Philippines, Indonesia, and Thailand. Let's get to Sophie in Hong Kong with a look at how the emerging market fixed income arena may play out next year.
Well, Sherry, first let's paint the context here. Going into 2021, EM central banks, they are under pressure to reverse course after altogether easing the most than during the 2008 crisis. But Bloomberg intelligence cautions that disinflation will persist, keeping monetary policy dovish, and heavy debt burdens to cushion the virus impact will likely see heavy fiscal scarring as well. And on the DM rate side, that's seen normalizing. So the risk to EM here is if yields in the U.S. rise too quickly and tighten financial conditions, which could spark a sell-off. But with EM economies emerging from the pandemic-induced slump for fixed income, local currency debt may benefit. And with U.S. yields likely staying range-bound next year, Bloomberg intelligence strategists say that credit spreads will likely be the main driver of EM dollar debt return. So flipping the page, as things stand here, these are the fair value estimates for credit, forex hedge rates, and currencies. You have EM credit at around 3 to 4%. For forex hedge EM rates, that's between 2.5% to 3.5%. And for emerging currencies, that's seen at -2 to 4% right there, Heidi.
Right, Standard Life Aberdeen Chairman Douglas Lynch says risks to markets and the economy will remain well into 2021. He spoke with our markets co-anchor Haslinda Amin.
I don't think markets are complacent. I think there are elements of froth within the market that people will look back on and say, how did that happen? And that happens from time to time. But I think that, you know, albeit that the markets are going through a period of divergence at the moment, I think what is interesting is the fact that the financial infrastructure, the architecture of the system has held up extraordinarily well during this period. And I think, you know, one of the observations I would make is if it hadn't been for all the work that was done by the industry, but more importantly by policymakers and government to enhance the resilience of the financial system post the global financial crisis, we would have had a financial crisis alongside the pandemic, which would have been devastating.
Markets seem to be, you know, pricing in pretty much a Goldilocks situation with the vaccine in particular. I mean, it will take time.
It will take time, and I think the impact of the vaccine will take longer than many people hope. I think the market, in a way, is discounting a more rapid rollout and impact from the vaccination program. It's going to take well into the end of next year and maybe even into 22 before we've got mass vaccination across all segments of society and across all countries. So we will have to wait and see. Having said that, there are many sectors that are going to benefit from the reflection that has been given across many economies in terms of how to build back the economies that have been damaged. I mean, we are seeing a tremendous amount of interest in ESG investing, largely because people can recognize only with collaboration, cooperation, and building resilience into economies can we be better prepared for the next time there's some event that threatens the global economy.
Do you see countries looking at the mounting debt in the coming year at all? I mean, how will they pay for the spending spree? Is it too early to worry about that?
It's not too early to worry, but it's too early to think that you could do anything different from what's being done at the moment. I think policymakers have got an incredibly hard judgment to make at some point as to when do they withdraw stimulus and not precipitate a depression, a slower economy recovery than would otherwise be the case. And that is an incredible judgment. So in the meantime, what they've got to do is, in my view, use this unprecedented period of low interest rates to build the infrastructure that builds productive capacity and creates employment. It's important that the lending that's done in the next few years goes into productive assets as opposed to financial assets and government debt and residential mortgages, for example.
2020 has been defined by COVID-19. What will define 2021, you think?
I think it'll be defined by the pace at which societies get out of lockdown. I think that we're assuming that vaccination will accelerate that. But if we have a third wave in Europe, if the US wave continues and we see further restriction on people's ability to go out and consume, I think that will slow the economic recovery that we're looking for in Western markets. So I think it will be defined by the success of the vaccine program, I believe.
Is there a risk that the market is underestimating?
Yes, I think so. I think there's euphoria on the basis that we now have a vaccine, which is fantastic. In fact, the good news is not that we have a vaccine. The good news is that we've got 3 at least vaccines and probably another 3 or 4 on the way. So we're going to have a smorgasbord of vaccines that will be probably more effective in different cohorts, and therefore a tremendous array of vaccination opportunities. But I think there is still a tremendous amount to be done in terms of the logistics to get the vaccine manufactured at scale and then transported and then distributed, and then to have a program of vaccination that gets us to the point where society is protected. And I think one of the things we all worry about is whether the fake news on social media discourages too many people not to get vaccinated when they should. And I think that's something that's going to be a challenge to deal with, and it's really important that people speak up.
Thunder Life Aberdeen Chairman Douglas Flint there. Now, the global pandemic is leading to a mountain of IOUs around the world. To discuss the surging fiscal burden, joining us now is Bloomberg opinion columnist and historian Neil Ferguson. Neil, always great having you with us. Of course, we've known for a while that fiscal hawks have gone extinct. Deficit spending has become a habit now. But does it really matter at a time when we're seeing historic lows for yields?
Well, obviously, it doesn't matter in the short term. And that means certainly into the middle of next year. But I think it's important to recognize that we're going to be coming out of a pandemic, not a financial crisis. And that is a very different thing. By the time we've got to something like herd immunity, which I'm estimating in the US will be around about May, through vaccination and natural immunity, because people have had the disease in significant numbers, the economy is going to bounce back much more vigorously than happened after the financial crisis. After the financial crisis, balance sheets were impaired, bank balance sheets and household balance sheets. That is not going to be so true in 2021. In fact, household balance sheets are going to be in terrific shape. There's going to be something in excess of $1 trillion of accumulated savings that people haven't been able to spend this year because of lockdowns and other measures. And I think there will be a surge of consumer spending on services by the middle of next year. So it's going to be a very different dynamic from the period after the financial crisis. And that means that I think that there might be, and I hesitate to say more than might, some inflationary pressures visible towards the end of next year. And that's probably the thing to watch.
Does that mean that we should be thinking about the Fed not in terms of just raising rates or trying to do anything else than do what the BOJ has been doing, some sort of yield curve control?
Well, I think the best analogy here is with the later stages of World War II and the post-war period. At that time, the Fed and other central banks were essentially reduced to being managers of government debt. Their job was to keep the real rate on a very large stock of debt low. And that's actually the situation that the Fed is in now. In effect, it's a debt management agency. And that probably is fine for the short term, because in many ways, COVID-19 has been like a war. And it's been appropriate that the Fed's essentially adopted this position. But in the post-war period, after World War II, there was a tremendous boom in the United States. And I think it'll be somewhat similar in the post-pandemic period. And the Fed's going to have a little trouble on its hands, I suspect, because it's changed its framework. It said it's happy to go above target, above a 2% inflation target, because it wants to kind of average out inflation. And it's been under target for so long that a little bit of above target inflation will be okay. But the question question is really what happens if it gets quite a bit above target. Will markets simply sit back and say, you know what, we don't really mind negative rates on these Treasury issued bonds, it's fine. Or is there going to be, in fact, some tension between the Fed and the market, particularly if you think about those 30% of bonds that are held by foreign investors? If the dollar is weakening at the same time as inflation is going above target, I think that's when you're going to see some stresses and strains. And it will be very important for the Fed to make sure that it keeps control of rates. Because, of course, if you start seeing a breakout of rates, if the Fed shows signs of worrying about inflation, then I think you're going to find yourself worrying a lot more about these large debt burdens that have accumulated. Remember, the thing about a debt, and this is something I agree with my old friend Larry Summers about, is it's not really the relationship between the total debt and gross domestic product you have to worry about. It's the cost of servicing the debt. And when the debt is a large number, then very small movements in rates have big consequences for debt service.
And of course, that debt to GDP ever even more skewed because of the fall in GDP as a result of the pandemic. But Neil, I'm wondering, do we also perhaps more so need to worry not just about debt serviceability and capacity, but also productivity? Because if you take a look at China, we've seen GDP falling alongside productive investment. Is this really a cautionary tale for other economies?
I think China's in a very different situation from the developed countries of the West. In China, I think people are perhaps overestimating where growth is going to go next year. And I tried to make the point in my most recent Bloomberg opinion piece that I actually worry a lot more about China's private sector debt than I worry about public sector debt in the United States, because that very high level of household and non-bank industrial debt is a reason why China's policymakers are going to be reining in the economy next year. Liu He, in particular, Vice Premier, who's no longer needing to worry about a trade war, is looking at China's financial situation and saying it's time to clean house. And I think you're going to see stresses and strains in the corporate bond market, in real estate, in local government financing vehicles next year as the Chinese authorities try to rein in the private sector debt and to avoid the excesses of the Chinese economy in the period after the global financial crisis. I think most Western economists are exaggerating what China's growth will be like next year and probably underestimating what growth in the US will be like.
Well, we all need one global good news story to hang on to, right? But, you know, in terms of the Western appetite for distressed debt in China, yes, we've seen kind of these, you know, testing of the defaults so far this year, but there's been Western funds just gobbling up that distressed debt. Does that kind of reinforce the problem? I know Michael Pettis has written about it, that this basically is this idea that the government will always bail out, there will always be the backstop.
Well, it's not entirely clear where the line is drawn, is it? I mean, there's clearly going to be problems for second-tier provincial banks. There are clearly going to be some of the weaker brethren among SOEs that are not bailed out. But ultimately, no major financial institution is ever going to go down because the one thing the Chinese learned from 2008 is don't let a significant financial institution go bust. The Chinese public sector can absorb a significant amount of the bad debt that's lurking out there in the private sector. But Michael Pettis's point, with which I wholly agree, is that China's growth story, really since the financial crisis, has been increasingly dependent on leverage. And ultimately, if that's going to stop, if there's going to be some cleaning of house, then China's growth is not going to bounce back to the pre-pandemic levels. In fact, we might find that low single-digit growth is the new normal for China, if, as I said, the authorities are serious about cleaning financial house in the private sector.
So what should we be doing now when times are good, now that the economic recovery will continue next year, hopefully, especially for the U.S., because what we've seen in Washington is that during times of economic prosperity, we haven't really been able to build a buffer.
Right. Well, I think it's going to be interesting to see what happens in the two Georgia runoff elections that are coming up for the Senate in January, because If the Democrats win both of those, then they will have a chance of doing their more ambitious fiscal plans that Joe Biden talked about during this year's presidential campaign. If they only win one or lose both, then essentially Mitch McConnell will remain master of the Senate and not much will be done in the way of fiscal support for the economy or, for that matter, tax changes. Now, the probability is that the Democrats don't win both, although the polls suggest that it's pretty close. And that means that we might find ourselves quite quickly back in that strange time which is associated with the Obama presidency, when the Republicans rediscovered their fiscal rectitude and stood in the way of large-scale and sustained fiscal support. I don't think the U.S. economy is going to need a ton of fiscal support in 2021, because I think it's going to be the roaring 2021, if not the roaring 20s, as consumers get back to spending on services. But if you look ahead, as the Congressional Budget Office does, beyond 10 years, then obviously the fiscal position of the United States is unsustainable, and there are going to have to be, sooner or later, some meaningful reforms. Now, these could take the form of higher taxes or just collecting more efficiently the taxes that are supposed to be paid by wealthy Americans, or there is going to need to be some reassessment of particularly Medicare. But I don't think anybody could claim that the U.S. is on a sustainable fiscal path unless you disbelieve the CBO's assumption that sooner or later interest rates do go up. The Larry Summers view is that we're in a permanent sort of ice age, and that means that interest rates are going to stay at these historically low levels indefinitely. I must admit, that reminds me of Francis Fukuyama's End of History back in 1989. Secular stagnation is the end of financial history or the end of economic history, and I'm too much of a historian to think that history ever ends. At some point, those rates will move up.
Neil, always great having these discussions with you. Thank you so much. Neil Ferguson, Senior Fellow at Stanford University's Hoover Institution and Bloomberg opinion columnist. And we do have breaking news at the moment. Joe Biden has tapped Gina McCarthy as U.S. climate agenda chief. This according to the Washington Post. Gina McCarthy, of course, ran the Environmental Protection Agency under the Obama administration, and she's currently head of the advocacy group, the Natural Resources Defense Council, and has sued the Trump administration more than 100 times, successfully overturning some of its attempts to delay energy efficiency rules. And according to the Washington Post, she's been tapped as U.S. climate agenda chief. Heidi.
All right, Sherry, we're getting some news about these virus relief measures from the Hong Kong government. They're said to be planning a Hong Kong $5 to $6 billion new virus relief measure package. That's according to Singdao newspaper. Of course, we were expecting the introduction of these new relief measures sometime before Christmas, expecting those to support industries that are most affected by the reinstatement of the social distancing restrictions. Of course, Hong Kong, we have seen, have returned to the tightest restrictions for the virus, as we've seen cases spike recently. Well, coming up next, in search of the perfect beat, how pandemic music makers have helped propel Roland's return to the stock market. We get the details next. This is Bloomberg.
I think we have a lot to be optimistic about in this country, but in the near term, even with these vaccines, Moderna and Pfizer, we just got to allow them to be given to the people who need them the most, but that's going to take more than 6 months.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Joe Biden is another step closer to the Oval Office, with the top Republican in Washington now recognizing him as the winner of last month's election. Mitch McConnell says the Electoral College has confirmed Biden's victory and has sent his congratulations. The president-elect says he sees areas where they can work together and hopes they can meet soon. Congress must ratify the college decision next month. Meanwhile, Australia is refusing to back down in its trade dispute with China, saying Beijing's ban on coal imports breaches WTO rules. More than 50 ships laden with Australian coal are stranded off the Chinese coast after being refused permission to enter port. Prime Minister Scott Morrison says a ban breaks the free trade agreement the two countries signed in 2015 and signals a worsening relationship. And the European Union has announced new regulations for big tech, saying companies face hefty fines if they treat rivals unfairly or fail to protect users. The overhaul of current digital rules comes in concert with proposals from the UK and signals a tightening of tech scrutiny in Europe. The rules set out new criteria for tech and allow for penalties of up to 10% of annual global revenue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi.
All right, Karina, we are getting some breaking news across the Bloomberg. The data coming through when it comes to Japan exports, it is a bit of a disappointing number. A contraction of 4.2% year on year is that headline number. We're expecting just incremental growth of 0.4%. That adjusted trade balance is up about 57.5% from October. We are seeing that breakdown when it comes to imports, also a decline of just over 11% year on year. That's also worse than expectations of a 9.5% contraction. And breaking it down in terms of geography, exports to China, though, seeing a rise of 3.8%. So you see that Chinese demand story still really the rare bright spot, but declines when it comes to exports to the US and to the EU of about 2.5% apiece there to those markets. We are seeing that miss for both imports and exports for Japan's trade data for November. Well, the maker of a drum machine, which counts Kanye West amongst his fans, is to relist in Tokyo this morning. Roland returns to the stock market after a turnaround in its fortunes, helped in part by aspiring musicians making music at home during the coronavirus pandemic. Our Asia Stocks team leader, Lian Ting-tu, joins us now from Singapore. So tell us about this company.
Hey, morning, Heidi. Sure. The company was founded in 1973 by Ikutaro Takehashi, a pioneer in music electronics who helped create many successful keyboard and electronic drum products. A very famous one was a drum machine called the TR-808, which failed commercially when it was released in 1980, but soon caught on with rap groups like the Beastie Boys. And as you mentioned, the machine's unique tones are all over the place today. Kanye West even named an album after it.
Yeah, so what's so different now, and how good a time is it to return to the market?
They first listed in 1989 at the height of Japan's economic bubble, as you know, and they flew high for a while. But the financial crisis hit the musical instrument industry pretty hard during 2008, and Roland suffered from some product mistakes as well, also tough competition and a strong yen. Then private investment firm Taiyo Pacific Partners took them private in 2014 and helped them turn around, getting rid of some unprofitable businesses. And now Taiyo is selling about half of its stake in today's IPO for about $350 million, which is the second largest IPO in Japan this year. In terms of timing is great since the Topix is just coming off its best month in over 7 years, and valuations are pretty pumped up.
And Lian, the pandemic, the coronavirus has really had an impact for musical instrument makers.
Yeah, the impact in the end is actually mixed. On one hand, lockdowns forced closures of retail stores while also halting live performances and school music programs. But online sales have jumped as people with extra time on hand buy more instruments. Roland is still working through a backlog of orders due to factory closures, but it is projecting a small revenue increase this year, with portable digital pianos and small amplifiers selling particularly well during the pandemic.
All right, Lian Tu in Singapore with the latest on Roland. Right, and of course we're headed to the open on Japan, South Korea. Let's turn to Sophie for what to watch. Sophie.
Sherry, we're watching Japanese pharma stocks on an NHK report that the government plans to cut prices of about 70% of drugs in an annual review for the next fiscal year, which is estimated to save about 430 billion yen a year in healthcare costs. This as virus relief is being boosted, with the third extra budget set to add $210 billion in spending, including additional funding for domestic travel incentives, which were temporarily suspended. So we are keeping an eye on rail stocks and airlines in Tokyo this morning. And over in Seoul, we're keeping an eye on Samsung and other chip stocks. This after Wedbush raised its price target for Micron on an improving appetite for memory. And drilling into it, the setup for PC demand, that is set to be much stronger than anticipated a few months ago, according to Wedbush. So chip makers very much in focus, Heidi.
All right, let's get you a quick check of the latest business flash headlines. Index operator MSCI says it's ready to delete a list of Chinese companies named in President Trump's executive order on firms linked to the military. MSCI has sought feedback from more than 100 US and foreign market participants who suggest the order may have had a significant impact on global investors. The companies referenced by the president include chipmaker SMIC and Hangzhou Hikvision. IBM is buying Canadian fintech firm Expertus Technologies to bolster its e-payment capability. Expertus helps process more than $50 billion of transactions each day. They'll join the IBM Global Business Services Unit. At least 1,000 banks, credit unions and other agencies currently use the system. The blank check company backed by Richard Lee and Peter Thiel is said to be weighing a merger with Indonesian e-commerce giant Tokopedia. We're told Bridgetown Holdings is looking at a deal with one of the most valuable startups in Southeast Asia and a tie-up that could value Tokopedia to up to $10 billion. Lots more to come. This is Bloomberg.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonises it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome to Daybreak Asia. I'm Hadi Stradwatts in Sydney.
And I'm Sharian in New York. Asia's major markets have just opened for trade. Our top stories this hour. Asia looks set to extend Wall Street's rise as Congress moves towards a new virus relief package. Treasuries retreat ahead of this week's Fed decision. Moderna's COVID vaccine wins approval from U.S. drug regulators. They say it's 94% safe and effective, clearing the way for emergency use authorization. Plus, Japan approves a third extra budget, including more than $200 billion to support the economy through the resurgent COVID-19 pandemic. Japan and South Korea coming online. Let's get straight to the market action with Sophie Kamarudin. Soph.
Now, Sherry, in the latest fund manager survey from the Bank of America, we did see red flashes signaling, given that cash positions are underweight, but we do have stocks continuing to gain ground. The Nikkei 225 adding 0.7% this morning. The yen stayed below that 104 level. We're also watching reaction to Japan passing the third extra budget, which includes additional funds for domestic travel incentives. And JGB traders taking note that the spending has not led to a change in the debt supply plan. Now, JGB is set to trade within range here. This after the 10-year yield slipped to 0 on Tuesday. The FOMC decision may also be keeping that mood cautious, and just noting that Japan bonds have been the worst performers in the world this year amid the record borrowings that we've seen from Japan. Now let's switch out the board and check in on the start of trade in Seoul. We are seeing the Kospi gain ground this morning by about 0.8%. This after we get jobs data. It was a 9th straight month of declining employment in South Korea, but the jobless rate did moderate to 4.1%. You have the Korean won on the front foot, trading below 1090 against the greenback this morning. Now let's switch out the board to check in on the mood in Sydney. The ASX 200 rising more than 1%. All sectors in the green. We have the Aussie dollar looking steady here, though, while yields are tracking the overnight moves higher that we saw in treasuries. And SBE minis, a little change as we wait on any details on U.S. stimulus. Status quo there. The offshore yuan holding a 2-day gain, while the dollar is trading near an April 2018 low. And Kiwi stocks adding 1% this morning, while the Kiwi dollar just trading steady here this Wednesday. Heidi.
Yeah, we're watching that action in the Kiwi dollar, of course, the best performer out of the G10 space. We've just gotten the New Zealand Treasury's half-yearly economic and fiscal update coming through, saying that they're expecting a better economic outlook, and that's boosting revenue. That's led to smaller budget deficits than they had projected back in September, which was that pre-election update. They also see an annual average GDP growth of 1.5% in the year ending June 2021. That is a jump up because their previous assessment accounted for a 0.5% contraction in economic growth, seeing annual average growth of 2.6% in 2021 to 2022, 3.7% by the time we get to 22 to 2023. In terms of the labour market, they're seeing a lower peak of the jobless rate at 6.9%. That's expected to peak in the fourth quarter of next year. They previously thought that number at 7.8%. And clearly they're saying that these indicators are looking at upside rather than downside risk for the New Zealand economy. This is an economy that we know has virtually eliminated COVID-19. They're still dealing, of course, with the fact that borders are closed, but they're working on a travel bubble with the likes of nearby Cook Islands as well as Australia. And certainly we are seeing that economic rebound being priced into what is overall a buoyant assessment from New Zealand Treasury. All right, let's bring in for more on the markets now, Dan Gerard, who's a senior multi-asset strategist at State Street Global Markets. So, Dan, I want to sort of start off big picture because it looks like everyone is on consensus for the start of next year, continuing to be bullish when it comes to equities, bearish on the dollar, bearish on bonds. So where are the opportunities? Where are the, I guess, divergence in views that we should be looking for?
Sure. Good morning, and thanks for having me on. I think that that's actually quite an interesting story. And your own columnist, John Authers, pointed out yesterday that it's almost becoming consensus to worry about consensus risk right now. I think what we're seeing, though, is something very different than what the sell side is saying. You know, there's a lot of sell side consensus risk, and of course, we're saying something very similar in that cyclicals. This should be a year about repairing the damage that was done last year, and that's in infrastructure trade, industrials, materials. I still think tech does well, but the reality is that under the service on the buy side, the investment managers, they are actually not overweight the cyclical trade yet. So even though that there's this idea that we're becoming too consensus, the way that investors are positioned is not consensus. And there is plenty of room to build positions in this new world we're moving into, a vaccinated, rebuilding world that has still supportive monetary policy and fiscal policy behind it, and in private capital that is chasing a bid to move those risk assets back overweight again.
I want to ask you about your call on emerging markets. You're seeing a broadening out of that trade beyond just North Asia. And in the last hour, we spoke to the historian Neil Ferguson, and he thinks that a lot of market participants, as well as economists, are overpricing or overdoing their enthusiasm on China's recovery. Does China still remain the anchor for EMs next year?
It remains the anchor, and I think that is an important market to watch, of course. But the point here is that last year it was so narrow. Emerging markets, it was almost supposed to be pre-pandemic, the year for emerging markets. We were coming out of the trade war. We had this supportive monetary policy across the board, and it should have been a good year for EM debt and EM equities. The pandemic hit and changed that. The narrowness was totally focused in the tech side of the world. I mean, it was really a few companies in EM you could break it down to. Now, we see that is going to spread out from the North Asia story. North Asia will still be supportive, but we're looking at Latin America as well now, because Latin America has two sides. We've got potentially a better yield curve for better financials performance. We've got the materials sector within Latin America, and we've got food products and the consumer staple side of Latin America as well. Food products, food and beverage is one of the few areas now that's got really strong pricing power, unlike many other sectors where we're actually seeing prices challenged quite a bit. Food is breaking that trend, which should help the company story and the export story from Latin America as well.
Yeah, the Bovespa just erased its 2020 losses, right? And we had seen some optimism about stocks because they were very cyclically tilted. Will we see this debate between cyclicals and growth stocks going into 2021 for emerging markets, and which one will win? Yeah, it's going to be, I think it's going to be a much more nuanced debate into 2021. In 2020, this was about a growth versus value story. Now it's the cyclical areas are going to take on some of the growth, some of the value. I think that in the trend, materials is in a much better position, supply-wise, pricing-wise, demand-wise. Energy, the industries that will support energy on the demand side are going to take a long time to recover, and there is a lot of pent-up supply that will come into the market to fill fiscal holes that are in badly need of repair. So that means we need to look for areas that are in better position to get earnings upgrades, a better earnings picture, better quality. Own is not going to be the driver. Financials on the other side, there are there are a few markets where financials actually look attractive because inflation has kept the rates picture a bit better, a steeper yield curve. India is one of them. Brazil might be another. And if we look at the equity story and the rate story in India and Brazil, that is going to likely buck that trend and see positive financials and the first place that I would broaden out EM exposure. Dan Gerard, great having you on from State Street. Thank you. Let's now get to Karina Mitchell with the first word headlines. Karina.
Thank you. Joe Biden is one step closer to the Oval Office as a top Republican in Washington now recognizes him as the winner of last month's election. Mitch McConnell says the Electoral College has confirmed Biden's victory and has sent his congratulations. The president-elect, meanwhile, sees areas where they can work together and says he hopes they can meet soon. Per protocol, Congress must ratify the college decision next month. In other news, the European Union has announced new regulations for big tech, saying companies face hefty fines if they treat rivals unfairly or fail to protect users. The overhaul of current digital rules comes in concert with proposals from the UK and signal up to 10% of annual global revenue.
We respect companies, but we say that the bigger they are, the more obligations they may have to fulfill what is important to us. In other words, what it is to give clarity, to give visibility, to give
and share buybacks, but must keep them to 15% of profit or 0.2% of key capital ratio. That's a more conservative payout than the Bank of England announced last week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi.
Karina, we've been talking about this story, the relisting of Roland, the electronic instrument keyboard drum maker. We are seeing a little bit of a muted debut this morning in Tokyo. Roland shares trading, or opening, I should say, at 2,954 yen, just shy of that 3,100 yen IPO price. This is what we're seeing when it comes to the price action. This, of course, on the back of a resurgence in demand for instrument makers, with people stuck at home and learning or perhaps perfecting their instruments. We're seeing downside of about 6.5% with that relisting debut of Roland. Well, still ahead, we'll be speaking with CEB Head of Research, Bunny Lam, getting his outlook on Hong Kong stocks and the economy. Coming up next, the vaccine rollout. Moderna's jab is closer to FDA approval after being found to be safe and effective. We get the latest next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
There is a need and a clear need for me to spend money. I need to spend money to boost the economy, the necessary push. And therefore today, as of now, and for this fiscal, I shall not worry about the deficit number.
The fact that we were able to get this vaccine developed in record time is nothing short of an extraordinary scientific accomplishment.
When you vaccinate millions of people, you will see, some rare events that occur with almost any vaccine. That's so far outweighed by the benefits that we're seeing.
There were medical professionals on site that were prepared to respond if there were any issues with the vaccine. Luckily, that did not happen. Everything went perfectly smoothly.
It's imperative for us to get the vast majority of Americans vaccinated so that we can come through this crisis.
We've got a lot of data showing that this is a safe and effective vaccine.
We'll make sure that we can get vaccines to people because this is the beginning of the end of the pandemic, and that's the most important thing.
U.S. healthcare experts there on the speed and significance of the vaccine rollouts. And we have also learned that Moderna's vaccine is a step closer to emergency use authorization. A panel of independent experts have found it to be safe and effective ahead of a final FDA decision Thursday. Joining us for a business and historical perspective of all of this is Michael Kinch, Associate Vice Chancellor of the Washington University in St. Louis and an expert on drug discovery. Thank you so much for joining us today. Of course, there's a lot of vaccine optimism out there. We're talking about exceptional discoveries, exceptional progress when it comes to really achieving and getting these vaccines to market in such record times. What are we not talking about right now?
I think probably the biggest thing we're not talking about are some of the unknowns. And that doesn't necessarily mean that they will be negative. They're just frankly unknown. And some of those are, how long will the protection last? We know from the data that's come out so far that the protection will last presumably a few months at least. But we don't know if this will require boosts annually or once a decade, or what the frequency of boosting, if ever, is going to be needed. And I think that's really one of the key things.
And of course, we have now talked about Moderna, we have Pfizer. What about AstraZeneca? Because it seems that Moderna and the Pfizer vaccines may not be as competitive when it comes to those emerging and poorer countries out there that need these vaccines at lower cost, not to mention that cold storage, super cold storage is not an option.
Yeah, absolutely. I think the logistics and the expense of the logistics associated with especially the Pfizer vaccine and to some degree the Moderna vaccine as well, which still requires standard freezing, that could be done away with by the AstraZeneca vaccine, which also appears to be probably the most affordable to produce. The problem is that AstraZeneca has been frustratingly opaque in terms of their data about both safety and efficacy. And the opacity has also been shared by some, frankly, misstatements, especially on the efficacy side when they released information suggesting that it was 90% effective, when in reality that 90% was a subset and it was overall effective about 62 to 70% of the time. So I think the AstraZeneca vaccine is probably a bit premature to assume that it's going to be approved in rapid succession.
Michael, I want to get your views on the transparency of the progress, because obviously there's been lots of concerns as well as enthusiasm and positivity about how quickly this has managed to happen compared to the duration of a regular drug trial. We had a Bloomberg opinion columnist writing about the need to know what those four members of the FDA panel who voted against approving the BioNTech and the Pfizer vaccine had to say. Do you think it's important that that information is out? What would have been the reason for that not to be a unanimous decision?
So I can't speak for those who were in opposition, but getting to the bigger question, I think that transparency is going to be absolutely essential. The scientific challenges and the medical challenges of getting a vaccine to the public, we've accomplished that. Now the key is going to be getting people to be willing and actually eager to accept this vaccine. And that is going to be a rather tall road to hoe. And we're going to have a big problem with that because we are already amidst a period where we're essentially in an anti-science period, where there's been a lot of distrust of vaccines that predated 2020. And the fact that you had names, for example, in the United States, such as Operation Warp Speed, that unintentionally conveyed the concern to many consumers that this was being rushed and that their safety might be at risk. We have no evidence to that effect. We have been so incredibly fortunate with these first two vaccines, especially, to see amazing efficacy without any significant and lasting side effects.
And in fact, you know, in case you thought it was easy, of course, we had CSL's vaccine coming across a trial stumbling block, and they're not going to be continuing with it after some problematic results to do with the false HIV results in some of the trial participants. I'm wondering, in terms of a bigger question, how does the fast tracking of the vaccine development, the R&D process, potentially change the future, or how should it change the way that drug discovery happens from here on in?
Well, I'm hoping that we can take away some lessons from this. Pandemics occur quite often, every 2 or 3 decades on average. And usually when you look back, you see that there are improvements that are made, that basically the pandemic tests many aspects of our society. And in this case, it might provide an opportunity to determine what is the proper balance between expediting getting a new medicine or vaccine approved versus regulating it to make sure that it's safe and effective. And there's no simple answer, and we do go through these periods. We saw this, for example, in the 1980s with HIV/AIDS, where a lot of the medicines were fast-tracked. And then in the 90s, we had a number of medicines that were found to be toxic, like Vioxx, and that slowed things down. So we're always rebalancing that equation, and I would anticipate that probably you're going to get a tip in the balance towards, can we be more efficient? And that's crucial because it's becoming ever more expensive to manufacture and to discover a new therapeutic. And so we really need to have those efficiencies.
Michael Kinch at the University of Washington in St. Louis. Thank you so much for joining us. Let's get you a roundup of the stories you need to know to get your day going in today's edition. That can be found in Daybreak. Bloomberg subscribers just go to Debut Go on the terminals. It's also right there on the mobile in the Bloomberg Anywhere app. Lots more to come. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
What we're trying to accomplish at Bumble is that you can drive profit and purpose, and they can coincide, they can coexist, and in fact, they fuel one another.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
All right, let's take a look at one of the shares that is making its renewed debut, I should say, in Tokyo. Returning to the market is Roland. This is a manufacturer of electronic instruments, keyboards, as well as a drum machine that is beloved by Kanye West. We are seeing just narrowing losses now, still down about 6%, or just shy of 6% there, opening lower than its IPO price of 3,100 yen. This, as we have seen pandemic demand for these use-at-home instruments soar. Well, Japan's cabinet has approved a third extra budget with $210 billion in spending. This says Prime Minister Yoshihide Suga looks to support the economy amid a resurgence in virus cases. Let's get more from our Asia Government's reporter, Isabel Reynolds, who's with us out of Tokyo. Isabel, so Japan's fiscal measures during the pandemic have dwarfed what they actually did during the financial crisis and after the 2011 tsunami and nuclear disaster. So how do we see this money being spent right now?
Right. As you say, the Cabinet approved a third extra budget this year. Normally at this time of year, we would be looking at the first extra budget. So the fact that it's a third extra budget indicates how seriously they're taking this crisis. The amount of spending is 21.8 trillion yen, which is $210 billion. a fair-sized sum. Now, some interesting parts of that include that 1 trillion yen of that is earmarked for extending Prime Minister Suga's domestic travel incentive program through to June. So that's a clear sign that he's got no intention of giving up on it, even though he earlier this week suspended it for 2 weeks over the new year because of the virus spread. Critics have said that what's called the Go-To program for this travel incentives could be one of the factors behind the fact that we have a record number of cases in Japan at the moment, whereas Suga is saying that it's the best way of shoring up regional economies. And it's worth noting that we saw a record 3,000 new cases in Japan on Saturday. Apart from that, we've got 4.4 trillion yen for coronavirus prevention measures and 3.1 trillion yen for disaster management. Plus, there's 11.7 trillion, which is supposed to help firms adapt to the coronavirus age. Most of the effects will kick in the new financial year, which starts in April.
Yeah, we've just also had pretty disappointing trade numbers out of Japan. So what are the chances, given all of this macroeconomic environment, that Japan can actually sustain its economic recovery?
Right. I think economists are becoming increasingly concerned that the renewed spread of the virus will weigh on sentiment. And some people are saying it could even push the economy back into reverse again after a recovery period in the last quarter.
Our politics reporter in Tokyo, Isabel Reynolds. And here's a quick check of the latest business flash headlines. Shares in Chinese search engine Baidu rose to a 20-month high in New York on reports it's weighing a move into electric vehicles. The Reuters wire cites local sources and says Baidu is considering contract manufacturing or a majority-owned venture with an established car maker. The report says Baidu has been talking to Zhejiang Geely, Guangzhou Auto, and China FAW, although no decision has yet been made. Chinese clothing company Shandong Ruyi has defaulted on a bond for a second time this week. A filing to the Shanghai Clearinghouse says it's failed to wire funds to pay the coupon on a 1 billion yuan note due Tuesday and is blaming tight liquidity for the miss. Shandong Ruyi had delayed the payment twice earlier this year and defaulted on a similar 7.5% note on Monday. The blank check company backed by Richard Lee and Peter Thiel is set to be weighing a merger with Indonesian e-commerce giant Tokopedia. We're told Bridgetown Holdings is looking at a deal with one of the most valuable startups in Southeast Asia, and the tie-up could value Tokopedia at up to $10 billion. Sources say talks are at a preliminary stage, and Bridgetown may yet look at other targets. Don't miss a big interview coming up later. Dell recently reported earnings that beat Wall Street estimates. Will speak exclusively to the president for Asia Pacific and Japan, Amit Mehta. Coming up, our exclusive interview with Hong Kong Exchange's chief executive Charles Lee as he prepares to bow out after a decade in charge. This is Bloomberg.
feel really lucky, having stared into what felt like a abyss for travel, and then to kind of rally together with thousands of people and rebuild the company from the ground up, something that I think is stronger than it ever was before the pandemic.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We have breaking news out of Japan. We are getting the Bloomberg Japan manufacturing PMI for the month of December. These are the preliminary numbers coming in at 49.7, which is an improvement from the previous month, and is also very, very close to that 50 threshold, but still in contraction territory. It's been in contraction since May of 2019. When it comes to the services PMI, not looking great, not surprising given that we continue to see virus infections. 47.2 is the number, which is a decline from the previous month. The composite PMI coming in at 48, and this is also a decline from the previous month, and the composite PMI also in contraction since February of this year. Of course, we're watching those Japanese eco numbers very closely, given that we already had very disappointing trade numbers earlier today, Heidi.
Yeah, they were a disappointment. Sherry, let's get to Hong Kong. The outgoing head of the Hong Kong Exchanges and Clearing is doubling down on the growing importance of Chinese markets. Charles Lee's comments come as index compilers, including the MSCI, are set to delete securities of some mainland companies. The chief executive spoke exclusively to us just 2 weeks before he steps down. Let's get it over to Sophie Cameron, who had that conversation. So what were these thoughts that Charles Lee had on the deterioration in US-China ties?
Heidi, Charles used one of his oft-used metaphors comparing money to the flow of water, saying that finance and money will find a way, that water cannot be blocked. So when I asked him about the implications of tighter U.S. scrutiny on China and what that means for the integration of China into global markets, he spoke of the middle ground that we can still see the U.S. and China intersecting on. And coming from an operator's perspective, the opening up of mainland markets is something that he said cannot be neglected, that China is seeing increasing importance. Have a listen.
If you look at that global map, invariably you will walk away with the conclusion that China is the place where yield is going to be, because fundamental economic development is stronger there, the consumer class is growing there, the people are getting more wealthy, the currency is becoming stronger, and their supply chain is as resilient, as strong as ever. While this decoupling will continue to put stress on the respective economies of each other, I think relatively speaking, the Chinese market will become increasingly more important.
So Charles, there just on how China is still an important part in the global map. This as we see more index compilers move to delist Chinese securities from their indices, including the MSCI, following on from the FTSE Russell and S&P.
What did he have to say about key acquisitions in his career?
Sherry, timing is key. That's one lesson that Charles Lee learned from the bid to merge with the LSE. But while that effort didn't score a goal for the striker and the Hong Kong Exchange, Charles did affirm that acquisitions do remain a key part of the Bourse's strategy to expand and diversify the business outside of its comfort zones. Have a listen on that.
We were very clear, very beginning, that there are 4 things we're going to want to do. You know, when I started, 1, we want to connect the waters. 2, we want to change the fish. 3, we want to expand outside Hong Kong and outside equity. And lastly, we want to modernize our platform. So the acquisition is really our number 3 strategy, which is to really expand beyond equity and expand beyond Hong Kong. And we took the first step, which is really LME, which is beyond equity to commodities and beyond Hong Kong to London. So that's a great venture that give us the confidence and give us the perspective and give us the experience to think bigger. But the LSE, we probably were a little bit late, and we thought Brexit is going to happen in January. last year. It didn't. It said it's going to happen in October. So we said, let's wait until October. And then they announced their own transaction. And so we were left with either just sit tight, as if it never happened, even though we fundamentally, decided to do it, with very broad support at the board and also other stakeholders. Or we do something. So I decided, okay, let's go and shake the tree. Maybe the apple will fall. If it does fall, it's our luck. It didn't. Then we walk home.
Increasing market efficiencies, leveraging data will be more of an emphasis for global exchange operators. Do you anticipate more deal making within the industry, consolidation perhaps?
I think the industry consolidation on its traditional business are becoming more and more of the past, because it's just not enough for people to buy. It won't really make enough of a difference on trading. I think the acquisition is, if it's ever happens, is this coming down the hill kind of acquisition, is really acquiring assets that is not exactly in the traditional financial services, but is sort of can be, put into supplement. Particularly data. You see S&P and IHS, those big giants eventually putting their massive data business together. So I think that's the future. But the acquisition for traditional exchanges, I seriously doubt that we're going to see another very big mega merger. But everybody's going to do things on the side and on the edges. We potentially still, because of the massive potent forces from China, we may or may not necessarily, I increasingly shouldn't be using we anymore because I'll be out of the exchange. But I think Hong Kong Exchange is still somebody that people need to watch for, because they still have the capacity and they still have the potent home market demand and depths and absorbing power for them to potentially do something more interesting and more dynamic and innovative. So I will be cheering them on the side.
Do you think there's room for bolt-on acquisitions, smaller bites as it were, versus transformational approaches?
Yeah, transformational approaches are very, very hard to come by. Bolt-ons are fine, less sexy, but occasionally interesting in specific areas. We tried some big one. I doubt anytime soon that the big ones are easy to grab, because exchanges tend to be geographically and sovereignty-wise very sensitive. So I seriously doubt very big mega exchange acquisitions.
Charles Lee there as he enters the final stretch of his time as the chief of the Hong Kong Exchange. Never one afraid to shake the tree there. Heidi.
All right, it is the end of an era there for HKX. Sophie Cameron there with that interview. We are just getting some breaking news on another mega tech IPO, that listing for Wish being priced at 46 million shares at $24 each. That is at the top end of the range. This is the online retailer Wish pricing at the top of its marketed range at $24 a share. That's according to people familiar with the matter, with the story, I should say. Wish's parent company is a San Francisco-based Context Logic. They sold 46 million shares in the IPO that looks set to raise about $1.1 billion US dollars. That would value the company at around $17 billion on a fully diluted basis. This, Sherry, just the latest when it comes to a blockbuster year, a blockbuster month for tech and IPO listings.
Yeah, not surprising given that we have these stay-at-home trades, right? And talking about stay-at-home, well, South Korea now confirming 1,078 more coronavirus cases. And remember, this is an economy that didn't have to shut down, that they really actively contact trace people. They were able to maintain just certain restrictions. They're right now at level 2.5 when it comes to that 5-tier system on those social distancing restrictions. But right now, South Korea confirming more than 1,000 cases after a whole week of seeing more than 600 daily cases. So we'll continue to watch what happens there, because a level 3 would be sort of semi-shut down, something that we haven't seen during this entire coronavirus pandemic. Let's return to Hong Kong and the broader markets because our next guest says the city faces an uncertain path in its economic turnaround. CEB International's head of research, Banny Lam, joins us now. Banny, and of course, we're talking about all of these IPOs and all of these tech listings in Hong Kong as well. And that has really been a positive for the city that has reeled from so many protests and other economic turmoil. But what happens when you have the Beijing policymakers now sort of cracking down, whether it's on anti-competitive behavior, on fintech? What happens then?
Yeah, I think the fintech sector right now is, I think, facing a so-called consolidation stages in the market right now. But I don't think it will affect those tech companies actually coming to Hong Kong to list it, because I think there's a lot of areas actually for high-tech companies actually not touching those regulatory requirements. So I am still positive on the whole sector, but I think you will see some macro internet companies actually facing those regulatory risks, I think, in the next few months. But I think in a few months, I think they sort out all the rules and then they will comply with the rules. I think the market, will be more positive on the sector in the medium term.
So we have already seen this rally when it comes to the Chinese equity market. So how much more room do we have to rise at a time when we are already seeing policymakers being a little bit more reluctant when it comes to financial risk?
I think for China, I think you see the Shanghai Composite Index, and actually the level actually, if compared to 2015, actually is still very low, actually half of it. So I think you still have a lot of room for China to grow in the equity market. But I think the financial risk right now, I think China, while actually targeting those internet companies, conglomerates on the maybe internet lending, and because I think the financial risk may be affected on this level. So I think the whole system right now, because China is recovering, actually financial risk is leveling off, actually is lowering. And at the same time, I think also tighten the regulatory requirements on those internet companies on borrowing. Those things actually will be helping restore the order actually in the financial sector. So that may be a good thing for China in the coming years actually to have a very healthy development of the whole sector.
Banny, we've seen the strength of the Chinese consumer play an integral part of the economic recovery. Which sectors in particular within that consumer space do you see opportunities?
Yeah, I think you're looking at the November's numbers, I think just released yesterday. Those numbers actually tell you the story is, I think, the consumer discretionary cars, actually sports wear, and those things actually doing very well. And this is starting in maybe August and September. So I think in the early part of the recovery of China, that back to maybe June or July, actually rely on the supply side. That means productions. Now I think the people save a lot of money because they cannot go out actually spend. Now they can we have a good purchasing power for them to come out to spend. So I think in the next few months, all the consumer discretionary sectors items you have a very strong growth. That will be very positive for the whole sector to outperform other sectors in the market.
When you take a look at MSCI China, we're still hovering at pretty close to the highest level since the inception of that index, right? So when it comes to these Chinese equities, be it in Hong Kong or be it mainland listed, what is going to be kind of the next leg up? Because it seems to have struggled with resistance at this point in the rally.
Yeah, I think it's struggling with resistance because I think maybe in the last few months actually have ups and downs very high, and then also some of the sectors actually outperform a lot. They may be waiting for consolidation by the end of the year because some of the fund managers maybe they're taking profits. But I think we have to put the eye on 221 because the 221 you will see maybe a big shift of the sector spending, and also some of the investors maybe shift their views on less spending on the maybe high-tech sector, maybe more shift the money into the traditional sector because we're looking for economic recovery in China as well. So I think consumer discretionary just said before, that will be good. For example, traditional sectors like China banks, actually they will be outperformed because like 2020 may be a bad year for them because the earnings actually drop a lot, around 10%. But in 2021, I think there will be a strong rebound. The worst time is over already for banks, so they will see a lot of rebounding on these traditional sectors in 2021.
When you talk about financials, though, is there a risk on those non-performing loans, especially in the smaller banks across China?
When you see the numbers right now, actually, I think they still can control the risk. But the good thing is China is on the track for recovery. Actually, like small and medium-sized the companies' loans actually may be like occupying actually not big shares of the banks, like a bad debt for a moment. So I will see like the bad debt level actually is still controllable in the market. And but I think the central bank, People's Bank of China, also like to watch out actually the risk behind it. So I think you see MLF and those things like cut, those things, they were really cautious, actually not like really releasing the liquidity in the market. So I was expecting the People's Bank of China will like not maybe maintaining normal stand, prudent stand actually in the monetary policy. They will not release too much liquidity in the market. They will invest enough money in the market for the investors, for the like companies to fulfill their capital demand only, not like really like putting lots of liquidity in the market, actually boosting the market like as a bubble.
CB International Investments, Bunny Lam there with us. Always appreciate your time. We have lots more to come on Daybreak Asia. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. President-elect Joe Biden is said to have chosen Jennifer Granholm as the governor from Michigan to lead the Department of Energy as he gears up for a bigger role in fighting climate change. The agency has a $35 billion budget and is responsible for, among other things, maintaining the nation's nuclear warheads and emergency oil supplies. Gina McCarthy will lead Biden's domestic climate agenda. In other news, Japanese bonds are facing a rare annual loss, the first for 17 years, amid record borrowing from the government and reluctance from the BOJ to boost bond purchases. According to the Bloomberg Barclays Index, Japanese government debt has fallen 0.71% so far this year, despite gains seen in all of the other 45 bond markets tracked by Bloomberg. The Malaysian Prime Minister has survived a key leadership test, with lawmakers approving a budget for 2021. Defeat for Muhyiddin Yassin's spending plan would have been seen as losing a vote of confidence, and the result reinforces the wafer-thin majority the Prime Minister holds in Parliament. Fitch has cut Malaysia's rating, saying that narrow majority implies persistent uncertainty. And new data from Sri Lanka show the economy entered and exited recession in the last 6 months, with growth returning as virus curbs ease. GDP declined about 16% in the June period from a year earlier, but expanded 1.5% in the following 3 months and snapping 2 quarters of decline from January. The Sri Lankan central bank has lowered borrowing costs 5 times this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi.
Karina, well, Saudi Arabia will stick to its plan to cut spending by 7% next year after its budget deficit widened dramatically amid lower oil prices and the pandemic. The kingdom's finance minister, Mohammed Al-Jadaan, outlined his plans to tackle the deficit and roll out vaccines in this exclusive interview.
We expect the first batch of vaccine that we bought to be arriving very soon. I would say possibly within hours. Ministry of Health has a very clear plan on how they are going to distribute this vaccine. It is going to be free of charge for everybody, whether nationals or expats. Even illegal immigrants will receive a free of charge vaccine. Obviously, it will need to be rolled out on a priority basis for those who are most vulnerable, and then for the first line healthcare service, and then the rest of the people. It will take time, obviously, like everybody everywhere around the world, but we expect within the next few months that we will have almost everybody who needs the vaccine and wants the vaccine to be vaccinated.
Minister, in your formal remarks, you talked about adopting a more effective spending plan. How does that translate into priorities for the new year? I mean, I know you have a long list of fields and issues that you want to address, but if you could just perhaps prioritize the spending for our global audience, what is the absolute top priority here?
A few things, Yusuf. I think this is a very important question, actually. One is people's health. So we still believe that we are not out of the woods yet, and we wanted to make sure that we have enough financing for the health service. And we wanted to make sure that we are prepared for, God forbid, a wave 2 hits Saudi Arabia. Thanks God, so far the healthcare service have been very well maintained. The levels of infected people is reducing significantly. So that's the first priority. The second priority is actually to stimulate the economy, and we wanted to focus on small and medium enterprises. We wanted to focus on basically going back to our original plan on funding the Vision 2030 programs to diversify the economy, to create more jobs in the economy, to enable the private sector. Financial technology is another area where we wanted to make sure that we enable more investors to come and invest in financial technology, and generally in the industrial sector, where there are significant opportunities that we have seen. And even in the last third and fourth quarter we are in now, we have seen a very, very healthy rebound of activity in the industrial sector, and we want to push that even more next year and the years to come.
Saudi Arabian Finance Minister Mohammed Al-Jadaan speaking to Bloomberg's Youssef Gamal Al-Din. And we do have a headline right now crossing the Bloomberg, and we're hearing from Politico that states are expected to finish an antitrust lawsuit against Google. They're expected to allege that Google has altered the designs of their search engine to the disadvantage of rivals that offer specialized search results. This is according to people speaking to Politico. And of course, we have seen the Department of Justice, not to mention Attorneys General, filing that suit against Google in October as well. And this is one of the biggest antitrust cases against the tech company more than 2 decades. Remember, the biggest antitrust suit was back in the 1990s against Microsoft, and we continue to see this push against these tech giants. And of course, we had action against Facebook last week as well. We'll have plenty more to come. This is Bloomberg.
Not only do we have the capital required, we have the long-term vision, the ability to focus and execute. And this is really about reimagining transportation, really. And so it gives us a baseline to build from and then expand on.
A quick check of the latest business flash headlines. Index operator MSCI says it's ready to delete a list of Chinese companies named in President Trump's executive order on firms linked to the military. MSCI has sought feedback from more than 100 US and foreign market participants who suggest the order may have a significant impact on global investors. The companies referenced by the president include chipmaker SMIC and Hangzhou Hikvision. Cloud computing company Snowflake extended a 3-day slump after the expiration of a lockup that stopped insiders from selling shares. The stock fell as holders had their first chance to cash out since Snowflake went public in September. It's fallen about 17% from last week's record, raising about $20 billion in market value. Revenue, though, is forecast to jump 80% next year. A drum machine maker saluted by Kanye West is back on the Tokyo Stock Exchange after a share sale that raised $350 million. Roland's TR-808 rhythm composer has also been name-checked by the likes of the Beastie Boys, but flopped commercially and retreated from the stock market after the financial crisis. However, it's seen a turnaround and a surge in demand from aspiring housebound musicians during the pandemic. Well, coming up in the next hour, BFA Global Research APAC Economics Head Helen Xiao gives us her outlook for China. Plus, hear from HDFC Managing Director Rono Sud Kanad later on Bloomberg Equality. We'll also be getting you more of our exclusive interview with the Hong Kong Exchange's Chief Executive Charles Lee as he prepares to bow out after a decade at the helm. Lots more to come on Bloomberg TV. Our markets coverage continues as we look ahead to the start of trading in Hong Kong, Shanghai and Shenzhen. Bloomberg Markets at China Open is next. This is Bloomberg.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
It is 9 a.m. in Beijing and Shanghai. Welcome to Bloomberg Markets China Open. I'm Tom McKenzie.
And I'm David Ingles. We are counting down to the open of trade in the Chinese mainland and here in Hong Kong. Let's get to your top stories. Today, a virus relief bill moves closer that's in Washington, with congressional leaders trying to hammer out a deal. They hope to attach aid to upcoming federal spending bills.
MSCI is ready to delete the Chinese companies denounced by President Trump for links to the military. They include Hong Kong-traded chip maker SMIC and Hangzhou Hikvision.
Chinese leaders prepare their priorities for the coming year. They include a renewed drive against debts and how to shield the economy from U.S. tensions.
And soap maker Blue Moon is the latest Chinese company to debut in Hong Kong. It'll be the city's biggest consumer listing this year. Shares are rising in the grey market. And the story of Blue Moon is a reminder of some of the idiosyncrasies around China's capital markets this year. Chinese companies making up almost 40% of IPOs globally, as we said at the same time as the FTSE Russell, the S&P Dow Jones, and now the MSCI looks to weed out some of these companies from their indexes because of this executive action from the Trump administration. David.
Absolutely. We'll be looking at what that reaction will be when we get, of course, closer to the open of the markets here. You have several more companies, several more stocks, I should add. Third index compiler out. Notable exceptions might see some upside. We'll get to that once we approach the open. Here's where we are, though, across equity markets. We are up, extending the gains that we had over on Wall Street. Keep in mind, but later today, and of course, as we move into tomorrow, you have the Fed, you have the BOJ, and several central banks to look forward to. Have a look at the rest of Asia doing this. When you look at exports, for example, over in Japan, you missed that, of course, surprise drop. Unexpectedly, in fact, picking up that pace of year-on-year declines over in Japan. Government bonds, have a look at this. Your 10s, New Zealand. I'll talk about New Zealand in just a couple of seconds here. So you have your 10, you have your yield curve actually steepening here. And a new forecast out of Stand Chart, 3.5% is their forecast for the Chinese 10-year next year. Very quickly, currency markets doing this. Dollar China, dollar Japan, by the way, lowest level here is in about 6 weeks. We're pushing those support levels. And when it comes to the Kiwi dollar, as I promised, New Zealand reducing the amount of bonds they plan to sell from next year into 2024. Unchanged right now on your Kiwi dollar. Tom.
Right, let's get you a catch-up of the first word news then. U.S. drug regulators say Moderna's COVID-19 vaccine is safe and effective, clearing the way for emergency use authorization. The FDA says the jab is 94% effective, confirming Moderna's earlier results. The news comes as reported cases continue to rise. New York City faces a near total shutdown after Christmas. Denmark is extending lockdowns to the entire country, and Italy may impose further social curbs. Australia is refusing to back down in its trade dispute with China, saying Beijing's ban on coal imports breaches WTO rules. More than 50 ships laden with Australian coal are stranded off the Chinese coast after being refused permission to enter port. Prime Minister Scott Morrison says a ban breaks the free trade agreement the two countries signed in 2015 and signals a worsening relationship. The Japanese government has approved a third extra budget with more than $200 billion in spending to support the economy through the resurgent coronavirus pandemic. The plan includes money for domestic travel incentives that ministers suspended this week. That creates a problem for Prime Minister Yoshihide Suga, who is halting a stimulus measure he originally championed. Joe Biden is another step closer to the Oval Office, with top Republicans in Washington recognizing him as the winner of last month's election, finally. Mitch McConnell says the Electoral College has confirmed Biden's victory and has sent his congratulations. The president-elect sees areas where they can work together and hopes they can meet soon. Congress must ratify the college decision next month. And those were the First Word headlines. David.
Yeah, that takes us into the U.S. story and stimulus here. U.S. futures down about 4 points right now. So Congress may be facing a make-or-break moment here on this relief package. Let's bring in Kathleen Hayes, our global economics and policy editor, has the latest on these talks that will culminate, Kathleen, a crucial meeting for congressional leaders. Could the stalemate, Kathleen, finally be broken? What do you think?
David, this actually started a couple of weeks ago when the Gang of Eight, a group of Republican and Democratic leaders in Congress, said, let's put together our own package. Let's try to get something that's much smaller than can get passed. Nancy Pelosi, who had opposed anything less than $2.4 trillion since Joe Biden has won the White House, has agreed to look at a much, much smaller package. In fact, she had talks with congressional leaders today. She then invited Steve Mnuchin, the Treasury Secretary, to a meeting of the Four Corners Leadership Group. Who is that? Well, it's Nancy Pelosi herself. It's Mitch McConnell, the Senate Majority Leader, Kevin McCarthy, the House Minority Leader, and Chuck Schumer, who is the Majority Leader in the Senate. And what they're looking at now is a slimmed-down stimulus plan. It drops aids to cities and states that the Democrats wanted so badly. It does not include liability protections for employers. Suits stemming from virus issues is what they're talking about. And in fact, it also is contentious still over adding stimulus checks, what some would still like to do, not just unemployment. Wehowever, one of the things that kicked off the rally full speed was when Mitch McConnell said earlier today that Congress is not going to leave without a package. He says we'll stay here, we'll get the package done no matter what it takes. That was considered a very important push to have Mitch McConnell, who's been so powerful on the Republican side, saying that. And of course, there's a lot of pressure now. They've got to take that stopgap spending bill they passed last Friday and have something in place to replace it by this Friday. And getting this package passed is a very important part of that. Congress is set to adjourn, the Christmas holiday or right around the corner. One more thing I just want to throw in quickly, Tom, is the fact that the airlines are very much in favor of this. They will get $7 billion in aid in the $748 billion, again, the bipartisan group plan, if it's passed, to help them bring back people who've been laid off, pay the people they have on the payrolls. So there's a lot of pressure building now for this to pass. The politics of talking about it before the presidential election are now behind everyone, and it looks like it's a lot more serious. Will President Trump approve it? Will he sign it, I should say, if it gets passed? That too remains to be seen. So far, not too much commentary there.
Our global economics and policy editor, Kathleen Hayes, with the latest on the negotiations around stimulus in Washington, D.C. And just updating you on another top story for us this morning, SMIC, or SMIC, the Semiconductor Manufacturing International Corporation, which is listed in Hong Kong, but also in the mainland. It suspended trading in Hong Kong. Now, this is one of the companies, one of the 10 companies that the MSCI came out and said it was going to be taking off and deleting from one of its indexes after consulting with some of its clients. It is a company that the Trump administration included in its executive order back in November that it claims, the Trump administration claims, this company has links to the Chinese military, something, by the way, that SMIC denies. We'll bring you more on that story as we get it. Currently suspended in Hong Kong. Right, still ahead, we're counting down to the listing of one of Hong Kong's biggest consumer sector IPOs. Chinese soap maker Blue Moon will debut this hour.
But next, Chinese leaders are likely to convene this week to lay out their priorities for the economy next year. BofA Global Research Helen Chow will be coming on in a couple of minutes to give us her expectations. And of course, we are counting down your midweek session, Shanghai, Shenzhen, in Hong Kong. Just over 20 minutes away, futures pointing up. You're watching Bloomberg Markets, the China Open.
With a new administration coming to Washington, changes are undoubtedly in store, from the economy to foreign policy to public health. I'm David Weston. Join me for a Balance of Power special report, a look ahead to the next 4 years, this weekend on Bloomberg Television.
Welcome back. You're watching Bloomberg Markets, the China Open. Just re-upping what we were seeing in terms of some lines crossing the terminal when it comes to SMIC, the semiconductor maker that is listed in Hong Kong. Its shares are suspended after a decision by the MSCI to delete SMIC SMIC along with 9 other companies from its global investable market indexes. That is after the Trump administration signed off on an executive order banning the buying and selling of 31 stocks, including SMIC, for their links to the PLA and Chinese military. Again, according to the US, SMIC denies that it has links to the Chinese military. Its shares are suspended in Hong Kong. David.
Yeah, it follows earlier on in early days, you had FTSE Russell and S&P Dow Jones, and now, as Tom was pointing out, MSCI also now out. So you have a list of 7 companies. Some of these companies, of course, have 2 stocks. As Tom was alluding to, there's SMIC. There's also a couple of others, which we will be tracking, of course, for any market reaction, though I should emphasize this move was more or less expected. I guess the surprise might come in the form of some stocks not being included in this exclusion. I'm going to mention CNOOC, for example. We'll see whether or not that gets some relief. But yes, there you go. You're looking at some of these names, Tom, being removed in the coming days here out of those MSCI indexes. Tom.
Yeah, and it underscores, doesn't it, the tensions between the US and China, particularly when it comes to capital markets. And despite those tensions between Beijing and Washington, Hong Kong Exchange's outgoing boss, Charles Lee, he says the city's links to the mainland are irreversible. He's predicting his successor will need to double down on that strategy after he steps down at the end of the year. Charles Lee spoke exclusively to Sophie Cameron about the role the Hong Kong Exchange will play in the future.
The Chinese market will never be like the international market in its entirety. The international market will never be able to suit into a Chinese market. But there will be enough, middle ground where they do intersect. It is in that intersection that Hong Kong have to find the most relevant role to play. Because Shanghai will play in that role, Singapore will play in that role, other people will play in that role, but Hong Kong is the only one who can truly go in between and need to find a way, because that role initially is small, becoming bigger and bigger, and then eventually stabilize so that the American will still be here, the Chinese will be here, there will be something in the middle. Then when that middle size is no longer growing, then Hong Kong just need to go deeper.
Now, there was momentum towards embracing Chinese assets. We've seen index compilers, for example, including those equities on their indices. That has stalled somewhat given the U.S. sanctions imposed by the Trump administration. What are the implications of that on China's attempts to integrate into the global markets and its liberalization on the mainland, as well as Hong Kong's role in this?
If you look at that global map, invariably you will walk away with the conclusion that China is the place where yield is going to be, because fundamental economic development is stronger there. The consumer class is growing there. The people are getting more wealthy. The currency is becoming stronger, and their supply chain is as resilient, as strong as ever. While this decoupling will continue to put stress on the respective economies of each other, I think relatively speaking, the Chinese market will become increasingly more important for global investors. So, yeah, government, policy makers, individual political figures can always do whatever they wanted to do that could potentially create short-term temporary impact on a more localized target. But as I said, finance money is like a water. You can't block water. You can block water from one area. You can't block water all the time. Water is going to sip through it. If you block it, it's going to sip through it. It's going to go up to the sky, and then it's going to rain into the other side. They will find a way to get there. You can't really block it. It's not very easy to push water uphill.
And what are your thoughts on banks complying with U.S. sanctions on Chinese and Hong Kong officials?
Well, I think banks are global businesses. A lot of the government have developed very intrusive, sometimes arguably quite arbitrary tactics when they want to achieve certain policy or political or regulatory goals. So the banks have no